watched the highlights.
I did too, actually. I was trying to make sure I kept up.
Very good. Farrell recovering from that. We hope to see him maybe tomorrow because the Gulfstream's over here. So, I think maybe
Okay,
Wednesday.
hold on. Let's just make this real clear right here. Yeah. I do not take a Gulfstream or a private plane because people have actually stopped me and said, why are you not on a private plane? I have never taken a private plane before in my life, but carry on.
I was stopped in Heathrow about lease on the Gulfstream and said, well, the Bombardier we're looking at, but we just don't think we can pull that off. Futures are -1, Dow futures -14. You're waking up on a Monday to a changed world. Brammo nails it with a quinfecta. IDF 5 or things in a swirl. Let's go to something we haven't talked about yet with the real yield up to new highs, new generational highs, 2.11%. China, the developers, that story unravels to the point, I think I can say there's no bid in the market because there's no market.
There is a feeling that something could happen where there could be a real default and suddenly there is a difficult scenario that the government can't control or is unwilling to control in a meaningful way. We talk about the quinfecta, and that includes real yields. It also includes the auto strikes. It also includes a government shutdown. It also includes this idea of higher gas prices at a time where oil prices are rising yet again today. And you put that together, and it's very hard to see how any of them, yes, maybe in isolation, not that significant. You put them together, it feels different.
It's like Craig Trudell and the EV vehicles. Well, who cares? Nobody can afford them but the rich people. I'm going to look at the housing market where nobody can afford to do housing except the rich people. And while you and I were sojourning in London, I thought, I wasn't in Mayfair. I was west of Mayfair a little bit, looking at, a closet. Bank rate 30s. 7.75%, rounded up. How close are we getting to an 8% mortgage?
At a time where perhaps not a lot of people are paying for them, for that kind of mortgage rate, because you can see that the housing market's basically broken. On the other hand, it highlights how expensive things are getting. Mark Zandi of Moody's over the weekend put this out.
Yes,
and he said it costs $734 more each month. That is thousands of dollars a year each month to buy the same goods and services as it did 2 years ago for the average median household in the United States. You start looking at that, you understand some of the dissatisfaction. You understand why people are less concerned about the pace of the disinflation and are still looking at just outright inflation and making a lot more discretionary choices with their buying.
We've got a guest on this in the market dynamics. If you're part of Global Wall Street, Catherine Kaminsky will join us here in a moment. Shall we brief?
Let's brief, because this has to do with the entire week ahead and really framing out this discussion of real yields climbing to the highest levels or about the highest levels since 2009. 7 Fed speakers. Tom is on the edge of his seat waiting to hear them all. Minneapolis Fed President Neil Kashkari, that is today at 6 p.m. Fed Governor Michelle Bowen tomorrow. Thursday, the Fed Bonanza. Fed Chair Jay Powell, Fed Governor Lisa Cook, Chicago Fed President Oscar Goolsbee, Richmond Fed President Tom Barkin on Friday. We hear from New York Federal Reserve President John Williams. Really key to hear anything on real yields. Earnings, and this to me, it kind of speaks to the same story, Tom. How much do people keep buying if you get their overall expenses continuing to climb? We get earnings on Tuesday from Costco, Wednesday H&M, Thursday is Nike. How much are we looking at a new pressure on consumer discretionary that start feeling it first?
This is nominal. Sales of all this is done in nominal, including Mike McKee's retail sales number. And I usually don't pay attention to this, and I think you're dead on. This time around, the retail pulse is a huge precursor to what we see beginning October 13th with JP Morgan.
Anecdotally, we hear people pulling back. When do we start to see that in the granular earnings data on the overall economic data? Yeah, exactly. Again, it's just why would people spend that if they're spending so much on everything else? Economic data this week, home price data, as well as the new home sales that comes out tomorrow. I'm curious if anything's moving, considering the fact that this is basically a broken market. Jobless claims Thursday. And to me, the key day of the week is Friday. Personal income and spending, as well as core PCE data. Again, how much do we see the economic surprises continue to inflect upward in a U.S. that is seeing this quinfecta of threats, this toxic brew of feeling that maybe it's getting difficult. Hexfecta? What's that?
6.
Yeah?
7.
What do you think hexfecta is? Like what? Vet Bill having a martini?
Yeah, no, we didn't have that. But, again, he has the olives. We've cut him off. They're trying to cut me off, too. I'm going to focus on the VIX 17.84. If you're part of Global Wall Street, arguably this is the conversation of the day. Catherine Kaminsky, and the title's boring, Chief Research Strategist at Alpha Simplex. But far more importantly, out of the Andrew Lowe Combine in MIT Boston is trend-based. She and her shop follow trends in the probability of coming out of a range into some trend across all assets like nobody on the street. Katie Kaminsky to brief us this morning. Katie, I'm going to be honest here. You correlate across some bonds, economics and all that, over to equity markets where you are more than tentative. Tell us about the repricing that we could see in the equity markets.
Good point. Okay, so this year what we've really seen is that the equity market has been disjointed from the fixed income market. So it's been blissfully going along relatively positively, ignoring the fact that there might be some issues and we might need to have higher rates for longer. We feel like last week we finally saw a point of recognition. We saw a breakout in the fixed income market where we saw yields higher significantly on the long end. What this means is the market has really finally said, wait a minute.
Right.
These upside risks are real. Like higher energy prices, that's a challenge. I mean, these things have to be solved for the equity market to waver through this.
And now we go where the pros fear to tread. Wells Wilder, 1978, with Katie Kaminsky. Katie, cut to the chase. There's a green equity feel of up, 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 and a red down, down, down from Wells Wilder.
higher inflation is the nominal rate, so we have to have higher nominal rates until we deal with the problems. And the problems are higher oil prices, inflation not going down. It's dealing with supply chain issues and other things that we just didn't have in a low interest rate world.
A clinic, Katie, thank you so much. 4.49% right now on the 10-year yield she was quoting. Catherine Kaminsky with Alpha Simplex this morning. Monday, Luke Cowell is doing Newtonian calculus way too early in the morning. I just got to know, Quantis hates when I do Greek.
Okay.
Alpha, beta, gamma, delta, Omicron, epsilon.
There is
he hates this.
a techno song that my oldest son listened to remember all the Greek letters. And says all I could think of, it was like alpha.
That's well, you should memorize your Greek letters as well. Katie Kaminsky there. That's a clinic for global Wall Street. The Standard & Poor's 500 this morning, I'm going to call it down 0.1%.
So what are you looking at most this week? I mean, for me, I think
Good question.
I really think that retail sales in the United States might be the most interesting part, especially paired with earnings. What about you?
I mean, I think the earnings play into it because that's the hope and the prayer of the soft landing is earnings resiliency. I got China, and I'm underplaying the gloom there. I could be wrong on that. But what am I watching? I think it's got to be the real economy. The parlor game, the Fed, the mumbo jumbo, less important now than, okay, what does Nike do? How bad is it? And all the different earnings that are out there. I would
agree with that. I don't think that the Fed speak is really going to have as much of a feature in market response. I think people have moved beyond it, and they're looking at the granularity. But this might be the last data that we get before a government shutdown removes all of the public data. I mean, the retail sales and the PCE, the core PCE on Friday, might be some of the last nuggets of information that we get from the official channels.
I'm just going to go back to the real economy, which is nominal GDP. What does it mean for revenues and the margin, the shock we've seen of constructive margins? But the heart of the matter, and particularly waking up on a Monday and having Purvis come up with Tallback is really important. The basic idea, Lisa, that we're going to go into earnings season and once again be surprised and everybody's going to pile into 7.5 stocks. That, to me, is what's not expected here.
Although, you know what?
Or
people
do they
are
do
all
better
buying
going down?
The iPhone 15 evidently is crushing it.
Maybe that Farrell, last sighting of Farrell actually was at Covent Garden. He was in a line outside the Apple store.
I love how you just, project on everyone. Take the jet stream, spend the time in, Apple stores, singing American
Futures
Pie.
-4. Yes, we got a message. Is the Bramo Cam with us in our new studios? Yes, the Bramo Cam came with us. This is Bloomberg. Stay with us.
On the next episode of Hello World, I head to Los Angeles, meet some robots, and eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
A government shutdown could impact everything from food food safety to cancer research to Head Start programs for children. Funding the government is one of those basic responsibilities of Congress. And it's time for Republicans to start doing the job America elected them to do.
President of the United States in for an active week. They're speaking to the Congressional Black Caucus Foundation dinner on Saturday. I would say largely a Democratic room. He'll have to go to Michigan, which is fractious to say the least, of a Republican and Democratic state. One year one wins, Lisa. The next year the other one wins. Trump looks at that as fair ground. There's no other way to put it.
The reason why they're both going to be in Detroit, in Michigan. And I'm curious who's going to gain more traction and whether that's going to take over any publicity from the potential government shutdown.
Welcome all of you. Good morning. Bloomberg Surveillance. We're in our temporary studios here in New York. A little bit different look. Farrell with our interior designers in London. He's picking out curtains for the new studio. We're a building here. Lisa Bramwitz and Tom Keene with really interesting markets. You need to stay with us through the morning here as we see if yield adjusts. Equities quiescent to say the least, although a VIX out to 17.90 shows a relative tension over, say, 14 days, maybe 10 business days. 93.41 on Brent crude, 90 West Texas Intermediate. We got to go to the yield space, Lisa. I'm sorry, to walk in and see 2.12% new high 10-year real yield. That shifts the game for any and all.
How many days have we come in and thought that yields would come lower and think that people were going to buy, since everyone was saying that they were buying, and as Katie Kumesi said they were all selling, even though they said they were buying. To me, the key question is what's going to be more important this week? Is it going to be the government shutdown discussions, or is it going to be what's going on in Detroit? Anne-Marie Hordern, fresh off UNGA, is back in Washington, D.C., our Washington correspondent for Bloomberg. Anne-Marie, I'm curious, what's more important to you? What's going on with respect to the shutdown discussions, or what's happening in Detroit?
Well, I think when you put them together, that's when you have concerns for the U.S. economy. Even though shutdowns in the near term don't impact the U.S. economy, they do cost money in the sense that we are paying people to not work but still not collecting fees, say at a national park. That can cost the U.S. government actually a fair amount of money. But to the consumer, there's not an intense amount of impact of a shutdown. But if you coalesce all these things together, as Stephanie Lowe said in your earlier hour, and you have higher oil prices that impact gas prices, you still have inflation, you have a government shutdown, and you have the auto workers striking, that could be very difficult for the U.S. economy. Obviously, in Washington, I'm laser focused on the shutdown because there's really not a lot of time to get this done. And you do see a lot of positions within the Republican Party feel to be that they're just hardening and it's just taking a lot longer. There wasn't a ton of movement this weekend. They'll be back in session tomorrow. And Speaker McCarthy wants to get 4 appropriation bills on the floor, potentially maybe coming together with the hard right to show an olive branch that he wants to do this by appropriation bills, not just a stopgap funding measure. And then maybe they would allow him to pass a stopgap funding measure. But at the end of the day, and the House wants to get through, it's not going to work in the Senate. So there potentially could be a shutdown, at least towards Rick Davis and Jeannie Sheehan Zaino's 48 hours.
And a lot of Democrats have been saying that maybe this could benefit Biden. A lot of the oxygen's being sucked out of the room. I was wrong earlier when I said it's unclear whether President Biden will join the picket line on Friday. He did put out a tweet saying an X post, I will say. I'll go to Michigan to join the picket line and stand in solidarity with the men and women of the UAW as they fight for a fair share of the value they helped create. How awkward is this going to be? Will this be viewed as a victory politically for President Biden or a liability?
Yeah, I'm looking at the president's week ahead schedule, and in Tuesday, it's there in black and white. Wayne County, Michigan is where he'll be to join the picket line. I mean, you had Pete Buttigieg out over the weekend saying the president should be doing this. He's standing with the American people. He's definitely being backed up by the Democratic Party to go join the picket line and go stand in solidarity with American workers. That's the tone from the Democratic Party. Obviously, there are concerns because they're in the middle of a negotiation with the 3 big auto companies. And obviously, the president wants to see auto companies in America, as they have this EV transition, also prosper. So the president, I think, is just going to make a show to make sure that he is being seen as the most pro-labor union president in American history. He likes to tout it, and now he's really putting his money where his mouth is. Interesting, this factoid from the Washington Post this morning caught my eye. Labor experts say it's probably the first time a sitting president has visited a strike in at least 100 years. So it really feels like a paradigm shift.
Right. Anne-Marie, I want to digress here for our international audience and, frankly, for Americans in an iPhone world. I am fascinated how blind Joe Matthew and Anne-Marie Horton are when looking at polls. We begin this political season, and the New York Times sums it nicely here. You got an NBC poll, you got an ABC Washington Post poll. They're not even close. There used to be this time where people in bow ties came out and said, and this is the way the poll is, plus or minus. It's gone. Do the polls matter, Anne-Marie, now that we're all living on cell phones?
Well, I think the polls matter closer to an election. I think it's very difficult to look at these polls so far out. We're over a year away from the November 2024 presidential election. But it is quite astonishing when you look at this Washington Post ABC News poll, because if even a slight bit of it is true, the Democrats have a big problem. Trump is leading Biden by 10 percentage points in this poll. And if you dig a little bit deeper into some of the details of this data, under 35, Trump is leading in voters aged under 35. Trump is leading by 20 percentage points. This is a group that Biden scored major wins with in 2020, leading by double digits. So yes, at the moment, this is an outlier, but looking at this poll could potentially be concerning if a few other polls start to show up like this. Also within the data, one thing is very clear.
Please.
Americans continue to give this administration poor remarks on the economy. Even though they tout Bidenomics and they tout the low unemployment rate, inflation still seems to be this number one concern.
So bring it over to Michigan. I mean, what is the prescription to get that under 35 vote in Michigan? Does everybody show up at a Nickelback concert? What do you do? What do you do in Michigan?
Nickelback. I don't even know if they're still performing, Tom. But I mean, I think
Anne-Marie, I priced them for a family outing. They want $750,000 base fee. Let's continue.
I didn't realize the Keene household were big Nickelback fans. Okay, good to know. I think this Michigan trip, the president is going to try to shore up everyone in that state to show he's in solidarity with these workers and their communities, right? So many of these UAW workers, potentially their families also work on the supply chain that are impacted by what is going on. The Democrats want to show we are on the side of workers, less so on the side of corporate America. This administration continuously always touts as well the idea of corporate greed and a low corporate tax rate that they've wanted to bring up after the Trump era tax cuts. That is his mission in Michigan, and why Michigan is so important is because, of course, Biden won it in 2020. But the former president, Donald Trump, was able to flip it in 2016. That was the first time since the late 1980s.
Anne-Marie, are we going to hear about the green agenda on Tuesday from President Biden?
Oh, I highly doubt it. Unless he's asked about it, he'll say that they want to support a fair transition to the green agenda, where workers are the first ones from the UAW to potentially get those jobs. But he is not going to want to touch this industrial policy with the Inflation Reduction Act.
Anne-Marie Horton, thank you so much. A terrific Monday brief. Hopefully she'll be here for the Tuesday brief as well. The news flow, just extraordinary. And I loved your question, Lisa, your insight about, okay, UAW strike or government shutdown, particularly if a shutdown is presumed to be 8 days a week and everybody gets paid at the end of it. Oh, we were pretending. I mean, I get to your point. If UAW is long like the Hollywood strike, that's maybe more important.
Especially because you've got posturing from both President Biden as well as former President Trump in Michigan trying to get that vote at a time where it's unclear where the allegiance lies and what the main issues are that are driving it.
We got the encyclopedia, Greg Giroux on this, expert at Bloomberg on all this. But I think Giroux would say, look, the election's there's 50 states last I knew.
Yeah.
It's only like 10 states or 9, I don't know how many, 9 states.
The swing states that are most important. And this is one of them. And it's really the key issue, which is you talk about, or Anne-Marie was talking about how a lot of people grade Biden negatively with the economy. And it comes down to inflation. And regardless of inflation coming in, costs are going up at a really notable way. And real wages just crossed where inflation was a couple of months ago. It's tough when you're looking at a fixed cost. Gas prices are rising. Your mortgage rates are crazy.
Well, that's what
it becomes a difficult moment.
Everyone feeling that in America. Right now we're feeling a market check in order. Futures at -4, Dow futures at -24. The VIX near an 18 level. The yield space speaks. Disinversion in place. Stay with us. Bloomberg Surveillance.
used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Bloomberg surveillance on radio and television. Jonathan Ferro, Lisa Bramwitz, and Tom Keene. Mr. Ferro on assignment after Arsenal Tots draw, interviewing Daniel Levy. That was hugely successful.
That was huge.
He was back in the corner. They went down, I mean, everybody's got an opinion of the game. I think Arsenal sort of didn't deserve to win, but
what a shocker.
Neil Millington at the Lanesboro would say, no, I'm wrong. But the answer is, Ferro was down in the corner with the Tots crew. This is a away game. And he was up like 13 rows. He wasn't hugging players, but there he was. He was going mental.
Yeah.
And it's great. He's on assignment in London, recovering. We look for him on Tuesday and/or Wednesday as well. Futures -4. Lisa and I are focused in the bond space, as they say, from bills out to bonds. Let's do curve inversion right now. 62 basis points. So we're in from 80, 90 basis points. On radio, the hand check here is going to be great here. 2-year, 10-year. And that's becoming less of a gap. We're disinverting, Lisa. What's that mean for the pros?
Well, what Katie Kaminsky was just saying is that maybe that's the tipping point where you reach some sort of new reality when people start to understand maybe this is the level that we're going to live with for a longer period of time, and that's why you're getting that flattening. But honestly, I just think right now, what Katie said, everyone's been saying that they're buying bonds, but they're all selling them. And at what point do we get some capitulation? That's fantastic. You guys think to that?
On a yield basis, like price down, yield up. That's where we're going here with a must-listen interview. It's like ZZ Top in that video that they did years ago. Eric Davis is going to join us in a moment. If you're with Global Wall Street, you've got to pay attention to this. He was hugely controversial last time. He was on 93.51 on oil. We're going to go under surveillance led by the President of the United States. We're in Patagonia on the picket line.
Well, this is a concern that some people have. What's the political stew that's going to take a precedence this week? President Biden warning Republicans of the risks of a potential government shutdown with a deadline now less than a week away. Republicans made little progress over the weekend on a short-term spending measure that would still need to pass through the Democrat-led Senate. It seems like it's increasingly likely there will be a shutdown. Unclear, though, Tom, whether the length will really justify its ranking among the quintuple threats that are facing markets right now.
Well, it's good to see. And to me, the big thing is this story, as Anne-Marie Horton said, he goes to Michigan, and after those polls that we saw this weekend, it's sort of a near-term, let's jumpstart this, but he's been trying to do that all through the summer. I mean, this is not a new project.
I love what Holger Schmieding said. It's like, relative to the U.S. right now, Europe seems like it's a well-oiled machine. Meanwhile, Morgan Stanley's Ellen Zentner saying it's highly unlikely the Fed hikes rates in November. They think that they're done, Morgan Stanley. Instead, believing the Fed is done and expecting rate cuts to start in March of next year. Zentner tells the What Goes Up podcast, quote, they've got until the end of the year to decide if they're going to hike further, and they've left the door open to hike further if needed. I have a strong view that they're done here, but they have left the door open. Basically talking about how the bar is incredibly high, given that their baseline expectations for a reacceleration slightly of inflation by year end.
And this is really important because you dovetail Zentner's economics, Lisa, with what we see with Jim Caron a few days ago, applying it into the bond space. And this is the Morgan Stanley bet that this is it, price up, yield down at some point.
There isn't conviction right now. This is very much controversial and very much non-consensus, if you think about it, because as Katie said, and I keep going back to this, everyone says they're buying bonds, but they're selling. And if you believe Ellen Zentner, you'd be a bond bull. Excuse me, I'll get it out. It's incredible.
Sound like Tom King.
Thanks. This to me is going to be really interesting, whether people start to lean into that.
We'll have to see. Everybody's going to have to rewrite this. Everybody's got to do their Q4 guesstimates on outlooks. I think it's as foggy as it was. What else do we have here?
Delivery times for Apple's latest iPhone, the iPhone 15, which I know you're very excited about. I think that Fat Bill's going to get one too. Well, the lines to wait for Apple's cheapest iPhone 15 model are almost twice as long this year than its predecessor, signaling strong demand for the company's newest phone. Buyers waiting 10 days to receive the basic model, up from 6 a year ago. Pre-orders for the iPhone 15 Pro Max increased to a record. Significant upgrades to both models are what some people say are driving demand. What I find interesting is this is even in China. It's not just in the U.S. And you wonder if maybe all of the regulations and the pushbacks of the Chinese authorities didn't really have the effect on people in the rank and file in China, the consumer, in terms of pushing them away from the iPhone.
Thanks for the email. Thanks for watching and listening in London, and particularly in Covent Garden. We just had a Faro sighting, WC2E 8HB. That's a zip code in London, and that's like the Apple Store, I think, sort of in Covent Garden. He's down there picking up a new toy. This is hugely anticipated, and this is what Bloomberg surveillance is about. Our team is 24/7, and over the weekend we said, get Catherine Kaminsky on the equity markets and get Earl Davis, head of fixed income at BMO Asset Management, on yield as well. Earl Davis joins us to bounce off what Catherine Kaminsky just said. Earl, you say price down, yield up. You have a greater conviction on that than the last time we talked.
So here's the interesting thing. The answer is definitely yes. This is unfolding largely as we saw it, and we still see, significant room for a sell-off on 10 to 30-year bonds, possibly 50 to 75 basis points higher before the end of the year on 10 to 30-year bonds. Having said that, we do see that as a buying opportunity. Friday we actually reduced our short position slightly, not by buying nominal bonds, interestingly, by buying tips. We do see tremendous value in the tip market at a 2.20 real yield. Not to say it can't get cheaper, which we believe it will, but that's where we're looking to buy when we're reducing our short position.
Well, two questions, one very short. Where does the 10-year real yield, where can that frame out from a 2.20? Does that have scope and scale, teens weens out to 2.22, 2.25, or can it really jump out?
It could really jump out to 2.50 to 3%. It was at 3% in 2008. And let me explain the reason why. When the real yield goes up, investors obviously get a real return. And with the economy being so resilient and still being strong, solid, as the Fed said, what they have to do is take dollars out of the growth economy, put it in the savings economy, and you do that by having a higher real rate to attract more buyers. So we can see it going above 2.50. We think possibly 3%, very top end.
I'm going to stop the show here, folks. This is so important. You've got Katie Kaminsky and Earl Davis pushing against the broad consensus, looking for lower price, higher yield. This is a global Wall Street issue right now. Earl Davis, that comes down to the gamma that we see, this instability, the velocity, the convexity almost that we see in equities. If we get a Davis bond pricing, do things unravel? Do we get to an instability? Do we get to greater gamma?
So the answer is yes, but for a very short period. We believe 2024, the economy will still do all right. So we do like credit, we do like risk assets, not at these valuations. So we do believe we unravel because you have to reprice for the higher discount rate. Once it does unravel, we will be buying. We will be going overweight. And I think that's something important to note, that, these are the flows and ebbs of the market, and it presents itself with opportunity. That's why, we're active managers, and that's what we believe active managers should do.
Earl, you were saying that real yields go to 2.5% to 3%. Is that correct? real yields
That is correct.
on a 10-year
A high
treasury.
probability. Nothing's for sure.
But to me, this is the lead of this whole thing, because a lot of people are saying this is not driven by inflation. It's not driven by growth. It's driven by something else. What is that something else driving the real yield higher?
Well, I'll tell you what it is. It's expectations. You know, when you read history books and the 70s and inflation, throughout the 60s, 70s, inflation wasn't an annoyance. It wasn't public enemy number one. It wasn't until Reagan and Volcker came in where they said inflation's public enemy number one. We're going to cut it, we're going to get it down. Right now, we're still in the annoyance phase of inflation. That's why we think it will persist. That's why we think this is a secular change towards high yields, because it takes a lot to get it to be public enemy number one, and we're not quite there yet.
At this point, you said that you're going to be a buyer when there is some sort of unraveling. What kind of unraveling is going to cause you to be a buyer if everybody's been saying this? They're waiting for the dip to buy, and that's the reason why there hasn't been the dip.
Yeah, you know what? The way we take risk is a mix of quantitative and qualitative. You know, we have structural risk and tactical risk. Our structural risk will be buying as yields get higher. We have our levels, we have our view, and then we reassess as they get to those levels. But as I said, we're still short, and we're still fairly significantly short, but we will be covering that on any further weakness and ultimately going long.
How concerned are you about the quintuple risk that we keep talking about, that maybe we're seeing right now capitulation ahead of the market turning toward all of the expectations of slower growth, given shutdown, strikes, higher gas prices, student loan repayments, and just the rates, the cost of borrowing going up as much as it has?
Hey, listen, I don't have any concern. And the reason is I look at the market, it's all about framing and how you look at the market. So I look at the market like a Boeing airplane. So we're getting all these weather patterns hitting each other, low inflation, high growth, low growth, all this, and we're getting turbulence. And you know what? The turbulence could shake the plane. It could drop 500 feet, but it's going to survive coming out of it. So I have absolutely no worries about it, but I do believe we're going to have a lot of turbulence over the next year.
Earl, very quickly here, and folks, we're going to get a little nerdy here as we did with Katie Kaminsky. Excuse me, Earl Davis, I've got Loonie at a 134. It is stochastic weak Canadian dollar at a 140. It's stochastic because the system's overcome by events. If I get an Earl Davis market, I get a stronger dollar. And does a stronger dollar itself solve its own problem?
That is a great question, and I agree with the sequencing of that. What the stronger dollar itself does, it allows us to play out into our story where there's going to be some volatility in this quarter, but 2024 is going to be all right economically. And the key to that stability from an economic perspective is a stable, strong dollar. So I think it allows us to play into the story of, yes, we're going to have volatile times, but we're on the best of airplanes, and it's made for this, and we'll be able to survive, and not only survive, thrive. You have to remember, as the yields go higher, that's a longer expected return for retirees, for pensioners, for investors in bonds. There's going to be tremendous opportunity here. Right. And even though we believe we're in a secular bear market, I see 2024 being a cyclical bull for yields.
This is fabulous. Earl Davis, thank you so much with BMO Asset Management. Folks, this is what this show's about. You have Katie Kaminsky and Earl Davis back to back, both screaming about lower price, higher yield in the fixed income space is what a Monday morning is like. Don Cass emails in the day the liquidity died. Let's talk about that.
He's really building on the theme.
The VIX 18, Standard & Poor's 500 down 0.2%.
Right now, we're looking coming up at a number of different events. You talk about the dollar, and you were talking about the yen and the weaker yen. And what I find interesting is that the Bank of Japan Governor Kazuo Ueda doubled down on his more stimulus needed message overnight. And that's kind of what some people are saying is driving the latest leg weaker for the yen, 148.63. They're not backing away.
Well, you nailed this because rounded up at 149, and I don't know where it unravels for them, but this is one of the issues that gets you away from the calm and that we're a liquid or we're a solvent system. And Don Cass down in Florida, you should hear Don Cass play American Pie. It's just unbelievable.
Throw him back a couple. It's pretty wild.
It's just amazing. He was at Kidder Peabody years ago. I remember him singing Vincent, Starry, Starry Night. Don Cass did that so well. Anyways, the day the liquidity, he was a kidder, and he used to bring his guitar to events. The day the liquidity died is what this is about. No one's expecting the liquidity to die. We have a soft landing. We have a system here. No one's looking for this solvency liquidity debate out there, given price move.
No one is thinking we're going to get a credit crisis. That has shifted off the table. Some people said that what happened was sort of a stress test back in March with some of the smaller banks and the banking failures, and it didn't lead to anything. So what will? And that seems to be off the table.
My answer is Bramo nailed it. We're looking at foreign exchange. There's not a chief U.S. economist in America that does foreign exchange as tightly as Laura Rahm. We'll talk to her in a moment here. We've got that yen out, rounded up a 149 level. I've got renminbi through to a 7.31 this morning. Even Turkish lira. Let's go idiosyncratic. Lira, 27.2. Where else are you going to get a lira quote on a Monday? Bloomberg surveillance, radio, television.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
The lack of reciprocity and level playing field from China, coupled with wider geopolitical shifts, have forced Europe to become more assertive. We stand at a crossroads. We can choose a path towards mutually beneficial relations, or we can choose a path that slowly moves us apart, where the shared benefits we enjoyed in recent decades weaken and fade.
Mr. Dombrovskis, I've really grown to listen to the guy and like the guy a lot. He has been a public servant of the Baltic states and all the Baltic states and also Europe as well. He's European Commission Executive VP and Trade Commissioner. He just works tirelessly. I'll get it out on a Monday.
It's all right. No, it's true. And I think that this is a really different tone that we've heard over this time. And I keep going back to Holger Schmieding, where he was saying that, the European region may be willing to take some pain to really execute some sort of greater de-risking or decoupling, whatever you want to call it, with China.
Good morning across America, on radio, on television. Futures at -10, Dow futures -60. Bramo and me holding court here in London. Eventful trip back. Thank you to all in London for a wonderful week. Farrell on assignment after his Daniel Levy-Tottenham interview caused a firestorm. His media people said, you can't leave now. He's got such a role going that he's on assignment in London, also looking at 3,000 square feet west of Mayfair, I believe, this morning. Right now, we're going to digress to the delicacies that America faces in a fractured Europe, and that fractures mostly around a new Germany, around a Europe, around Germany, And of course, all this going on with the war in Ukraine and the war with China. Bloomberg's Maria Tadeo-Brice this morning in charge of all of our European coverage. Maria, we got here in a Europe after Merkel. As Dombrovskis speaks, as all the others blather in Brussels as you deal with daily, it's a changed Germany after Merkel, isn't it?
It's a change to Germany too, but I'm happy you mentioned Dombrovskis, because for an international audience, you need to understand that this is someone who really knows how the European Commission operates. He's not the most animated. Some would say he's a little bit dry, but this is a man who really gets the numbers and really gets the details. So obviously when he speaks, people do pay attention. And the tone in that speech, when I heard that you wanted to talk about the speech, I was very happy, because this speech, it really is quite something. I mean, you have to look at what he says. Essentially, this is a crossroads for the relationship between the European Union and China. And he talks about either we fix it or prepare to lose investment.
Well, okay, but Maria, the cutting edge to me, and this is over the weekend, folks, a lot of really smart coverage of the South China Sea and the expansion of America's military might in a new way in the Trans-Pacific. That's not a European discussion. Yeah, Maria, is it just an economic discussion? Is Europe dealing in a trade vacuum versus the United States?
No, it is totally economic at this point. And the number, again, the figure that really gets Europeans has to do with the trade deficit between the European Union and China. And Tom, it is growing almost every year. It's almost now 400 billion euros. And that is a number that really underpins this entire tone, this changing tone, really, in a very big way, if you read between the lines, between the European Union. I mean, when you get the guy who handles the trade portfolio that goes to China for 4 days and say, we have to fix the situation, otherwise the European Union may not be as keen in investing and opening the market to China as we have been, that is a very significant change in tone. And again, it all goes back to that number. The Europeans are not happy with that trade deficit. The question is, of course, what happens with Germany? This is a country that has been the most reluctant. They have been fearful at times about potential retaliation. But also, Tom, you pick up a lot of different sentiment now in this condition and in this commission that says the fact that we listened to Germany for so long, that we were so fearful of China, has prevented action that was valid and legitimate.
And this is what we heard from Holger Schmieding, that suddenly there's a willingness to take pain in the near term to de-risk, his word, decouple maybe somebody else's word with the Chinese economy. How much pushback is there right now from Germany?
Look, for the time being, not a lot. And remember, they actually agreed to that EV probe. We should note it wasn't Germany that pushed for that probe. It was Emmanuel Macron of France that wanted this probe into the electric vehicle, because he does believe it is the future of the sector. But again, beyond that, for the commission, what they say now, you should note also that the head of the commission is a German too, and she's willing to open this probe. I think what happens now is that the Europeans have to some extent realized that trade is great, but the European single market, and this is a moneymaker for Europe, may have been abused a number of times. And when they look at China, they take the experience of the solar panels. Europe had the technology, but they got wiped out by Chinese companies. I think there's been a realization of that, and the political mood is changing. I'm not sure how much Germany will be willing to run with it, but for the time being in Brussels, it really has. And this is a relationship that honestly in the past 2 years has gone very cold.
Which is a question about whether this is an alliance with the U.S. or whether this is Europe kind of in its own right trying to make a move for long-term prosperity. How much is this being driven in tandem with other nations in the West versus a kind of go it alone, very European bespoke agreement that they're trying to reach with China?
Well, in terms of, we all know that both in the United States and the European Union, everyone says no to decouple, that is too late, that train left the station already, but yes to de-risk. And so the language on both sides of the Atlantic is identical. But when it comes to this push from the European Union, I would say it is very European. I think when you look at the single market, we should really stress this. The Europeans view this as their crown jewel. This is the moneymaker. They have to protect it. And as you see now, they're willing to not just protect it with actions, but really a speech and a tone that is very different when it comes to China. Again, for Valdis Dombrovskis to go to China and say, we're at a crossroads. You either balance this relationship, we narrow that trade deficit, or prepare to lose investment. That is very significant. I mean, to me, the speech, it really is very important.
How much meat is there behind this, though? How much willingness is there to actually levy tariffs or engage in some sort of de-investment, even potentially at a loss?
Look, I
think when it comes to the trade war, the European Union has been clear that they do not want to see a trade war, and they also believe that a lot of the trade that goes from the European Union to China is actually beneficial for the European Union. Everyone is clear on that. The reality is, when you look at, however, the number that has triggered maybe not alarms, but really concerns, is the fact that you see this trade deficit in favor of China constantly, consistently, every year, and it's growing, and no administration has been able to narrow that. Then when you look at that speech, what Dombrovskis gets to is, we don't want a trade war, but we need to narrow that trade deficit. It's 400 billion euros. It's enormous.
Maria, thank you so much for the brief. From Europe there, and something that seems distant, but all of a sudden it mixes in with American-Chinese policy as well. Maria today in Brussels on the stridency of trade in Europe as they look to China as well. You know, you miss, Lisa, I'm sorry, you're 1 week in London, we're out of touch. You know, don't you lose it? I think in any number of ways. I was looking at like, how are the Giants doing? They're terrible. And the Jets, they had that terrible injury. And Aaron Rodgers, the Padres, I think they won 9 in a row. Tatis with a great catch. None of it matters. None of what we do matters, folks. Even Michael Purvis coming up with Tallbacken. Because there's only one topic this morning.
What's that, Tom?
Here's a partial score. The Bears beat the Chiefs. No one cares. They don't care what we're doing as well. Taylor made an appearance. And this is, I can't even begin to explain the politics of Miss Swift at Arrowhead Stadium to her right, off her right shoulder, on radio, dressed in the garb of the receiver for the Kansas City Chiefs, Travis. Travis's brother Jason plays for the Philadelphia Eagles.
Okay, I'm curious, Tom.
Taylor's an Eagles fan, but she's wearing Chiefs red.
Okay, so I knew you were going to go here. Taylor Swift is evidently having a romance with the Chiefs tight end.
Unconfirmed, but we'll go there.
Travis Kelce. And Kelsey. Yeah, I'm nailing it. Even though she is an Eagles fan, and that is the news, right?
This is like bigger than Biden.
How do you catch up after you've been off for a week with what you need to know that happened in the U.S.?
I go to the Afterthought. It's my load of American gossip. I do two things. I go to Afterthought and get a briefing. And there's a tradition really back over 15 years. I go to Scarlet Fu. And Scarlet Fu is the surveillance celebrity lodestone. And she gives me a brief.
Okay, so then she tells you.
She knew the strike was over with the screenwriters before the screenwriters.
Because there was a romance between the Screenwriters Guild.
I said, "What's Oppenheimer doing?" And she said, "It's great." And Barbie's doing something in Russia, and that's breaking up. But this Taylor Swift thing is really big. You make light of this.
I'm not making light of it. I mean, it's really important. Why is it the most seminal news item that you needed to catch up on?
Well, they had a Super Bowl, and Mrs. Kelsey, Travis's mom, had to choose between Philadelphia and Kansas City.
Did you see that Usher is going to headline the next Super Bowl?
I saw that. Actually, this is really cool.
I said to my son, "Did you hear this?" And my son said to me, "Who's Usher?" And that's actually a key question, because for a lot of the younger kids, they don't know the artist.
First week at Bloomberg, Matt Winkler, founder of Bloomberg, got approval from Reto Gregori. They put me up at the Ritz. I'm going down the elevator with this kid with diamond earrings in his ears. It was Usher. I was the only one on the elevator who didn't know who Usher was. Usher, the Super Bowl.
There you go.
This is Bloomberg. Good morning. S&P.
Now, women on average have about a 30% lower, amount of money saved up for retirement compared to men.
Yes.
So what are you doing about that?
Yeah, so we launched a campaign called Retire Inequality. And we do know that women retire with 30% less. Women make 83 cents on the dollar. And so there's a couple of things that we're doing. One, it's having this conversation and making sure that we all are aware that there is a gap. By the way, women live longer than men, so longevity risk is a real factor. Secondly, it's about making sure that we are talking to women about what can you do differently. And so whether that's negotiating pay and what are some tools that are out there, making sure that you take the time to negotiate, because we know women do not negotiate as much as men, which puts you at a disadvantage to start. But then also along the way, making sure that women are securing their own retirement, and that as part of their retirement plan, we're having much more conversation around guaranteed income as well. And so ensuring that we understand what are the nuances for women. If you think about COVID, 2 million women exited the workforce. They did not continue to contribute to their 401k or 403b plan. And so how do we make sure, as a matter of policy, as a matter of engagement, that women can have an opportunity to catch up, that women can understand that if you exited the workforce and now you're back, that that's 2 years of compounding that you were not able to take advantage of? And how do we continue to make sure that we're educating them and giving the tools that they need to get back on track?
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping. Look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
We've seen phenomenal sort of narrowness in the US market. It's really hard for the market to look for a dovish Fed right now.
The markets are going to have to accept that they really are willing to keep interest rates higher for longer.
Our concern is that they are going to keep rates too high for too long. They're going to slow down growth too much.
At some point, their lags are going to come in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The quinfecta of threats heading into Halloween, the toxic brew of different issues. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. John is off today doing some really cool stuff, which we will bring to you later. And it is us back in New York. And I have to say, it feels different, Tom.
Yeah, it's absolutely different here. There's a real change going on, and the news flow is absolutely extraordinary. And what we've really focused on through the hour in the economics, financial, investment markets is price down, yield up. If we were to see that, excuse me, did I get that right? Yeah, price down, yield up.
Crushing it. Doing great.
And nobody's pricing that in
right now. We remember month after month, the yields would go up, especially on the long end, and you'd have all the bond bulls come out, and they would say it's time to buy. And this time feels different. Suddenly, all of the bond bears are lining up to say, this is just, the new normal. And that feels like a different set of parameters at a time where people are thinking maybe the economy can withstand it, maybe it can't, especially with some of the other risks, the strikes, what we're seeing with gas prices, what we're seeing with the government shutdown.
Lisa's going to do the data check here, but you got a deterioration of the tape right now with the VIX over 18 solid, the 18.03. With Michael Purvis coming up, I think it's a perfect segue from what we did with Katie Kaminsky and with Earl Davis. What I would say, Lisa, is it's a compendium of this day, this day, this day. It's adding up. And to the gloom crew, you wonder when it breaks. That's sort of the tension that we have Monday morning.
Two things. To me, I'm focused on what's going on in Detroit. The fact that we're going to have President Biden there tomorrow. We're going to have the former President Trump on Wednesday trying to rally the troops. And then later in the week, we get retail sales as well as core PCE. And to me, that in tandem with earnings from the likes of Nike, H&M, Costco, do consumers keep spending at a time where yields are climbing to the highest levels going back to before the financial crisis? To take a look at what we're really watching today, it is the real yield. And that to me, and what you're talking about, yields higher, you can see the real yield going to the highest levels going back to 2009. You can see gas prices climbing yet again reversing as hedge funds get bullish to the greatest degree since 2020.
For those who are not in the game, you're not part of Global Wall Street, we thank you for watching and listening every day. 2.11 on the 10-year inflation-adjusted yield permeates through the system. I can't emphasize enough how the effect here of taking us back to, I believe you said, Lisa, 2009, or to take some of these levels like the mortgage rate, 7.75%, 2 days ago, I believe it was. It takes us back to another time and place. A lot of people haven't been there.
And there's a foreign exchange component to this as well, which is a strong dollar, which is getting to a level that a lot of people think is disruptive. We heard that last week from a number of different guests in London. The euro hovering near its weakest going back to March. You could see the dollar ascendant. But with the yen weakening to such a great degree and Governor Ueda not backing down. Again, these different features that just paint a less stable backdrop with very new contours.
I know you're going to want to go through the data check and get Michael in here, but to me the basic idea, folks, is you can warble gaily about equities, bonds, currencies, commodities, but you never know what's going to be the catalyst to break.
Right.
I mean, I'm not saying it's the real yield. It could be, it won't be something dramatic like Argentinian peso, but it's talking to Looney with Earl Davis, it could be Looney going out to 135, 136. You just don't know.
We're seeing weakness, and what really comes after a particular weakness in the Magnificent Seven. We're seeing S&P futures down 0.3%. NASDAQ continuing to underperform, and that to me is interesting at a moment where it had been the stalwart. Meanwhile, you do see a bit of dollar strength, 106.32, still firmly below 107 for the euro, and that 10-year yield crossing the 4.5% threshold.
Wow.
So just continuing to climb higher to some of the post-crisis highs.
And moments ago, perfect timing, Bridgewater of Connecticut, it's a startup shop up in Connecticut outside New York City. Bridgewater says, quote, Japan's move away from negative rates now looks overdue, and that's some of that tension of yen at 149.
Joining us, Michael Purvis, founder and CEO of Talbot and Capital Advisors, to put together how different this landscape really feels. Michael, from your landscape, from your perspective, do you think that yields can continue to climb from here, or is this a topping out as people finally capitulate?
Look, I think, take the 10-year nominal yield. I think there's sort of a big technical air pocket to 4.75 and then 5% here. If you look at technicals on the 10-year yield, I mean, those are looking like Bitcoin did a couple of years back, right? I mean, it just looks like it's going higher here. But I think, when you think about some of the fundamental underpinnings of it, you've got a situation where term premia, you can measure it a couple of different ways, but that has been expanding. You were just talking about Japan and the BOJ. You're looking at interest rates around the world shifted higher. That means the foreign anchor Japanese or say German sovereign paper is not what it used to be. It was just a couple of years ago we had 18 or 19 trillion dollars in negative yielding debt. That's down to $500 billion today, and it looks like that $500 billion is heading to zero pretty fast there. So I think this is a Treasury sell-off very different from last year's Treasury sell-off. Last year was about how many hikes is Powell going to give us? What is CPI going to do? This year, it's much more about really, I think, groping through where our star is going to be, where Fed policy is going to be over the longer run. So I think the 10-year is going to keep shifting higher here.
Just to double down quickly on what Tom just mentioned with Bridgewater, are you saying that Bank of Japan is sort of inevitably going to also back away, that they're the next stone to kind of drop in this steady march toward higher benchmark rates?
Look, I think right now the BOJ is playing with fire a little bit with a currency, with a country that imports all its oil. Right now, it's a stretch to call the dollar a petrocurrency, but relative to Japan and frankly Europe, we kind of are, because we're not an importer of oil like we used to be. And oil extraction is a big part of our economy. We're now producing as much as we ever have in the United States' history. Japan, of course, doesn't have that ability. So if the dollar rallies and, say, crude jumps another $10, $15, $20, you're going to start looking at the yen at a very difficult place, which means either the BOJ has to join the hawking party, if you will, or you're going to see some really, really interesting and potentially dangerous dynamics play out in a very important economy. And that could be that could be one of the tail risks that all the markets are going to have to contend with in the coming months if the BOJ continues to play this game.
Michael, what do you do if you get a correction? It's been so long since we've had one. I take immense issue. I take immense issue with where we are now, the gloom and all that as well. I look, Michael, we've got the SPX down 5%, Dow down a little bit more, NASDAQ down 7%. I'm going to call it a summertime drawdown. That's not a correction. Can you see a correction coming? Can you plan for it?
Well, I'd say it this way, Tom. I think there's parts of the market that have been very overextended. That's the Magnificent Seven, the big tech part of the market. I think if I'm right that nominal real longer-term interest rates are going to settle into a higher floor than what they had been, then I think those valuations are going to come down unless they, look, if they blow out earnings, in the next quarter. That's now not too far away, okay, you can maybe still have some AI buzz hitting those things. But I think what I'm expecting to happen is that valuation will adjust lower on the big tech part of the market, and the call it the everything else part of the market will be okay because the valuation is not overextended there. With all that said, I'm kind of looking more of a range-bound S&P into the rest of the year and, frankly, into 2024, because the earnings growth in 2024 is probably, in my estimation, is going to be mid-single digits.
On dollar call, DXY, if it was to break out higher, we talked about the Plaza Accord earlier. Let's not do that now. But Michael Purvis, the basic idea here is dollar strength becomes pointy, becomes stochastic because people say no. Are the institutional forces in place that if we do get a renewed dollar strength, it can reverse rapidly?
Look, I think, there's sort of there's a couple of different types of dollar strengths. One is from a risk-off shock because something bad happens in the world and the dollar gets bid in sort of a reactionary form. I think what's happening here is that because real interest rates and nominal interest rates in the United States are just heading in a higher place than they are relative to Europe or Japan, the two other most important economies and currencies, you're looking at a situation where the dollar looks like it's going to have this sort of structural support here that's more gradual. It's not a shock type of dollar rally. It's more of a keep a dollar stronger longer, if you will. And that's reinforced by, if oil continues to stay in these higher levels, I think it's going to, keep reinforcing that. We don't have the hydrocarbon vulnerability that Japan and Europe have. So I think that's going to be a sort of more of a long-term weight over certain asset classes like EM equities and other, more dollar-sensitive assets.
Just quickly here, Michael, what's your highest conviction right now?
My highest conviction is that I think we're going to start seeing some of the big tech continue to sell off here, just not because there's something bad per se happening, but just simply valuation adjustment against higher longer-term interest rates. So, I went out with NVIDIA puts in early August, and I'm holding on to those.
Michael Purvis, thank you so much. Greatly appreciate it. Michael Purvis with Tallback and Capital years ago. This is a huge, ginormous call on ADX. On the currency dynamics of the Pacific Rim as well. The tape deteriorates. I'm not going to make a big deal about it, but the tape deteriorates. Lisa, futures negative 11. The VIX out to 18.07. I got a 0.3% move on NASDAQ. And to me, it's like the way it's deteriorating, it's just the bid's just giving way here is how I'd frame that.
To me, it feels like suddenly real rates are very much in the focus, and there's a question about how much further valuations can continue to richen if you have this kind of rate backdrop.
Well, you get into first, inventories, last in, first out, and all that. You got the retail people coming up. It affects them just like it affects the banks coming up. JP Morgan, October 13th. A lot going on here. To say the least. Standard & Poor's 500 down 0.3%.
In the backdrop of all of this, Tom, there's a question about going back to the office. Did you see the story in the Journal over the weekend about people counting badges in and out to determine how often people are in the office? And they did some surveys of office attendance requirements. About 1 in 5 require 5 days a week back in the office.
Yeah, well, it's an important thing. There's like 21,000 people here at Bloomberg making the terminal go every morning, all the different things that we do. And I'm the only one who doesn't have a badge. I mean, I don't badge in. They inserted a chip.
Oh, is that right?
Yeah, right here. They put a chip in right here.
So you badge in
a little
at
bit
home?
lower.
You have to badge in
it's like,
for Miss
It's like the
Teen.
dogs have
She
the
requires
security
it.
thing in case they get stolen, kennel fee and vet bill. Mike put a chip in right here. So I don't have a badge.
That's great. You just sort of beep every time you walk in. They sort of
jump a little bit.
Exactly. Is there a shock
electric
unit?
shock. It works out.
There is this question about when this is actually going to bring some sort of reduction in vacancies, and you're seeing that on the margins in certain places, but not really. I mean, you were saying it feels like it still is just about.
Yeah, it's there, and I think the interviews today have been, the conversations, I should say, have been really, really good here. Terry Haynes coming up. But the heart of the matter to me is when in doubt, you follow the deepest, broadest market. And even if you're not part of Global Wall Street, folks, on radio, on television, get up to speed on your choices of foreign exchange. Terry Haynes doesn't know anything about foreign exchange. That's why we're having him on.
Great.
There's going to be a shutdown. They're going to stop printing dollars there on that road from Reagan into the United States. Treasury's going to... Terry Haynes is so august. His name was on the dollar once. He signed it, and all that. Coming up on Washington, on your shutdown across America, on a president at the picket lines, Terry Haynes, Pangina policy. We'll do that next. Futures deteriorate, -11. Good morning.
Multi-trillion-dollar industry. There's a lot of ground to cover.
A record year of growth, hand over fist all year.
We're just getting started.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg. Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week. Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
He is proud of being the most pro-union, pro-worker president, not only compared to the Trump administration with its anti-union policies, but really compared to any modern president. These auto companies can thrive in a win-win deal that does what the president has called for, which is to say that record profits should lead to record pay and record benefits for the workers who are creating all that value.
On CNN, Peter Buttigieg, the U.S. Secretary of Transportation there, talking up where we are. I had a 3.5-hour plane delay. We circled over White River Junction for 40 minutes. I sat on the runway at Newark at 20 minutes, and then I called the Secretary of Transportation.
Oh, is that right? What did they say?
I said, what do we do?
We'll go staff.
It was sport coming home. You come over and you wave at Iceland and you slide into Middletown in the Gulf Stream, and it's a different world after all. Right now, futures -11. The tape is deteriorating on this Monday morning. Not sure what to make of it. Curve disinversion. 2's10 spread out to 62 basis points. It was much more inverted weeks ago. My headline is I got a 2.11% on an inflation-adjusted yield. Lisa, what gets you in the data? Is it the yen and Dollar dynamics, stronger dollar?
The fact that 10-year yields have crossed over the 4.5% mark, once again, that it's being driven by real yields, to me colors the entire discussion, which is we are seeing real yields dominate, taking a little bit of the froth off the top. And to me, that's the real question at a time where there's a political brew underpinning this with strikes, shutdowns, higher borrowings, et cetera, at a time of, otherwise strength and resilience. But for how long? That's sort of the question.
I was distracted in London, and I did not notice that I believe Thursday last, 7.75% on a 30-year mortgage. I missed that. And it vaunts up.
Look, I've read so many notes about how the mortgage market, the housing market's broken, right? Essentially, nobody wants to buy an existing home because no one wants to pay that, right? So at what point do you get the price corrections if you get a functioning market? How does the Fed deal with this? I mean, it seems like they're not that concerned.
Right now, we're going to dive into the toxic brew of our politics. Look for balance of power this evening. Anne-Marie Horton, Joe Matthew, Kaylee Lyons helping out from time to time there. It is just fascinating on shutdown, on strikes, and the rest in Washington. Terry Haynes is a student of this. He's founder of Pangea Policy. Always speaking to Terry Haynes is win-win. So we're going to win-win here in a lose-lose for the president. Terry, I'm going to cut to the chase. How does President Biden break the lose-lose moment?
Frankly, Tom, I'm not sure he can. The president is now in a situation where he's constantly having to shore up his base, and in order to do that, since the base are kind of small but powerful within the Democratic Party constituencies, teachers unions, the UAW, that sort of the Green Lobby, those sorts of people. It makes it much harder for him to go to the center, and you see that kind of cul-de-sac in the recent numbers you and I were talking about on the break, where his approval rating is at best a low 40%, but nobody's giving him good marks on the economy. He is either even or loses to Trump. He certainly loses to Nikki Haley. All these sorts of things, and plus there's now a rising third-party candidacy risk too.
I got 8 ways to go here, Terry. In the time we've got, the stew is so rich right now. And let me try the government shutdown. We've spoken to people this morning who look at a government shutdown as an 8-day dalliance. That just seems too cavalier to me. What is the gravity, the reality, the gravity of a shutdown?
What I've been telling markets for quite some time is, first, the shutdown's likely. Secondly, and I think really importantly this week, markets need to understand this is not the same old one and done that they've been used to that doesn't really have any economic impact. This is going to go on for about 3 months. The reason why it's going to go on for about 3 months is with stop-starts. Sometimes the government will be funded, sometimes it won't. Is that they haven't? You've got Biden kind of in the tank on his own numbers. You've got a Congress that bipartisan, bicameral, that's lazy. These people took 7 weeks off instead of dealing with this, and now here we are. So this crisis is by and large self-created, but they haven't done any work on appropriations bills, which they need to do. They haven't finished anything. It'll take them the next 3 months in order to finish the defense authorization and the defense spending bills, by which time the rest of the appropes catch up and they can actually do something before Christmas. Why that's important is that, according to the budget deal, a 1% cut goes into effect in January. If no deals are done, nobody wants that, so therefore that's the 3-month time period. Why that matters for markets is that there will be more volatility in areas that are heavily dependent on government. Defense, does it get funded at what level, who, how? Same with healthcare. So it's a different deal.
Amid all these discussions about cuts to the deficit, is there any discussion about Social Security, about Medicare, about Medicaid, about the major costs that the nation is incurring?
No, not at all. Not even close.
So what does that say to you in terms of the theater?
There's no political will or courage to do that. I'm sorry, Lisa.
So no, but Terry, I mean, what does that say to you about how much this is theater and how much this is ideology and how much this is sort of a de facto necessity of a shutdown, regardless of any kind of agreements or technical anything?
I increasingly have to restrain myself from saying kabuki theater over and over because it is. This is self-created theater. Anytime you have a bunch of people who claim to be seriously concerned, Democrats, Republicans, House, Senate, whoever, seriously concerned about the direction of the country, and want their policy priorities put in place, and yet for 7 weeks don't do anything about it, that will tell you everything you need to know about the seriousness of those people and their desire to actually get something fundamental done.
Who is this kabuki theater for, and is it working?
It's for the bases of the parties. It's for those who fundraise off of outrage, whether it be on the left or the right. And does it work? It works in the sense that outrage gets a response in righteous anger and more campaign contributions. Does it work in the sense that they're any closer to solving the problems they claim to care about? No, it doesn't.
Terry, I want to go back to brass tacks, which is way out in November, the first Tuesday of November. President Biden won over 80 million votes in the last election. No one's had more votes in an election ever than the loser, Donald Trump. That tells me it's massively about turnout. Can you gauge now in any way, shape, or form the emotion of turnout in October of next year?
My instinct on this is that the outrage turnout is driven by outrage and driven by kind of galvanized on issues. My sense is that those who are outraged on the Republican/right side probably have more energy than the folks that are outraged on the left. Not only that, but you point to Biden's vote totals. Massive amount of those overvotes are California and New York, places where it's pretty much just running up the score. It's a world where the president won 4 states by a combined, roughly 100,000 or less, and so that turnout's going to make all the difference. I think the outrage that comes from a lack of movement in Washington just stokes things a little bit more.
Terry Haynes, thank you so much. With Pangea Policy, again, Balance of Power tonight across Bloomberg Television and Bloomberg Radio. Every once in a while, a headline comes across and you stop. It's a Bramo quality headline, to say the least. There it is, just in Technicolor.
Well, basically, you can see 10-year, 30-year yields both rising to post-crisis highs of the cycle. We were just talking about the 4.5% 10-year Treasury yield. You could see that 30-year yield, 4.6%. These are round numbers. Up less has been the 2-year yield. We have seen a plateauing out, which really highlights that flattening of the curve that Katie Kaminsky was talking about, Tom.
Please stay with us for continued market coverage here. It's not overt yet. It's not demonstrative, but boy, is there a tight correlation across equities, bonds, currencies, commodities. Dollar strength comes up here with a vengeance. The real yield 2.12% again. And, I guess, Lisa, more than anything, I've got to go to the currency market. I think you're going to get sterling. You're going to get a 121 handle in sterling. Pharaoh's never going to come back.
Dollar strength.
I'm here. I'm in London.
Has been the story. Yeah, although he's got to get paid in dollars to really make it work.
Well, that's why he's just living large there west of Mayfair. Laura Rahm next. Perfectly timed. Stay with us.
This was, you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Secretary of State, Senator, First Lady, with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Bloomberg surveillance on radio and television and market check in order. It's pretty much, Bramall predicted this to be blunt. We're up a stick on the VIX, 18.19 with tape deterioration. It's not a big deterioration, but there's a weight to the tape this morning that's extraordinary. Futures at negative 13. Again, the VIX 18.19. And Lisa, history being made in the bond market, higher yields.
The idea of 10-year and 30-year treasuries both crossing round numbers, 4.5 on the 10-year, 4.6 on the 30-year. Looking out to some of the highest yields going back to 2011 for the 30-year and well before that, 2006 for the 10-year. At what point do we reach some sort of capitulation, Tom? That to me is sort of the key question.
Yeah.
Are we reaching a point where people are saying this is sustainable, or are people throwing in the towel on being bond bulls, which a lot of people said they've been?
Well, it's going to be interesting to see. And the tandem that we had at Katie Kaminsky and Earl Davis here, Alpha Simplex and BMO Capital Markets, the basic idea that both of them from two different worlds are saying, okay, what happens if we get price down, yield up? Besides an 8% mortgage rate, I think it's a joint study on a Monday.
And at what point does some of the froth start to come off the risk asset sphere, right?
Yeah.
This is sort of the interesting other side, is that people are saying maybe we can live here, right? This is okay. This is sustainable. Okay. Well, if that's the case, how much strength does there have to be given the quintuple threat that we've been talking about?
We were jetting back, living lazy, living large, and our team worked through the weekend on market coverage. We'll get to Laura Ram here in a moment. Just a perfect moment to speak to Ms. Ram, Chief U.S. Economist, FS Investments on Foreign Exchange. But first, we have to go to head of our Surveillance Shutdown Central. Michael McKee joins us, Bloomberg International Economics and Shutdown Correspondent this morning. I know it's funny, but it's not. Give us one vignette of the pain that will be inflicted upon this government shutdown.
Oh, there are so many, but I think one easy thing to look at is the number of people who get furloughed who don't have any money coming in. Their kids become eligible for reduced or free meals, but there's no money for the reduced or free meals. So there's be a lot of pain and suffering, especially in lower income levels because of this. It won't be a huge macro issue unless it lasts for a long time, and I'm afraid that Terry Haynes is probably right, that this could go on for months. And if that's the case, then we have some real problems beyond just money.
And we're talking about also the idea of a data-dependent Fed at a time where data might not come at all. What data might we not get if the government shuts down, as most people actually expect as the base case?
Well, the first thing you won't get is construction spending, which is due next Monday. We have the JOLTS report next week, jobless claims, obviously, factory orders, and, of course, September payrolls, the jobs report, which is considered reasonably important to the Fed and their futures. We also wouldn't get the next month's CPI if it continues to go on, because there won't be anybody to collect the data for October.
Take us behind the closed doors, and are there people still collecting the data and just not releasing it, or are they not even collecting the data? really giving us a dark period of data vacuum at a time where data's never been more important.
Well, for some of the numbers, data comes in. The establishment survey is a survey of companies, and they send their data in, but somebody has to collate that. There may be a certain number of people who are brought in to work without pay to put things like that together, but in previous shutdowns, we have not had the government release data. The last one we had, if you remember back that far in 2019 when it was finally ended, we went several months without getting data until they could catch up to everything. So if you're the Fed trying to make policy November 1st or December 13th, you may have a real problem.
In the 142 papers on your desk that amazingly folks are read, I should say that, different than me. On the 142 papers on your desk, is there a political tinge to a shutdown? Are Democrats hurt harder than Republicans or vice versa?
Well, historically, it's been Republicans who've taken the blame, even when there was once a shutdown during the Obama administration, because the Obama administration wouldn't give in.
But what about the public? What about
the public tends to blame Republicans for it. Now, the question is, we're far enough away from an election. If this goes on for a long time and there's some lasting damage, then it might linger. But when you look at the consumer, I've gone back and looked at the consumer sentiment numbers. People don't even notice. It doesn't register. It doesn't show up in consumer sentiment, and then it certainly doesn't show up really in spending.
Surveillance Shutdown Central there, Michael McKeon, he'll be giving us a lot of perspective on this into a potential shutdown. Laura Ram joins right now, Chief U.S. Economist at FS Investments. A timely interview, Lisa, to say the least.
Especially given the fact that we might be heading into a vacuum of information. Laura, you were, I'm sure, listening to Michael McKee talking about what we may not get going into a dark period and a data-dependent Federal Reserve making crucial decisions. How important is that aspect of some sort of shutdown that is underappreciated in markets?
I think it's very important because you still have a real disconnect between what the Fed says they want to do and what markets are expecting. And the only way to really close that gap is for the Fed to really, come in and jawbone markets, and they would ostensibly use the data to do that. If they don't have the data to back it up, and listen, the economy has been very strong. The data has looked really solid, and I think the Fed has absolutely used that as a foundation to try to push markets towards the fact that we both need, maybe another rate hike, but also are not going to be cutting, and all of that is data-based. So to your point, it really makes it hard for them to close the gap between what I think they've signaled to us as policy, like in the dot plots, in the economic projections, and what markets are pricing.
There's a real tension right now. A number of guests have come on the show this morning and said that they expect yields to stay here for a longer period of time. This is the new reality, and they think that this economy can continue to keep going regardless of the fact that it is that much more expensive and discretionary income is going to a lot more basic assets around the house. Do you agree with that, or do you think that it's getting to the point where these yields are unsustainable?
So it's a two-part answer, because I don't think that these yields are unsustainable. And in fact, if you look at, I think everybody's now looking at the mid-90s as a guidepost, the one time the Fed was able to raise rates and not cause a recession. The Fed held the Fed funds rate in restrictive territory for 3 years, and long-term interest rates were quite a bit higher than they are today. I think that flattening, this sort of bearish steepening where bonds are sold off across the curve, is probably going to continue. I think there's a huge disconnect, which I think people aren't talking about enough, between equities expecting the economy to be strong and revising earnings estimates up for next year. I mean, right now, consensus earnings estimates are up 10, 15% next year.
Yeah.
If you just look at the broadest base, that is really implies significant economic acceleration from a level where we're already fairly strong. You can't get that without the Fed not only really keeping rates where they are, but even considering rate hikes into 2024. That's not my forecast. I think the economy is going to be slower next year and that their earnings estimates are too optimistic. But this is a big disconnect that I think we really aren't shining a light on.
Laura, how close are we? And I don't mean plaza accords. Someone dismissed that earlier this morning. But Laura, how close are we to where the stochastic history of strong dollar adjusts Fed policy, where Powell is overcome by strong dollar? like on DXY 105 tending to 106. Are we getting it close to where those dynamics take over Fed decision making?
I don't think we're there yet, Tom, and I do think the dollar is going to continue to strengthen significantly into year end. I think that the rate of change is really important when you think about the Fed, in taking that on as part of their decision. And I think when the Fed looks at the landscape today, they're seeing shadow tightening, I call it, coming from a lot of places. The higher oil prices, the dollar, the real interest rate dynamic. I don't think that they're displeased with that. I think this is kind of their bargain with markets. Like, we won't give you a lot of rate hikes if you will allow this tightening to kind of continue to bubble up in the background and squeeze demand over the longer term. I think if it moves really fast, that's when you start to see the Fed take this into place. And listen, you and I have been here before. I do not put it past FX to be the market that really breaks out. It is highly volatile when you least expect it. And I don't put it past FX, especially in the emerging markets, to really come out of left field and cause a broader financial market disruption.
I was talking to John, Laura. He's stuck in the United Kingdom. He's working on a project over there. And I was just telling him that it was amazing to see the autumnal leaves and the glow of October within the hurricane or whatever we're having in New York. The sun came out, a week ago?
Yeah, it's
something
been a long
like
time.
that.
Last time we were here.
Laura, it's a time of season where we go into the seasonal quarter and retail becomes important. What's the American consumer going to do?
Right now, it is fascinating that given how strong the economy is and given how much people are spending, consumer sentiment is still dragging. I really chalk that up to inflation. I think the Fed is patting themselves on the back that inflation is down to 3.5%, 4%. For the households, the sticker shock that they're still experiencing is a very clear and present pain point. So I think from here, the consumer slows. The student loan, starting up again, those student loan payments are a marginal impact to me. It's not going to be the main driver. But despite the fact that households really, I think, have a solid foundation, it gets slower from here because, frankly, this level of spending right now is unsustainable.
Do you think that means hard landing? Does that mean recession, or does that just mean a slowing down and a sort of disinflating of the economic trajectory?
I've been in camp recession, thinking that the Fed, given the dramatic and aggressive nature of this Fed rate hike, is going to cause the economy to contract sometime. I originally had said the beginning of next year. Obviously, right now, the way things are going, that seems like it's going to be pushed out. I think all the reasons why I was thinking this would be a mild recession may be the reason why we just get a slowdown and not a full-on contraction. That list includes scarcity of labor. It includes the CHIPS Act. It includes just broader general underinvestment in our economy that we're playing catch up on now. These were reasons why I had sort of said, recession, but more mild, may keep us on the line of a soft landing. But either way, I think, when I look at the bond market, it's pricing in a slowdown. When I look at the equity market, it's not. And, listen, the equity market's a historically terrible indicator of the economic cycle. I think we all need to acknowledge that. Just because equities are up, and they're not recently up, but just because they're up doesn't mean that we're out of the woods on the economic cycle.
Laura Raim, thank you so much. FS Investments there, beautifully linking in foreign exchange with DXY rounded up to 106, seeing strong dollar this morning. The markets are interesting. It's not an abrupt move, but nevertheless, a VIX over 18, and the Standard & Poor's 500 down 0.3%.
Coming up, we're going to be speaking with former FDIC Chair Sheila Bair, and it comes at a time where we're looking at a new rate regime. And my key question to her is just, can we survive this? What does this do to the banks? Did the whole banking crisis of earlier this year mean anything, or did it just show the resilience of an economy and a banking system that can, to use your phrase, adapt and adjust?
Hugely well-timed. Out of the academics of Northampton and Amherst, Massachusetts, and on to some real public service for the country during, to say the least, some trying times. And to stagger from Robert McTeer in the 80s to Sheila Bair from, the recent times, whither are banks? That's not a small It's off my radar. I'm guilty of this. But there they are. It's not one and done with Silicon Valley Bank, is it?
And where do they lend, right? And we were in London last week at the credit conference that we put on, and we were talking about how a lot of these private asset managers really want to take on the role of these banks. The banks are giving it to them because they can't make a profit. So where does that put the regulatory oversight? Where does that put some of the questions around who's going to be doing lending at a time where lending is a lot more expensive?
You look at a monthly chart of the Keefe-Bruyette index, and the answer is southish. And do you come back and retest pandemic lows, which maybe was unimaginable here? In a timely conversation for Global Wall Street, Sheila Bair will join us. She's the former FDIC chair. Look for that. Futures modest deterioration. Futures at -11. The VIX out over 18, 18.09. We are on radio. We are on television for Global Wall Street. This is Bloomberg Surveillance.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
This is Bloomberg.
In general, in the globe, we are going through very challenging times in terms of macroeconomic picture. Of course, the geopolitical tensions are not helping at this stage, but I do believe that many investors still see the long-term potential of China. It's exactly how to navigate the current situation that makes our job even more important.
Over in China, Sergio Armati, the head of UBS, talking about the relationship in that nation as well as some of the fund exploration with respect to Credit Suisse and the whole assembly there. Today we've been talking about a number of different events this week, in particular having to do with the strikes, Tom, and I was noticing the divergence between the companies that are getting close to resolving the strikes and those that are really in the heart of it. And you could see that with Disney and Netflix shares both up in pre-market trading on the news that we got that there might be some sort of deal with the Writers Guild and that they're going to get some sort of moving forward with respect to Hollywood. Disney shares up about 0.5%, Netflix shares up about 1%. Stellantis on the flip side down 1.3% as those strikes expand.
Well, the
today.
strikes expand, but I don't know how to conflate LA strikes of a really strange Hollywood system with people making $60,000 a year on a assembly line in Detroit. people conflate the two together, and I'm just not sure that's correct.
There is a way to conflate them that I think is really important, which is technological changes have kind of trumped all to sort of create a new urgency. Artificial intelligence very much in the forefront of the discussion over in Hollywood. This question also of streaming and how you get royalties, how you get fees. And over in the auto manufacturing side, the question of electric vehicles, new production facilities. These are the new technologies creating the frameworks of a lot of angst, how you ensure job security in a world that's moving really quickly.
It's going to be, to me, it's going to be absolutely fascinating. I don't see any other way about it. What do you make of this market this morning? To me, it's just extraordinary. I got a 2.11 on a real yield. And, there's some tension out there with that headline we saw earlier on higher yields, cycle high, hearkening back to the time of bear.
The question is, can we live with yields like this? And can we move with them moving this quickly? Can we live with this idea of a fast-moving freight train of people moving away from being bond bulls and going into being bond bears? And the answer is not clear, right? We've heard from guests who have different opinions. We just heard from Laura Rahm, who is talking about how, no, it doesn't seem sustainable. Others saying, yes, it is. And here we are at a time where we might be going into a blackout period for data. So we can't really understand the ramifications from the economic standpoint in real time.
In combat, sometimes people are called. Sheila Bair was of Kansas and the University of Massachusetts Amherst, a nodding acquaintance with Senator Dole of Kansas, and that began her public service to the nation. And then she was selected in 2006 for the boring job of being FDIC chair in the banking system. This extended out to a not-so-boring 2007, 8, 9. She survived to 2011. She is the author of 2 new children's books. They're out October 1, Money Wizards. I didn't read that in 2007. But Daisy Bubble about market speculation, that one I read cover to cover. Sheila Bair joins us this morning here in another time and place from 2007. Sheila, if I'd read Daisy Bubble on that August afternoon in 2007, where LIBOR OIS went out 4 standard deviations, what would you have written about to sprightly 7-year-olds?
Well, to you, I would have said you should have read Daisy Bubble probably in 2002, 2003 when the housing bubble was starting off. I would say to young people, as I say in the book, and there's some back matter in the book that talks a bit about the housing bubble and the more recent crypto bubble, that speculation is dangerous. Herd behavior is dangerous. How many times have we told our kids, don't do something just because everybody else is? And bubbly markets are a lot about that. Gen Z has a word for it, fear of missing out, FOMO,
right.
Get in, everybody else is getting in. And then the bubble pops, usually by the smart money selling.
You were
for the average investor, they should stay away, kids or adults.
You were a saint with accolade from Democrats and Republicans alike about a patient approach in times of crisis. We had a banking crisis a number of months ago, and we're already back to fear of missing out. That crisis is over. Is it?
Well, I hope the crisis is over. As I wrote at the time, I thought regulators did overreact. I'm not sure 3 mid-sized regional banks failing was a crisis. They treated it as such. The rest is history. But I think more banks are going to fail. I think if properly managed, it will not be a crisis. Banks do fail. The reality is the very largest banks are too big to fail, notwithstanding our best efforts to try to kill that doctrine. And the smaller banks are heavily reliant on insured deposits, which are stickier than the regional banks are suffering they rely more on uninsured deposits where they're seeing outflows. But with the inverted yield curve, been inverted for over a year now, if your deposit funding costs are going higher than your long-term loan rates, you got a big problem. And with CRE out there, I can only assume there will be more bank failures. I don't think it will be a lot. I think the FDIC and other government agencies have the tools to deal with it. Yes, I do. The next 12 to 18 months, I think there will be more bank failures.
Let's put together some of the ideas that you're talking about, the concept of excesses, bubbles, people chasing the FOMO trades, which we saw in mass over the past 10 years. And then this idea of a rate regime that harkens back to when you were FDIC chair for the first time. How much have we seen the excess bubbles kind of worked through the system, or are they yet to be worked through the system? In other words, are we still going to see that reckoning that people said would happen back in 2007, or back in, I should say, 2013?
Yeah, so I do think there's some bubbles left that need to be popped. Hopefully, it'll be gradual. You're seeing valuations come down. Commercial real estate still inflated, but you're seeing some of that start to correct. The stock market, I think it's probably got some ways to go down again. So it's just a matter of whether we can, the expectations are right. People understand what's going on, and we can manage it. And but yeah, I think there's still many shoes left to drop. And of course, just in terms of credit markets and distress in debt refinancings, we've got a lot of corporate debt refinancing over the next couple of years. A lot of that CRE debt is expiring, needs to be refinanced. So these are shoes that are left to drop, which is why, even though I'm an inflation hawk, I am so glad that the Fed has been hitting pause. I think they were going too fast. There's only so much of this transition to higher rates that the economy can absorb without triggering very broader problems in the financial sector and the overall economy.
And Sheila, you've been saying that you think that ultimately it's good to have the discipline that higher yields do invoke. But you think it's been too fast. Do you think that ensures something of a recession that people are perhaps overlooking?
Well, I think if you go too fast, then you do trigger a crisis, and then the Fed has to do U-turn and ratchet back down, and you start this whole problem all over again. There's not much research that shows low rates boost, sustainable economic growth. There's a lot of research that shows this harms productivity. Larger companies benefit much more than smaller ones. Actually, high rates help the smaller businesses because they get their credit from banks. It's easier to lend for banks if the rates are higher. And even though some pain in the banking system now, if we can transition into a more normalized higher rate environment, overall, I think that will make the traditional banking system, the banks that take deposits and make loans, stronger.
Right.
So, I've been on a lot of corporate boards since leaving. My sense is that they don't borrow to invest in productivity. I mean, that comes out of operating income. They want to do that anyway. So if you just make it cheaper to borrow, that goes into M&A activity, might go into buybacks. There's really no evidence that the ability to borrow cheaply by large companies goes into productivity. And I think the low productivity we've had since this very accommodative policy stance has taken hold shows that.
Sheila, thank you so much. Sheila Bair, the former president, Washington College of Maryland, former FDIC chair as well this morning. We haven't talked enough about it. It's been percolating there, but you get out a technical chart of the Keefe, Bruyette, and Woods Index, and I'm sorry, it's not pretty. There's just no other way to put it.
I mean, people say banking crisis averted, but not for people who own those shares and not necessarily in terms of valuations. But what Sheila was just saying there is at a certain point, there needs to be more of a reckoning that hasn't really come to the fore. And a lot of people have been pointing to commercial real estate recently, including some pretty big bank executives. So again, there's been a lot of threat, but it hasn't come to the fore yet, except for in pockets like the shares of some of these banks.
Yeah, we're going to have to see, to say the least. Coming up here on Bloomberg Radio, Paul Sweeney and I, Phil Camparelli, JP Morgan Asset Management. On the Open, young Pharaoh is in London on assignment on TV. It's the Bitcoin Open. We'll be doing that with Matt Miller sitting in for Mr. Pharaoh. On Bitcoin, Michael Zezas, George Concalves, Sarah Hunt. This is Bloomberg. Stay with us.
On the next episode of Hello World, I head to Los Angeles, meet some robots, and eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
The thing that strikes me about these technologies in particular is that the brain is that last fortress, and our inner self is the thing that defines us. And yet we're at this turning point where that inner space could become part of some business's private enclave or some government's Orwellian fantasy.
So I worry about this deeply. And I worry that that final private space, the space that I think is so critical both for self-awareness and for resilience, for the ability to know truth from fiction, the emotional self-reflection and cultivation, is at risk of brain transparency.
You mean the idea that we can just be seen through entirely?
Essentially, right? I think the way we define intimacy in a lot of relationships is by choosing what emotions, what thoughts, what secrets we want to share with another person. And if all of that can be revealed by decoding your brain activity, if other people can have access to it, whether it's your partner who says, no, I want you to prove that you're in love with me, or a lie detection test by the government, or the way you authenticate yourself at borders is through brain transparency, I think this final space of mental reprieve is at risk.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Good morning from New York City. For our viewers worldwide, I'm Matt Miller in for Jonathan Farrow. Ahead of a risk-off session on this Monday, we have equity index futures extending losses on concern about high for longer. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Traders bracing for a busy week of Fed speakers. The dollar hits its highest level since March as higher for longer fears continue to keep markets on edge. We begin with the big issue, and that is Treasury yields taking center stage once again. We saw a jump last week. Let's see what happens now.
Yields are rising.
The higher real yield story.
Why are bond yields rising?
So much of it's been driven by the recent stronger economic growth.
Economic growth in the third quarter has picked up.
Inflation indicators, whether you look at owner equivalent rents or oil prices, are starting to tick back to uncomfortable levels.
We're in an environment where the Fed is leaning towards potentially another hike.
Expectations for the next Fed rate cut have been pushed out into the future.
There's an acute awareness and concern on fiscal right now.
You've got a substantial amount of fiscal spending.
That's something that may actually even pressure Treasury yields modestly higher.
We're still not sure that we are at peak yet.
There's so much uncertainty on the path for Treasury yields.
Bond yields being higher, a Fed that's higher for longer is going to continuously put pressure on just the broader markets.
Joining us now, Morgan Stanley's Mike Zizas and George Goncalves from MUFG. Let me start by asking you, George, what you think about this new resurgence in yields. I mean, didn't we understand last week or in the past 2 years that the Fed was aiming for higher rates? And don't we know that they're going to hold it there until inflation is back down to 2%?
Look, the bond market's been skeptical, but I think they're finally starting to listen to the Fed. And this, to me, is not really bond vigilantes really returning, but it's more about the bond bulls throwing in the towel. We've had a deeply inverted curve, a curve where historically would be suggesting a recession's coming soon, which I still think that's the case. But nonetheless, while we're waiting, the bond market's respecting the Fed, and rates are normalizing from the belly of the curve. And we've been saying since really the midsummer that post-debt ceiling, we're going to have this supply deluge, and then the Fed staying on hold for longer. It was going to normalize the belly of the curve, and that's what hurts the most. It's the revenge of the bear steepener.
So I guess one concern, Michael, is that, inflation could be resurgent, and then the Fed has to continue, even hike again. how do you see prices coming under control?
Yeah, well, actually, we're pretty constructive on the idea that there's going to be a lot of pressures that push inflation lower into the fourth quarter. And it's not just some of the ones that are grabbing headlines, like the potential for a government shutdown to crimp demand or UAW strike. There's also just a natural give back that our economists have been flagging from consumption behavior over the summer around special events that isn't going to be there. And then on top of that, we've got student loan repayments starting again. We think you combine all of that, that's as much as taking down PCE by 1.3, 1.4%. Those other factors we talked about could easily drive GDP to a 0.1% quarter print. And we think there's a pretty meaningful risk of getting a negative payroll print. Now, none of this means there has to be a recession. We're still in the soft landing camp. Okay, but all of that suggests that what the Treasury market's pricing about the future Fed path might become a little more dovish after you start seeing some of this data. And that's the type of thing that should tell you that yield increases from here should be pretty limited. That should be pretty positive for bonds overall.
On the other hand, we have a wave of risks, I think, including the student debt repayments coming back online. Morgan Stanley's Mike Wilson sees consumer stocks losing their luster, writing, quote, "The technical breadth set up for consumer stocks looks particularly challenged. Price action is picking up on slowing consumer spend, student loan payments resuming, rising delinquencies in certain household cohorts, higher gas prices, and weakening data in the housing sector." George, you know, this list goes on, and I think a lot of people have been repeating it over the past couple of weeks. What do you think about the headwinds for the U.S. consumer?
Look, I think that's a pretty comprehensive list, and I generally agree with what was said before. The problem is the Fed is keying off of lag data, and they're not minding their own lags of all these hikes that they put in place in a very quick and aggressive hiking cycle. The lags of all these hikes are going to hit on top of all those kind of economic headwinds. But as we heard from Chair Powell last week, you know, forecasting the future is hard to do. So I think they're going to just wait until something breaks either in the economy or markets or both.
Maybe something breaks again, right? Because we've already had the problem with the banks. Let's get to, though, the data, because a lot is coming up this week. A lot of Fed speak, certainly, and some economic data. Bloomberg's Mike McKee joins us now for a preview. Michael?
Well, Matt, we could be talking about something that breaks, and that's the government. We'll talk about that in just a second. But we do have a busy week of data ahead, although not all of it is that important. Here's what really is going to matter, and I would point your eyes to Thursday when Jay Powell does a town hall with teachers. They don't get paid a lot of money, so I would imagine they will be questioning him about interest rates and inflation. Jobless claims may be that day. If the UAW strike distorts the numbers, they won't have a lot of information for the Fed and those who are thinking about trading on the Fed. Income and spending and PCE on Friday is the other big number because we get the Fed's favorite inflation numbers. They're expected to be better, but not a whole lot. And then Sunday, maybe data ends if the government shuts down. We have a lot of Fed speak as well this week. Kashkari, Bowman, Goolsbee, Cook, Barkin, and Williams all joining Jay Powell. We'll get an idea of how serious all of them are about raising rates one more time. They put it in their dot plot, but are they going to follow through? Whether they follow through may depend on the government shutdown, though. You put the calendar up for next week, and you see there's already a lot that we are not going to get information on. If the government shuts down, we won't get construction spending data, JOLTS, factory orders, the trade balance, jobless claims, and here's the big one, September payrolls. So I guess kind of the question for your guest, Matt, is if we don't get the payrolls report, how are Treasuries going to
Mike Zizas, what do you? George made an interesting point that maybe we'd be better without the data in terms of the stock market, in terms of rates. I guess if the government shutdowns for too long, it's almost perverse, but people buy treasuries, right?
Implication is that it's going to dampen growth, right? So to your initial question of do investors care about this, they do. It's got to be one of the most frequently asked questions we've been getting over the last 2 weeks. But I think the power here is less in a potential for a long shutdown crimping GDP, but rather in it calling attention to all the other data downdraft that we've been talking about into the fourth quarter. All that together, and the shutdown is just sort of emblematic of it, would put pressure to at least limit yields rising further. And so we think investors are supposed to look at that and look at bonds more favorably instead of the way they've probably been looking at it over the past couple of months, which is, if I bought a bond, I lost some money on a total return basis. But over a 12-month basis, if you're buying them here, given the economic downdraft in the fourth quarter, we think you're going to be in a pretty good position to capture some really solid total returns.
It does seem like you should just back up the truck at these levels because even if you don't get the capital appreciation, which I assume you're expecting, you still get a decent return. What are the biggest risks, Mike, to your expectation of, I guess, soft landing and inflation coming back down to target? What are the biggest concerns for you?
Yeah, I mean, listen, obviously, if the fourth quarter data doesn't play out the way we think it would, then what's currently priced into the Fed's path is probably going to be pretty persistent, and that could push yields higher. Right now, for bond investors, that might mean some more short-term pain. But even if you think the Fed maybe isn't at the end of its hiking cycle yet, but will be within the next 12 months, and there's only perhaps a few more rate hikes on the table, we still think this is a pretty good entry point. You might have some short-term pain on a total return basis, but we think it's completely reasonable to expect high-grade corporate bonds, U.S. Treasuries, to kind of push close to double-digit total returns over the next 12 months.
George, what do you think? I mean, what's your outlook for 12 months from now, and what are the biggest risks to that?
Look, I mean, maybe we could zoom in on the next 12 days versus 12 months. Like, I think Mike is probably right on the medium term that we're trying to make a topping process here in rates. We just don't know if it goes any further. And this has been a very technical market, and it becomes illiquid very quickly. And so if we have this kind of gap higher, might be a great buying opportunity, but not many people will show up to buy the bond market, perhaps, if we have this big sell-off, because everyone's going to be scared after seeing what just took place. Meanwhile, you kind of look forward down the road, the rates should be heading lower given that sort of economic outlook that I think we both share here. But I do think that these technical factors, as well as the wild card around what happens overseas with if there's a need for foreign intervention, if selling of treasuries, that still kind of hangs over the market's head as well. So I do think that the risk is to one last kind of rise in rates, and then that really will start to crack the risk markets and then get money back into fixed income.
Mike, I know you're the head of fixed income research, but what do you think about the equity indexes here? We've had almost a correction in terms of the NASDAQ, is down 8%, let's say, since the end of July, beginning of August. The Russell 2000 is down more like 11%. It does seem like equity investors are a little worried.
Yeah, I mean, listen, you had a quote from my colleague Mike Wilson earlier, and I think that says it all, right? If you see the economy weakening, both in growth terms and in inflation terms, then that's not a great consumption backdrop. It's emblematic of not a great consumption backdrop. And in a market where the multiples expanded substantially, you should expect some give back. So it's one of the reasons that we've got more confidence in bonds delivering solid returns over the next 12 months. And we think it's going to be a tougher road for equities.
Mike, great to have you with us. Mike Zizas there talking to us from Morgan Stanley, where he's head of fixed income research, and George Goncalves from MUFG. Also great speaking with you. Thanks so much, gentlemen, for joining us. Coming up, the morning calls, and then later we're going to talk with Sarah Hunt of Alpine Saxon Woods, joining us around the opening bell with her outlook for what assets do in this higher for longer environment. This is Bloomberg.
there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Welcome back to Bloomberg The Open. I'm Matt Miller in for John Farrow. Let's get to the morning calls. First up, Jefferies downgrading Nike to a hold, pointing to slower consumer spending and macroeconomic headwinds out of China. China, really a big story today with, it looks like another blow up, or I guess continued blow up in property. Next up, JP Morgan upgrading Dow to overweight, highlighting the stock's reasonable valuation and strong balance sheet. This is formerly Dow Chemical, now Dow Incorporated. Finally, Guggenheim upgrading Microsoft to neutral, saying that generative AI narrative is too positive a force to contend with. You can see Microsoft shares down in the pre-markets, not having much effect on that as the entire market seems a little bit risk-off. You saw equity index futures, they are down. We see bond yields rising again, so there's a lot for the equity market to contend with today. Coming up, we're going to talk about that. Really, the main issue is the higher for longer, or high for longer, as some prefer to say, environment. Could mean good things for the energy sector. That's the view from Sarah Hunt of Alpine Saxon Woods. That conversation next up. At the opening bell, this is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
It's got about 25 seconds to go until the start of trading on Wall Street. You can see that equity index futures are down, and the problem is investors are actually starting to believe the Federal Reserve when they say we're going to keep rates high for a fairly long amount of time. There you hear the opening bells. You can see the New York Stock Exchange here and the NASDAQ there. The NASDAQ, by the way, down about 11% since the end of July. So I think we're in solid correction territory for that index. Take a look at, the Russell 2000. The Russell 2000 down 11% since the end of July. The NASDAQ only down 8%. Let's switch up the boards and take a look at the Bloomberg Dollar Index, because I think that's one of the most interesting assets this morning. Right now at 1262, so the highest level we've seen since March, which feels like so long ago. The 10-year yield climbing ever higher, now at 452.73, approaching levels that we haven't seen again since 2007. NYMEX crude holding in that $90 range. West Texas Intermediate trading for $90.31, and we're seeing Brent still maintaining a level under $95 a barrel, but very close to that. And that's a concern, I think, for the equity market. One stock to watch, speaking of equities, at the open is Warner Brothers. Film and entertainment stocks have gotten a boost as striking screenwriters reach a tentative new labor agreement with Hollywood studios, including Disney and Netflix. Bloomberg's Abigail Doolittle joins us for more with what the end of the strike could mean for these stocks. Abby?
Indeed, Matt. We do have a potential resolution here to this very bitter months-long strike with Hollywood. The Writers Guild of America, representing more than 11,000 screenwriters, on Sunday night, last night, said that they had reached a tentative deal on a new contract with some of those big entertainment companies. It's interesting to see them a little bit mixed right now, suggesting that investors are maybe they want more, which we'll be talking about in a moment. But in the coming days, even as soon as tomorrow, we could have a vote with the Guild members voting on whether to accept the deal. They basically got much of what they wanted, had demanded, including increases in compensation for streaming content, concessions from studios on minimum staffing on some of the television shows. The Writers Guild, their committee, their comments really bubbling, saying this deal is exceptional. On the other hand, the entertainment studios basically acknowledging that a tentative deal has been struck. Apparently, language around AI is the one sticking point. But I think the reason that we don't have these stocks really flying higher, Netflix is up more than 1%. SAG is still on strike, of course. This is hopeful that maybe the actors will also find some kind of a deal. But right now, if this deal for the Writers Guild is in fact struck, it means only the late night shows will be restarting because they don't have actors. So stay tuned, but some optimism here that, again, this bitter feud in Hollywood, that maybe it's coming to an end.
All right, so could see the potential end of one or even two strikes. Abigail, thanks very much for that. Abigail Doolittle looking at the reaction in those stocks. Let's turn to tech, though, right now. Big story on Amazon today. It's going to spend as much as $4 billion to buy a minority stake in generative AI startup Anthropic. The CEO, Andy Jassy, writing, quote, "We have tremendous respect for Anthropic's team and believe we can help improve customer experiences through our deeper collaboration. The idea is Anthropic would use Amazon's cloud services and chips." And of course, Amazon already promotes this business. Bloomberg's Ed Ludlow joining us now from San Francisco with more on this. I think partnership is probably a good word, Ed.
Yeah, it's interesting to understand the mechanics of it. As you said, Anthropic will migrate its software into the AWS cloud, but also make use of Amazon's proprietary silicon, the AI accelerator Trainium on the training side and the AI accelerator Inferentia on the inference side to build its next generation of large language models. 4 billion up to 4 billion. I think what I'm hearing in the first instance is it's more like 1.25 billion, and we go from there upwards. On the semiconductor side, it's interesting because it is a vote of confidence in AWS's proprietary silicon. We've talked so much about NVIDIA and the H100 AI accelerator as being the kind of benchmark for compute in the building of large language models. But the other way of looking at it is this just Amazon paying an AI startup to use its chips, kind of a reverse revenue situation, which I also find interesting. Claude, which is Anthropic's foundation model, was already available on Bedrock, and Bedrock is basically Amazon's open source platform where third parties can either build their own large language models or use the template for those that already exist. And later on in the show on Bloomberg Technology, AWS CEO Adam Selipsky will be on the program, and there are a number of questions to ask about why Amazon did this. You know, they've been flexing a lot their own competence in the field of generative AI and also building of foundation models, but they're making a sizable investment here. One quick point, Matt, Google is already an investor in Anthropic and also holds a minority stake. So there's an element of competition and frenemies here, which I quite like.
Well, first of all, I love the name Claude. That's fantastic. Did you say you're going to have who's going to be on your program? AWS boss?
Yeah, the AWS CEO Adam Selipsky is going to be on the program later today, and I just have so many questions about how this is going to work in practice. Like, why use someone else's technology versus build your own? You know, Amazon usually does it on its own, but if they go the full 9 yards and do invest $4 billion here, raises the question why they didn't just buy Anthropic outright earlier in the year when it was at a much lower valuation.
Yeah, fascinating. I'll be tuned in to watch that for sure. I mean, AWS, obviously the biggest cloud operator in the world. Plus, as you point out, they make their own chips, and typically they do all of their own work. So this investment is a really interesting deal. Adam Selipsky joins Ed Ludlow and Caroline Hyde at noon today or thereabouts. Definitely tune into Bloomberg Tech for that. Now, from new tech to old, let's talk about HP. Remember Hewlett-Packard? Those shares under pressure as billionaire investor Warren Buffett continues trimming his stake in the computer and printer maker, selling 129 million shares according to the latest SEC filing. Bloomberg's Katie Greifeld joins us now with more on HP. Katie?
Hey, Matt. Yeah, Berkshire Hathaway unloading HP shares yet again this month. Shares currently flip-flopping at the moment, slightly higher right now. They were down as much as 4% in the pre-market after Berkshire disclosed in a filing that share sale. And that sale took place over 3 transactions between the 20th and the 22nd. And it follows Berkshire's earlier sale of about 160 million shares just a week or two ago. Now, rewind. Remember that Berkshire began building up this stake in the PC maker last spring. And looking at the filings, it looks like Berkshire may be rethinking that position now. And remember, we got HP's latest round of earnings late last month. Revenue dropped by nearly 10%. That ties back to China. And HP also lowered its full year profit forecast. So you add it all together, it's been a painful stretch for HP. Of course, it's still about unchanged on the year, maybe down about 1% or so, but shares have fallen more than 20% since just mid-July, Matt.
All right, Katie, thanks very much for that. Katie Greifeld looking at HPQ for us. Let's turn back to now the higher for longer narrative. Sarah Hunt of Alpine Saxon Woods weighing in on the market impact, writing, quote, just as all have settled in for a nice soft landing, it looks like some of the tailwinds may be ebbing. The market is starting to absorb the higher for longer message that, to be fair, the Fed has been singing all along. And that realization is not going gently for equities. Sarah, I'm pleased to say, joins us now on a day when it looks like we're going to see more equity index drops. The NASDAQ, as I mentioned earlier, is about 8% off the highs we saw in July. The Russell 2000 is down 11% from the end of July. So it's weird, Sarah, that we're talking about, and everyone seems to agree that a soft landing is coming, but we're getting these recession warnings from the stock market. What's up?
Well, you've got a combination of factors going on, right? I mean, first of all, we were going to have a big recession. It was going to happen early this year. Then it was going to be shifted to the second half of this year. Then it wasn't going to be a recession at all, but the Fed got everything just right, and it was going to be a soft landing. I think it keeps evolving as we keep seeing events overtake what the themes are in the marketplace. And I think right now, I mean, higher for longer, when you really are just going back to 2007 levels, as you mentioned earlier, the recency bias that we all have for low interest rates, we should be reminded that that's not the norm historically speaking. So I think that there's really a catch up that has to happen here because bonds have been looking at one thing and equities have been looking at another, and they haven't really been aligned.
Is the Fed guilty of, leaning on this recency bias? I noticed that on Wednesday they said rates are going to get back down to 3.9% by the end of 25, 2.9% by the end of 26. Now, I realize forecasting that far away from an organization that has a pretty poor record of forecasting isn't so key, but why do we feel the need to push rates down? I mean, the average over the past 50 years has to be closer to 5, right?
The average is closer to 5, but you have to look at how indebted governments are, right? So if you're looking out further than that and you start to see that all the governments that now have to pay those rates on government debt, it starts to become a scarier proposition. So I think part of it is, maybe we could survive at a lower rate than 5%, but I think that the zero bound and the negative numbers that we had post the financial crisis just had driven a lot of odd things to happen, and getting back to normal is not necessarily a smooth path.
Well, last week, all the bears seemed to capitulate, or the final bears. And at the same time, we're looking at a UAW strike that could stretch, right? Expand and stretch. A government shutdown that seems pretty much inevitable. And a consumer that, at least if it's stronger than it was pre-pandemic, it at least is weakening, right? With less savings and more bills coming due.
Absolutely. And I think the problem is that once you finally get to the point where the market was just going up and people were expecting it to go down. So people finally capitulate and go, okay, maybe it's not going to go down so much. And then you really start seeing these tailwinds that are somewhat the long variable lags that we've all been discussing ad infinitum since the beginning of the year. And I think that there is some real concern about weakness in the consumer. All of the things you just mentioned, higher oil prices take a bite out of everything. That number of how much more households have to spend every month is not a small number. And even if inflation comes down because of base effects, it doesn't mean that that number gets smaller immediately. And I think that there's a real spending issue coming up, and I think that that's going to impact earnings. And I think that's where we are a little bit more cautious and think that a 12%, which is consensus for the S&P next year, seems a little high to us.
Earnings, I guess, one of the things I was hearing over the weekend, Sarah, is that now earnings maybe are more important than the Fed. And I guess it could be bulls that are looking for something, right, in the face of what could be another hike and 2 fewer cuts. What's your outlook for earnings? How do you see that argument?
Well, I think it's difficult because you had this big push in inflation, right? And if that was good for earnings because top line revenues grew while margins were still strong, I don't understand how inflation coming down is not supposed to be bad for earnings. And I think that we've had this idea that somehow we can just continue to grow from where we are, and I think that's very difficult, especially if we do get some reduction in inflation. You're seeing costs go up across the board. Labor costs are going up. I mean, that's part of this whole discussion that's going on with the UAW and in Hollywood and everywhere else, and you've got higher energy and food prices. So it's hard to see how margins don't and input costs don't start to squeeze margins. So I think that makes earnings, especially the idea that they're going to grow above 10% next year, is a little trickier for us to get our hands around.
So what do you do right now? Do you buy defensive stocks? Do you buy rates? Do you start moving out the curve? What do you do if you're worried?
I think that you have to look for businesses that are going to grow, hopefully, in any environment. And you have to look at we're talking about some big thematic stuff. Like there will be an energy transition. It will take a lot longer than everybody is expecting it to. But in the interim, I think liquefied natural gas, I think the stocks that play into that, I think that they've got a good runway going forward. Energy stocks are higher, but not nearly as high as the oil price right now because people don't believe that oil prices are going to stay up here. And they may fluctuate from here, but I think you've got a longer tail investment that people are willing to look through because they're expecting a transition much quicker. We also like companies with really good balance sheets. Some of the defense stocks, I mean, speaking of defensives, have really been getting hit very hard as we had this huge push in growth stocks that pretty much obscured anybody else in the market over the last year. So I think that there are good places and there are good balance sheets, but you have to be looking at the valuation, which for a while we haven't had to do. And you also have to be thinking about what does the world look like over the next 3 to 5 years and where is investment going to go? Because that's ultimately where you want to be investing.
Sarah, great to get some time with you. Thanks so much for joining us. Sarah Hunt there, coming to us from Alpine Saxon Woods, where she is Chief Market Strategist. Coming up, President Biden heads to Detroit.
All of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike.
Our team coverage up next. This is Bloomberg.
On the next episode of Hello World, I head to Los Angeles, meet some robots, and eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
The thing that strikes me about these technologies in particular is that the brain is that last fortress, and our inner self is the thing that defines us. And yet we're at this turning point where that inner space could become part of some business's private enclave or some government's Orwellian fantasy.
So I worry about this deeply. And I worry that that final private space, the space that I think is so critical both for self-awareness and for resilience, for the ability to know truth from fiction, the emotional self-reflection and cultivation, is at risk of brain transparency.
You mean the idea that we can just be seen through entirely?
Essentially, right? I think the way we define intimacy in a lot of relationships is by choosing what emotions, what thoughts, what secrets we want to share with another person. And if all of that can be revealed by decoding your brain activity, if other people can have access to it, whether it's your partner who says, no, I want you to prove that you're in love with me, or a lie detection test by the government, or the way you authenticate yourself at borders is through brain transparency, I think this final space of mental reprieve is at risk.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
We can and will go all out if our national leadership decides the companies aren't willing to move. Stellantis and GM in particular are going to need some serious pushing. All of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike. We will be striking 38 locations across 20 states, across all 9 regions of the UAW.
That was UAW President Shawn Fain calling for an expanded strike, with General Motors and Stellantis facing walkouts at 38 more facilities after talks last week failed. President Biden heading to Michigan on Tuesday to join the picket line ahead of Donald Trump visiting on Wednesday in lieu of a GOP debate. He's going to skip that one again, too. The White House insisting on the possibility of a win-win deal.
He is proud of being the most
pro-union, pro-worker president, not only compared to the Trump administration with its anti-union policies, but really compared to any modern president. You're not going to find somebody who has more consistently stood with unions. Now, having said that, it's also the case that these auto companies can thrive in a win-win deal that does what the president has called for, which is to say that record profits should lead to record pay and record benefits for the workers who are creating all that value.
Let's get to our team coverage now. Bloomberg's Kayleigh Lyons in Washington, D.C., and David Welch, our bureau chief out of Detroit, joining us to talk about this. Kayleigh, first off, I think interesting, maybe surprising, exciting. The president is going to go and join, the picket line? He's going to stand with the unions in D.C.? I mean, this is going to be, invigorating, I guess.
Theoretically, Matt, it could be. This would really be likely the first time any president in U.S. history has gone to join striking workers at the picket line. But that is exactly what President Biden is planning to do tomorrow. He has accepted the invitation of Shawn Fain, the UAW president. Because remember, Matt, in making the announcement of the expansion of the strike on Friday, he said, "We welcome anyone who supports our cause to join us at the picket line, President of the United States included." So yes, you are going to see President Biden there tomorrow. But of course, that front runs by just one day the planned address to UAW workers from Detroit of former President Donald Trump. He will be counter-programming the second Republican primary debate on Wednesday evening, addressing the union. Both of these men really competing for the auto workers as voters and wanting their endorsement because, of course, the UAW has yet to endorse former President Biden or any other candidate for that matter in the 2024 race. Now, we understand that former President Trump is going to make a lot of his remarks about the transition to EVs, the idea that this could outsource jobs for China, for example, try to fire up union workers on that front. The EV push, of course, something that President Biden has pushed for very heavily, but he also has dubbed himself, as we just heard Secretary Buttigieg say, as the most pro-union president in U.S. history, and he's going to try to prove that tomorrow as he joins these workers on strike.
Right, and he wants the EV infrastructure to be here in America. That was pretty clear from the IRA. Let's get over to David Welch right now, and my question, David, is could there be a win-win? Because the unions, although they accepted a deal to help the companies survive post-financial crisis, they kind of put those companies in ruin with the previous deal into the financial crisis. So, could there be a win-win, or are they going to drive costs up so much that these companies aren't going to be able to make any margin?
It depends on how much. Now, first of all, labor is like 5 to 7% of the cost of a vehicle. So even if they got a 20% pay raise, that's 1% on total cost. So look, this isn't debilitating what the union wants unless they get pensions and they get retiree health care. And it doesn't look like they will. Shawn Fain hasn't talked about that in his last few addresses. He's talked more about cost of living allowances, raises, job security. So there is a way, and I think it's how it is shaping up. If you look at what Ford has agreed to so far with the union, there is a way that the workers will get very nice raise, better benefits, and it will definitely drive up costs. There's no question about that. But the companies can still remain very profitable. They'll be a high-cost producer compared to their competitors, but they will be very profitable.
What is the likelihood, David, and I've been thinking about this all weekend, that these unions for GM, Ford, and Stellantis get a great deal and it's strong enough to bring in workers that are building Hondas or BMWs or Teslas that aren't in a union?
That's the union's goal. They want to be able to, basically show up, a big victory flag here to those workers, particularly Tesla, but all of them. The problem is the union's never been good. They've never succeeded at organizing Japanese, Korean-owned plants, even German-owned plants. Has been mostly failure for them, and they made very little headway with Tesla. So they're going to need a very good contract to do it, and they're going to have to do a much better, much different kind of sales job than they have in the past.
This is one of the things that President Biden has said, Kayleigh, that unions bring up wages for all Americans, even those not in unions. This is a chance also for President Biden to show that he's energetic, to show that he, has vitality. Is he going to be able to do that?
Well, certainly he'll try because, of course, this isn't just the current U.S. president. This is someone who is seeking to be president again, running for re-election in 2024 and trying to be out there on the campaign trail, visiting all these different states as he tries to tout Bidenomics, the resurrection of the American manufacturing economy that he is trying to bring about. And yes, the rise of U.S. labor as a force within the wider U.S. economy. So he is going to try to do that, Matt. We'll all have to wait and see how things actually turn out tomorrow.
Kaylee Lyons and David Welch, thanks very much for that. Coming up, the market-moving events you need to be watching next in our trading diary. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg's The Open. I'm Matt Miller in for Jonathan Ferro. Take a look at some of the moves we're seeing across assets. Bloomberg U.S. dollar index, the strongest level we've seen since March, so it's climbing higher. If you look at rates, we have the 10-year yield at the highest level that we've seen since 2007, making new highs there. And, of course, equity indexes are trading lower on concern about that higher for longer March. Time now for the trading diary, what you need to be watching this week. Minneapolis Fed President Neel Kashkari speaking at 6 p.m. Eastern. Tuesday, tomorrow, President Biden, as we said, heading to Michigan to join the UAW picket line. Fed speak picks up on Thursday with Chair Powell, Goolsbee, Cook, and Barkin. Plus, we'll get another U.S. GDP and a round of jobless claims. And finally, the government shutdown deadline coming at midnight on September 30th. This was the countdown to the open. This is Bloomberg.
What do you like most about your job? I think the people, I mean, ultimately we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
Look, I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I try and play that role.
Secretary of State, Senator, First Lady, with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is Monday, the 25th of September. This is Bloomberg Markets. Here are the top stories we are covering for you at this hour. Yields keep marching on. The 10-year Treasury yield is at the highest since 2007. Bund's at the highest since 2011. How much do we blame central banks for the sell-off? Or should we blame oil? Crude steadies near $90 a barrel as speculators boost bullish positions to the highest since last February. Vicki Hollib, Oxy's president and CEO, joins me this hour for more on the market. And Hollywood writers have a deal. Screenwriters reach a tentative new labor agreement with studios, teeing up an end to their nearly 5-month strike. But there's no deals yet for actors or auto workers. From Washington, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is on assignment. Welcome to Bloomberg Markets. And Guy, it's actually Alex who will be speaking with Vicki Hollib later this hour. Lots to come on the energy market, but it really is the bond market that has our attention on this Monday morning.
What is it, the weather in New York? I can't figure it out. Why is everybody so gloomy this Monday morning? Certainly on your side of the pond, everybody seems very downbeat. Yep, the bond market continues to push yields higher. It's amazing to see the gravitational effect over here. It's having quite a pronounced impact on European government bond markets. What I can't figure out, Kaylee, is it the weather? If it's not the weather, what is it? Is it the shutdown risk? Is it the oil story that Alex is going to be talking about? Is it just the Fed still sounds quite hawkish? There seems to be a multitude of reasons why we may not be done with this yield story just yet.
Yeah, maybe it's not any one of those individually, but all of them combined, and that collective force, Guy, is what's driving yields to the highest we've seen here in the U.S. in 16 years. We're looking at 451 on the 10-year right now.
I'm amazed. Equity markets actually seem to be holding in there for the time being, but there is a holiday today. Volume doesn't look particularly good. Maybe there's another series of contributing factors into the mix as well. Anyway, as you say, Alex is in Oklahoma once again, this time without the hat. She will be joining us throughout the show. She's got some great guests lined up. We're looking forward to those. Oxy and Continental are going to be joining us over the next couple of hours. Oil, one of the potentially big contributing factors as to why we are seeing yields go higher, Kaylee. Let's talk about our question of the day. I think it's right on point today. Why? Why are yields higher? Let's try and figure out the answer to that question, because I think there's a multitude of potential reasons here. Edward Harrison, with you. Ira Jersey of Bloomberg Intelligence is probably the first person we want to be talking to about this. Ira, what is your thought on this matter? I'm trying to figure it out. I'm trying to understand, is it a cocktail of factors? Is there something that is kind of on point here? Why are we seeing yields continue to go higher? Because the inflation narrative doesn't seem to be necessarily part of this.
I think a big part of it is the central bank narrative, and not only here in the U.S., but also in Europe. So, Guy, I have to disagree with you. It's not treasuries that are pulling European yields, it's the other way around. So when you look at the two big moves that we've had in the bear steepening of the yield curve, so the long end underperforming the front end of the yield curve, that all started back in 2000 on Thursday during European hours. You saw a very significant increase in 10-year yields, 2-year yields kind of hovered around the same level, and that occurred again last night. So it's really the European investment and the European lack of interest in buying U.S. Treasuries and indeed European government bonds that has really contributed to this big move.
Ed, do you agree with that assessment? This isn't a U.S. issue?
I woke up this morning and I saw that we had 5, 6, 7 basis points up in the long end of the curve, and it just extended in the U.S. hours. One thing that I think would be interesting to think about is that we've had an up move. There's a channel upward in yields on the 10-year, which has been nominals, but also been mirrored in real yields. So really in the U.S. at the minimum, it's the real yields that are driving the move higher. We've gone from about 1% to over 2%. We're about 2.12 now on real yields.
Ed, is there also this issue, if it is Europe and maybe we are the tail wagging the dog right now, if it is Europe, what is it that markets are pricing in here? Is it an admission that we are basically in stagflation now? It was interesting, Torsten Slok at Apollo had a nice note earlier on suggesting that if that was the case, and he thinks it is, then what that is ultimately going to mean is higher yields for longer, not particularly good for the equity market, and that's the narrative. That's the playbook that Europe is now going to be putting into place. If Europe is driving this, is that the reason why?
Well, what I would say is it's not necessarily the case that Europe is driving it. It's rather that the Europeans had a crack at taking the yields higher after we opened. It's a combination, both A, of the fact that we have the potential for stagflation in Europe, but also B, the fact that there's a delayed reaction to thinking about the Fed. The Fed in 2024 said we're going to cut rates by 100 basis points back in June. Now, you might think that they would dial that back slightly because the economy's been better. They've dialed it back a decent amount, actually only 50 basis points of cuts that are priced in. That was much more hawkish than people have anticipated, and that is negative for longer-term yields, and that's what we're seeing, this delayed reaction to the Fed, adding to the European narrative that you were talking about, Guy.
Well, Ira, as Ed was just talking about how what we're seeing with the 10-year Treasury yield tracks the move we are seeing in real yields. This isn't break-even driven. That's not what this is. It isn't really, it seems, about inflation expectations. So should we understand that oil really doesn't have anything to do with this, that these moves are entirely separate?
Well, I think oil does have something to do with it, but it's been basically real yields have been the only real driver of the total bond market for the last 3 or 4 months. There hasn't been a significant move in inflation break-evens, like you noted, for quite a long time until they came down significantly. I think the oil impact really has to do more with what is the reaction function of the Federal Reserve and other central banks, particularly in Europe, who care about headline inflation and how that might affect longer-term inflation expectations of the consumer sector. So I think that remaining at the peak for longer is something that oil prices distinctly affect.
Ed, final point from me to you. Kayleigh brings up oil prices. What effect are they having? What effect is QT having in this mix? What effect are strikes having in this mix? What effect are kind of a potential shutdown having in this mix? What are all these other factors doing in terms of their effect on what is happening with yields right now?
Well, I think
Oh, go ahead, Ira.
Sorry, Ed. You can both have a crack at it, to be honest.
Well, let me say that I want to piggyback on what Ira was saying and point to the concept that one of the things that's driving this is the fact that we're very limited in terms of what the Fed can do and what the European Central Bank can do. Basically, as long as we have that inflation relatively high, as long as the U.S. economy is not falling off a cliff, how many cuts are you really going to get from the Fed? They're very limited in terms of what they can do. So at the margin, all these other things are going to be of less importance.
Great, guys. Thank you very much indeed. Appreciate both of you joining us. Thank you very much. Ed Harrison and Ira Jersey joining us on what is happening with this phenomenal rate story that apparently is mainly having its genesis over here in Europe. Oil, though, a huge contributing factor, one could argue, in terms of the zeitgeist around all of this at the moment. It is appropriate, therefore, that Alex has decided to take this opportunity to head back to Oklahoma. The 2023 American Energy Security Summit is taking place at the Ham Institute for American Energy in Oklahoma City. She doesn't have a hat, but I guess she's got a lot to talk about. Alex, the oil story is... Yeah, there we go, no hat. The oil story is huge right now. This is the perfect time to be talking about where it's going to go from here. Where do people think it is going from here in Oklahoma?
I can't believe you had a picture of the hat for me. Okay, well, I think that we are going to hear from the CEOs is that they're going to look at oil between 60 and 80, right? No one's going to want oil at 100 or plus because that's going to be some demand destruction. Interestingly enough, if you want to have policy that's going to unleash American oil, what that does is actually tank the price. And oil producers don't want oil at 40 or 55. That's not going to be good when it's very expensive to produce this oil now because of inflation and labor. So there's a real tension here as to what actually makes sense. If you unleash the oil, you get lower oil prices, which hurts the producers, which then makes less oil, or you keep it kind of high and then help the productivity and help the cash flow. So that tension will definitely be unveiled here.
Okay, so it basically is a decision, Alex, of keeping supply constrained or not, right? And shale's just one factor in that because, of course, all of these guys are thinking about the counterbalancing effect of OPEC+.
Yes, but here, more importantly, I think it's the counterbalancing effect of the energy transition. So I'll be speaking to Ambassador Nikki Haley later on today, and she unveiled her economic plan, which talked about getting rid of the $500 billion in subsidies for green energy. You know what? The guys here, they like those subsidies. They're using the subsidies to build out carbon capture, to build out hydrogen and other facilities. So how do you repeal something that the energy guys actually like because they're plowing billions into the energy transition? Another tension here. And the backdrop, guys, honestly, is China. I'm listening to a lot of speakers right now, and they're all harping on China and having energy security from China, something that we don't necessarily think about in the same way when it comes to the energy transition.
All right, really interesting stuff, Alex. Looking forward to your coverage from Oklahoma throughout the day. Alex is going to be back with us later in the show for exclusive interviews with Oxy CEO Vicki Hollub and Continental Resources CEO Doug Lawler. She also, as she mentioned, will have a one-on-one with Republican presidential candidate Nikki Haley. So tune into that at 1 p.m. New York time and on Live Go. Coming up here, though, we'll have more on our question of the day. Is it oil? Is that why yields are higher? Sarah Kunst of Clio Capital is joining us next to discuss. This is Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Yields are rising.
The higher real yield story.
Why are bond yields rising?
So much of it's been driven by the recent stronger economic growth.
Economic growth in the third quarter has picked up.
Inflation indicators, whether you look at owner equivalent rents or oil prices, are starting to tick back to uncomfortable levels.
We're in an environment where the Fed is leaning towards potentially another hike.
Expectations for the next Fed rate cut have been pushed out into the future.
There's an acute awareness and concern on fiscal right now.
You've got a substantial amount of fiscal spending.
That's something that may actually even pressure Treasury yields modestly higher.
We're still not sure that we are at peak yet.
There's so much uncertainty on the path for Treasury yields.
Bond yields being higher, a Fed that's higher for longer, is going to continuously put pressure on just the broader markets.
Those were some of our guests on Bloomberg TV talking about yields as they continue marching higher, which brings us to our question of the day. Why are yields higher? Looking at 451 on the 10-year right now. Joining us to discuss with her thoughts is Sarah Kuntz, Managing Director at Clio Capital. So Sarah, what should we chalk this up to? What's driving this?
You know, I think that certainly oil is a part of the conversation, but I also think that there's a new normal that we have to get used to with oil, which is, you know, once summer's over, that first cold snap starts to hit, you know, there's probably going to be a big global oil producer who suddenly decides that they don't have the supply they thought they had, the price needs to go up, and I think we need to stop being surprised by that. You know, certainly as long as we're you know, looking at a world where Russia's at war with Ukraine, I think that we're going to see them have a lot of supply issues in the winter that really, you know, drives up the price whether we like it or not, and that does have an impact on yield.
And do yields stay higher? And if yields do stay higher, what does that mean for equity portfolios, Sarah?
I think that equity portfolios for the next little while don't have much to be positive about, period. Certainly, you know, higher Treasury yields mean that it's a lot easier to make money there, and you're less likely to be pouring it into, you know, IPOs and other kind of more speculative feeling bets. But, you know, I think that yes, it doesn't have a great impact on equities, but I don't know that that's the only thing driving down equities and you know, making Treasuries look a lot more appealing.
Well, when we say it will have an impact on equities, arguably that impact is going to be felt disproportionately in some areas of the market relative to others, right? Sarah, where do you see the greatest vulnerability to a higher for longer rate story?
I think that it's the big tech names. You know, I think that the growth names that have just sort of fueled this massive run, especially in NASDAQ over the last year, and you know, looking back beyond that, the last 3-4 years, I think that those stocks are feeling more speculative and harder to back. I think we're seeing that in kind of the lackluster IPOs that have come out of Instacart, you know, ARM. These aren't sort of the blockbuster hits that people had hoped, because I don't think that risk appetite's there right now.
So what do you think outperforms going into year end? Is it cash? Is it bonds? Is it equities?
I don't know if we're going to see much outperformance. I do think that we're going to see people sitting on the sidelines with some cash, waiting to see, you know, this looming government shutdown again is not necessarily the best thing for investor sentiment. And, you know, I think that there's going to be a lot of people who keep some of that cash on the sidelines to see what happens, you know, after this last rate hike that's, you know, at this point almost hopefully coming up soon, so that people can start counting down to the cuts.
Sarah, you talk about a government shutdown, which here in Washington is basically all we're talking about, and of course is one of the risks on the horizon, but you have many other potential headwinds as well. Mike Wilson over at Morgan Stanley actually publishing in research in the last 24 hours talking about slowing consumer spending, student loan payments resuming, rising delinquencies in certain household cohorts, higher gas prices as well, weakening data in the housing sector. Sarah, is it becoming just a really difficult picture for the consumer now?
It's been a really difficult picture for the consumer. We've seen retailers saying that pretty consistently over last quarter's earnings calls, right? And they're not even necessarily talking about their sales. They're sounding the alarm about something that's a much bigger macro driver. And that was still when, people didn't have to pay back their student loans yet. People didn't have to worry about, their heating bills going into the winter. And so, yeah, I think that the consumer's not in a great place. I think the consumer hasn't been in the great place. The difference now is that's really getting kind of priced in. And I don't think it's necessarily going to be a great winter.
Kaylee, it's really interesting. You talk about the consumer. The consumer is many people, clearly, and it's been interesting to watch how the higher-end consumer has held up. But you've now got warnings from just about the luxury good companies here in Europe about a slowing consumer in the United States and over in Europe and in Asia as well, and that all speaks pretty badly. LVMH is absolutely cratered, and you do wonder, if stocks don't perform from here, what happens to that higher-end consumers? They seem reasonably resilient to higher rates, but a stock market setback, I just wonder.
Yeah, if you have all of a sudden all of that wealth that maybe was accumulated and you start to feel like your real wealth is actually much lower if you are invested. Also keeping in mind, Guy, that a lot of this has to do with the housing market as well, which to this point, given rates are so high and no one wants to let go of their existing low mortgage, you still have a lot of value in high home prices. Do we start to see that turning eventually? I personally, crossing my fingers, trying to buy a house, but that'll obviously have an impact as well if and when it does happen.
Absolutely. So Sarah, what do you think? How resilient is the upper-end consumer to what is happening here?
My most fascinating data point I've seen in the last few months over that is the fact that Walmart's actually gaining a new consumer, and that's that consumer that does have more money, more wealth, but they're starting to trade down, right? And so we're seeing this sort of down trade. If you have money, you're not suddenly running out of it, but you're starting to think about it a little bit more. I'm watching holiday travel a lot. I want to see, are people booking these big end-of-year trips, or are they going to stay home and drive to grandma's, because that all has an impact on spend. But I think in general, no one feels right now that this is necessarily the right time, to go buy a $100,000 Birkin or a new Lamborghini.
Which is a shame, because those were the two things that I was definitely thinking about. Sarah, great to catch up. Lovely. Thank you very much indeed. Sarah Kunst, Managing Director, joining us from Clio Capital. I'll just have to put those two things off. Christmas list is changing rapidly. Okay, still ahead, Amazon talking of shopping, entering the AI race. It's made a $4 billion investment in generative AI startup company Anthropic. I should get that one right, learn to speak. We're going to have details on it next. Ed Ludlow will nail it. The startup is coming up. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your night because it's really bothering me.
Ah, my nights.
Yeah. He's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this, put it over here.
Not cool. Not cool. All right, I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
It's 20 past 7 on the West Coast where the sunrise is looking gorgeous. Let's get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its beautiful morning. Joining us now is Bloomberg Technology co-host Ed Ledlow. And Ed, what we have to talk about, other than how good that sunrise you're enjoying looks, is Amazon. $4 billion in Anthropic. This is a big generative AI play. Walk us through it.
Yeah, it's up to $4 billion into Anthropic. In the first instance, it's something like $1.25 billion, but it's a sizable investment from Amazon in what is a leading startup in the AI field. It has its own foundation models. Claude was a generative AI tool released in March of this year, San Francisco based. But more interesting perhaps is kind of the technical or technological relationship between the two. So Anthropic is going to migrate its platform or software to AWS cloud, but it's also going to train its future models on Amazon's proprietary silicon or AI accelerators, Trainium and Inferentia, which is a pretty big vote of confidence in Amazon's competence around chips specifically designed for AI workloads.
Ed, what do regulators think about this kind of thing? Are they comfortable with this kind of M&A? Because this would strike me as potentially the kind of M&A that means that small companies don't become big companies. They get consumed by big companies before they become big companies.
It's interesting. We were discussing the size and scale of this as a team this morning and over the weekend. Amazon technically takes a minority stake in Anthropic. And remember that Google, Alphabet, the parent of Google, had already invested in Anthropic earlier this year. So there's kind of an interesting competition, frenemy kind of situation going on there. It's not an outright stake. This is pretty much the most sizable AWS-specific investment that Amazon's ever made. And if you think about what Amazon as a whole has done in the past, this is at a scale that's kind of similar to Whole Foods, right? I think it's probably the second biggest behind Whole Foods. So it's interesting. Had Amazon thought about this earlier in the year, before Anthropic had raised money, one would raise the question quite reasonably, why didn't Amazon just buy it outright earlier in the year? But they're not doing that here. It is a minority stake.
All right, Bloomberg's Ed Ledlow, thank you very much. And of course, you can catch Ed and Caroline Hyde on Bloomberg Technology just around 90 minutes from now. Right now, though, we do have to get to some breaking news out of China. Evergrande, the big property developer, a unit missing payments on a 4 billion yuan onshore bond. Guy, of course, we've been paying a lot of attention to this distressed developer in particular. Concerns around it are the reason why we saw property stocks in China down the most in 9 months overnight. There's concern about a potential liquidation, and that's just fresh signs of stress that are in the Chinese property sector, Guy.
And you're already starting to see it kind of rippling in quite quickly into European mining stocks as well. There does seem to be this idea that these guys are so stressed, they're not restocking, they're not planning the next big building project, and as a result of which they're kind of reducing the amount of steel, et cetera, that they're ultimately going to need.
Yeah, this is going to be a story that we will continue to keep an eye on. Again, an Evergrande unit missing payments on a 4 billion yuan onshore bond. Coming up there, we're going to go back to Alex Steele in Oklahoma. She's got an interview with Vicky Hall of the Oxy president and CEO. This is Bloomberg.
been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
We are an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. And Abigail, it's all about the moves in the bond market today.
The bond market moves are huge, and we'll be taking a look at those in a moment, Kaylee. But first, let's take a look at the S&P 500, because we're looking at something here that we've not seen yet in 2023, and that is 5 down days for the S&P 500 in a row. The last time I looked at the index, it was fluctuating. Right now, it's down slightly over this time period, about down 3.2%, having everything to do with those bond moves that you're talking about after last week's higher for longer Fed meeting. Let's take a look at what's happening today for bonds, and it's not pretty for stock investors given the fact that it tightens financial conditions. You have the 2-year yield not moving all that much, but take a look at the 10-year yield back above 450, the 30-year yield at 464, up 12 basis points. So this really pressuring a lot of risk assets, also giving a lift to the dollar. The Bloomberg Dollar Index continues to break out of this year's range. Right now, up about 0.4%. Not surprisingly, we have crude oil down, we have silver down, other commodities down. We also have Bitcoin down about 1.5%, really pointing to this risk-off tone. Completing the risk-off tone is the Russell 2000. It continues to truly break down. Matt Miller earlier today really brought to my attention that it's in a correction, and that is true. We've been looking at this chart relative to the Russell 2000, breaking below its 200-day moving average before any of the other indexes, down 11% from the July peak. That's a pretty defined break below the range, suggesting we could see more weakness ahead, Guy. It also begs the question, are we going to see the S&P 500 and the NASDAQ 100 follow suit?
Absolutely. I think a lot of people are watching technical indicators very carefully right now. Abigail, thank you very much indeed. Let's find out where Alex is. We need to go to the 2023 American Energy Security Summit. It is taking place in Oklahoma City, and Alex is joined now by the Oxy CEO. Alex, take it away.
Thank you so much, Guy. Without the hat, it is true, but I'm here with the president and CEO of Oxy, Vicki Hollub. Vicki, it's like my once-a-year catch-up with you, so I thank you for joining me. $90 oil, does it get to 100? Is it sustainable?
I think that we all in the industry have an opinion on oil prices, but usually we're wrong. So rather than answer that directly, I would like to say that the fact is that since China, Brazil, India, and Russia really had their growth in GDP spurt back in 2004, real WTI prices have averaged more than $80. And so I really think that now, to me, that indicates that the mid-cycle price of oil is around $80. Now, the reason Prince Abdulaziz has been doing what he's been doing recently is to balance the markets, because there was a time of overspend followed by a long period now of underspend in the industry and then the pandemic. So now, to balance the markets, is best for all of us, because if he wasn't doing that, then prices could potentially go way up to over $100. But in balancing the market, you protect the downside so that you have a healthy oil and gas industry, but also without damaging economies around the world.
So some of the underproduction or undersupply was because you guys, shale players. So are you doing anything differently if we're at a mid-cycle price of 80 and we have spurts to a 90?
I think that certainly our industry has gotten to the point where we are practicing much more discipline than we used to practice. You see that prices have been moderated recently, that a lot of people have predicted $120 to $130 oil. You haven't seen it because the industry doesn't want to go there. Since in that time period that I just described, since 2004, prices were above $100 26% of the time. I don't think we'll see that again.
So Vicki's still capital disciplined, or Vicki's going to pump more?
We're capital disciplined, and what that means for us is that we don't increase oil significantly in a market where we don't see the balance. Okay. It would only be in a market where we see the balance that we would increase our production, and then it would be at a moderate pace. We really are much more focused on returns than production volumes.
Any recessionary things that you're noticing, or fears? Any demand destruction? Like, are you noticing anything on the backside in terms of demand for you guys?
We don't see any demand destruction at this point. I don't think that if prices went above 100, that it would stay long enough to destroy demand. I really think that we're continuing to see a gradual improvement. And I think even in a recession, I don't think that demand would drop so significantly that it would drop prices.
So we're here at an energy security summit. And part of the line is going to be like, let's unleash American oil, right? If you unleash American oil, oil can go to $40 a barrel, $55 a barrel. You're not going to want that. You're going to need higher prices. So if you got the go-ahead to be like, you can do whatever you want, Vicki, would you? Can you? Are there other constraints?
The constraints really are making sure that you increase value, that you don't destroy value. If you look in those, that 20%, 26% of the time that prices were above $100, a lot of value was destroyed because we drove up the cost of what we were doing. We were inefficient at that activity level, the industry in general. And so now I think there's a lot more discipline around how to do it better, and not to get into an oversupply market.
So if I look forward for Oxy in the next 10, 20 years, you guys are going to basically be a carbon management company, and a big part of that is direct air capture. You suck some carbon out of the air, and you either store it or use it to get more oil. You recently announced that Amazon's going to purchase about 250,000 metric tons of carbon removal credits over 10 years. Huge. It's a big part to get that plant built. What are the financial terms of the deal?
I can't say, but I can say this, that since we started working on selling carbon reduction credits a couple of years ago, the voluntary compliance market has continued to grow. More and more companies are wanting to offset their carbon footprint. There's more than 2,800 companies around the world that have goals to reduce their carbon footprint or neutralize it. Therefore, prices are starting to go up for carbon reduction credits. We can't share prices on contracts, but we can say that we believe that this is certainly encouraging us to know that we can do this and do this in a commercial way. And the important thing to remember is that what we're building here is a technology that the world desperately needs to reduce CO2 out of the atmosphere. And in doing that, what we can do too is provide value to our shareholders. Because if we can't do that, it's not sustainable.
So let me ask it a different way. How hard was it to come to a price with Amazon, or how easy?
I would say that this is a growing industry. An industry is developing out of nowhere to.
This is hard. This is CEO speak for hard. Is that
this is hard?
Okay, so it's hard.
It's hard. I don't think that we've negotiated a contract yet that didn't take almost a year or more, because people are just starting to understand the industry. Our legal people have never written contracts like we're writing today. So we're at the forefront of this, and I feel like we're leading the way in a lot of ways, especially with respect to these large volumes and and matching that with what companies need to fulfill their goals.
I'm going to ask you one more in a different way, one more time. You get a tax credit for direct air capture of $180 a ton to decarbonize, depending on where you put it, in the ground or back to oil. You have said that companies will be willing to pay above that. Did you learn that that is true with Amazon?
I never can talk about prices on any given contract.
But did you feel good? Did you feel a sense of relief?
But I can say that to make this commercial, there's more than one thing happening.
Okay.
We're also going to, over time, be able to significantly lower the cost associated with these carbon credits. So it's not just the sale, it's not just what you get for it, it's the cost of doing it. So balancing the two of those and getting to the optimum point is where we're headed, and I feel confident we'll get there.
Fair enough. What do you say? So we're at the Energy Security Summit. I know that carbon management is going to be huge over the next, 10 hours here. What do you say to those who say, yeah, but that's just an ability to let you pump more oil? I mean, you've said that you're going to use that carbon to get more oil out of the ground, so that's not going to do anything for us. What do you say to that?
I say that what they don't understand is all the benefits of doing this, because it takes more CO2 injected into the reservoir than what the incremental oil produced from that CO2 will emit when used. So what it does is it creates a carbon zero or carbon negative barrel of oil. And maritime and aviation needs carbon neutral oil to make their jet fuel and their maritime fuel. It's very much needed for that. The second thing it does is it's further lowered, the intensity is further lowered by the fact that you're using infrastructure that's already there. So getting more out of existing reservoirs is a lower intensity, carbon intensity barrel of oil. So that helps. And then the third thing is that it's very important for the world to produce reservoirs like this, because if the industry adopted this all around the world, this is the best thing that could happen from a climate change perspective, because the last barrel of oil produced in the world should come from this kind of reservoir. And especially here in the United States, where we have vast resources and great resources to develop, those resources are not infinite.
And lots of rocks.
And so it's really important to get the most barrels of oil out of the reservoirs we have in the United States. And we can do that today. We have the infrastructure in the Permian to begin there. And then as we begin there, expand that, we can do it in the rest of the areas here in the United States. That guarantees more energy independence for the United States.
I like the pitch. It's a pitch. She did her pitch. It was a good pitch. Before I let you go, just to tie into what's happening in the broader world, yields are higher all across the board. Is that impacting how you're doing with Oxy at all, or how are you looking at that? Does that tell you anything?
I think that it's important to that happens for a healthy industry.
Okay, fair enough. All right. Thank you so much, Vicki. I appreciate it. Vicki Hollab, she's president and CEO of Oxy. Guys, back to you.
All right, and Alex, thank you very much for that interview. Alex will be back in the next hour for another interview with Doug Lawler, the CEO of Continental. Coming up next, though, summer is ending, so where do we stand in the summer of strikes? We'll have the latest on the United Auto Workers ahead of President Biden's plans to join the picket line in Michigan tomorrow. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
After nearly 5 months on strike, Hollywood screenwriters have reached a tentative new labor agreement. President Biden just moments ago releasing a statement praising the deal and saying, quote, "I urge all employers to remember that all workers, including writers, actors, and auto workers, deserve a fair share of the value their labor helped create." The president, of course, is set to travel to Michigan on Tuesday to support striking members of the United Auto Workers. Meantime, former President Donald Trump plans to do the same on Wednesday. For more on the current state of the negotiations between those auto workers in the UAW and the big three automakers, Bloomberg's Craig Trudell is with us. Our global car czar, who is usually in London but is in New York today and I believe heading to Detroit tomorrow as all of this is going down. Craig, great to see you. Of course, on Friday we saw an escalation of the strike, it expanding to all of the parts distributors for both GM and Stellantis. Was any real progress made in talks over the weekend? What's the latest?
We didn't hear any meaningful updates really over the weekend, and I think the escalation that we saw on Friday was a little bit muted on the part of the union. So these parts distribution centers absolutely are going to have the potential to affect the dealer level, how consumers have potentially have trouble with getting their cars repaired over the next weeks or months, depending on how long this lasts. But we have not seen an addition of more assembly plants or maybe specific parts plants or engine or transmission plants that would really sort of result in substantial disruption to the industry, at least from a manufacturing perspective. We also encouragingly for Ford heard that the union felt encouraged about the amount of progress that they're making with that company in particular. So this is at this point 2 companies rather than 3 that the union is really putting pressure on and sort of taking to task for, in its view, not going far enough to sort of meet their demands.
Craig, what impact will the president's trip to Detroit have, do you think, on how this story develops from here?
I think it's going to be really interesting to see, Biden tomorrow, Trump the following day. I think we did see some hesitation on the part of the union to embrace, White House involvement here. Sort of, a reluctance for some of Biden's deputies to get involved. They wanted this to be a matter, between these companies and the union. And I do think, that maybe sort of became, too much pressure to resist on the part of the White House, wanting to send a clear message that they're on the side of the union, and Trump, kind of trying to assert himself. And I think the UAW leadership very much has been, on the side of Biden, and yet the president of the union was very clear to our colleagues in the Detroit bureau of Bloomberg very recently talking about some of the messages that Trump sends to workers resonating. This idea that there is real concern on the part of the workers of this transition to EVs and what it's going to mean for their jobs going forward. And that's at the center of these negotiations. There's a real concern about whether or not some factories may go down as a result of the fact that we're going to shift from engines and transmissions to batteries. And we do still have a lot of factories in the U.S. that specifically make engines and transmissions that won't necessarily, easily be able to one-for-one make that switch to batteries.
Yeah, and we understand based on what Trump's advisors have said that he's going to talk about the idea that all these jobs are going to go to China instead, given the EV transition. Just on that note, though, Craig, of job security, we understand that that is really a sticking point in the conversations with Stellantis, at least, but I'm sure that goes more widely for all of the big three negotiations. That one feels like it's harder to resolve than just deciding what the number is on wage increases.
Yeah, I think that rhetoric about these jobs are going to go to China is absolutely misplaced, and it's a result of the fact that the amount of subsidies going into trying to lure battery investment in the U.S. Is substantial as a result of the Inflation Reduction Act, and is resulting in real investments by these three companies and companies like Toyota. Volkswagen, a lot of companies, the amount of investment flowing into North America is really substantial, and you're seeing, concern globally about that, about, Japan and Europe and Korea, being very concerned about the fact that the U.S. is really trying to assert itself in luring some investment. That being said, that doesn't mean that there won't be some disruptions here. And so we're going to have, some real trade-offs and challenges at the worker level as a result of this transition.
It's interesting that China issue is being used here in Europe as well. A debate taking place between the UK and the EU. The German automaker certainly saying, you've got to fix this, because otherwise, basically, you're making us less competitive against Chinese imports. Craig, thank you very much indeed. Craig Trudell joining us from New York, soon to be in Detroit. Some great coverage coming up of what is happening with these strikes over the next couple of days. Coming up on this program, the SEC is said to have collected messages from staff of more than a dozen investment firms. More on the investigation into the use of private messaging apps. Today's Wall Street Beat is coming up next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
It's time now for Wall Street Beat, where we look at what's buzzing on Wall Street and the world of banking and finance. And today, we're looking at the SEC's investigation into Wall Street's use of private messaging apps. Joining us now is Bloomberg's Sonali Basak. So, Sonali, by now we're all very familiar with this story. There's already been, I believe, $2.5 billion worth of fines given out related to this. But now the SEC is actually combing through a lot of these messages. Should we be surprised?
They're combing through messages now of the next phase of what this investigation spans to. That is investment advisors. Remember, we only really know that they're collecting those messages, those WhatsApp messages and other unauthorized apps. We have names to the firms, Blackstone, Apollo, Citadel. This is all according to Reuters. Carlyle, TPG. These are the massive private equity firms and hedge funds that the SEC and the CFTC are really now expanding the scope of the investigations to. Now, remember, when you look at what they've been looking at already, to your point, it's been $2.5 billion worth of fines. You've had domestic banks that have settled. You have also had international banks that have settled, the likes of BNP and Deutsche Bank and others. Now, remember also that as we watch them kind of expand the scope of what they're looking at, this kind of unauthorized use of messaging systems, you have to kind of wonder how far and wide will this really go at the end? Will they also start to look into RIAs, for example, firms that are smaller than some of the giants that I had just named over to you that have been expecting these moves for months?
Sonali, just to be clear, so the first set of fines were basically, you've been using it, you shouldn't have been using it, therefore we're going to find you. Now they're starting to read them. In trying to read them, what are they looking for?
Well, you have to remember that the reason this happened in the first place, and I think a lot of people tried to pin it on the pandemic, but if you look at what had happened, you have the SEC really looking at messages that went back far beyond the pandemic. Messages at JP Morgan going back to 2018, for example. And so what are they looking for? They're saying that it's making the SEC's job harder, regulators' job harder to parse through messages as they need to in the event of any regulatory matters. But now what they're saying here is that you shouldn't be using these unauthorized forms of communication in the first place. So a little bit of a chicken and an egg issue here as kind of the use of technology has expanded so far and wide on Wall Street. Asset managers are taking this very seriously. You know, I had mentioned this idea to folks over at a lot of those firms that we have named, and some of them are very afraid to talk to people on things like WhatsApp and communicate on places like Signal for this reason. So it certainly has had an impact. And there has been a response from the industry, lobbying groups saying that the SEC is overreaching in these regards. We are only talking about the collection of private messages here, Guy, as the SEC tends to do. But remember, this is now a situation that is expanding well beyond the biggest banks and into many more members of the financial community.
It's amazing to see how this is just growing and growing and growing and growing. Where does it end? Sonali, thank you very much indeed, Sonali Basak, on what's happening with the WhatsApp, Signal, etc. story that we're watching so carefully and have watched, as Kaylee says, for quite some time. Where does it go next? Stock 600 down by 1% today. European stocks have been really down from the get-go this morning. The narrative out of China wasn't clever. The narrative out of Asia wasn't good. The bond market, it's just a sea of red out there, basically. The UK 30-year, look at what we're looking at there. Long duration bonds, that's an 11 basis point move. These are really, really chunky moves. It was interesting listening to Ira Jersey in the beginning of this hour talking about the fact that the genesis and maybe some of this move that we're watching here, certainly since last Thursday, comes out of Europe. Not front end, it's the long end that is moving so much. Euro dollar down by 0.7%, 1.578 is where we're trading there. Christine Lagarde's been talking today. We've got big CPI numbers coming up later on this week. What does this all mean for European equities? Emmanuel Cao, Barclays head of European equity strategy, is joining us next. This is Bloomberg.
there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Monday, the 25th of September. It's ugly out there. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So one of my team earlier on today said to me, "Happy Monday," which I don't think is a thing. And it's certainly not a thing today when it comes to financial markets. Look at what is happening out there. Stock 600 down by 1%. Luxury stocks are getting dinged up pretty badly. The miners are getting dinged up pretty badly. Travel and leisure stocks, more the leisure than the travel, getting dinged up pretty badly. Stock 600, 448. Getting through some technical levels in Europe as well, which is pretty ugly too. Entain. This is what I mean about the travel and leisure sector. Down 14.5% today. The outlook, not good. This market is having to take this company is having to take a look at its markets and review where it goes next. That stock getting hurt pretty hard. Look at Kering. Paris Fashion Week is underway. Apparently it's going quite well. Apparently the Kering show was great, but you've got a Bank of America downgrade today, which is knocking the stuffing out of that stock, down by 4.5%. You've also got Valentino out, the CEO of Valentino making some pretty negative comments as well about what is happening in the luxury space. So, Kaylee, happy Monday? Not really.
Yeah, it doesn't really seem like a happy Monday here in the U.S. either, Guy, because you are seeing selling in the equity market, and that probably has a lot to do with the selling we are seeing in the bond market. Right now, the S&P 500 off by about 0.25%. We're at the 43.08 level, but it really is the 10-year yield that captures our attention, maybe following really what we saw start in Europe overnight, but that yield now up 8 basis points on the day. We're at 451. This is a fresh high since going back to October of 2007, almost 16 full years. What's interesting is it is concentrated in that long end of the curve. At the front end, you really aren't seeing much movement at all. We are flat on the day on the 2-year, which is just at 5.1%. And finally, this is feeding through into a stronger U.S. dollar as well. The Bloomberg Dollar Index up by about 0.5% on the day. And at 12.63, we are now at the highest level going back to December of last year, Guy.
Well, let's talk about what is happening over here in Europe, because apparently we're responsible for all of this. I want to talk about what's happening with the German bond market, the Bund, the bubble and chasse, what's happening with real yields as well. Are we going to 3% on a German 10-year? Well, certainly, if you take a look at the activity and the move that we've seen over the last couple of days, maybe the momentum is taking us in that direction. I think we've got 9-year highs on real yields. Germany is stagnating right now. The economic data is not good. People are talking about Germany being the sick man of Europe. Yet what is happening here is potentially higher inflation and lower growth coinciding. That is not a great combination. And maybe that's ultimately what is being priced into the German 10-year, Kaylee.
Yeah, and it all is going to come down to how the ECB reacts reacts to a potentially stagflationary environment. ECB President Christine Lagarde was just speaking before the European Parliament in Brussels, and she reiterated that borrowing costs will remain elevated for as long as needed to tame inflation.
Our mission, our duty is to return inflation back to target in a timely manner. The faster it gets there, the more stable prices are, the less painful it will be going forward for both those who invest, but also those who have borrowed.
As Torsten Slot was saying in his note earlier from Apollo, stagflation looks like the real story here in Europe, and the playbook is a fairly straightforward one from central banks. You have to keep interest rates higher, and at some point you hope that there is a spark that reignites growth. Why are yields higher, though, I think is a key question, and I think that's a question we need to answer. I think it probably is a cocktail of factors, but some may be more important than others. So why are yields higher, and which yields are more important in this whole story? Joining us now, Bloomberg's Justina Lee and Eddie van der Volts. Justina, I'm going to talk to you first, because I want to pin you down on what you think the answer is to what is happening here. What do you think is driving yields higher? Is it a cocktail of factors? Is it the oil price? Is it central banks? What do you think is going on?
Well, it seems like investors are slowly adjusting to the reality that rates will stay higher for longer. And of course, last week we also got some noise from Fed officials saying that there might even be one more rate hike coming up. And I think sort of the catalyst for all that is that move in oil higher. Now, a lot of that narrative has been more about the supply side than the demand side. So it's not necessarily having to do with inflationary pressures increasing that much. But I think at the very least, it's pretty direct. You know, you have higher oil prices, that translates into a faster inflation in terms of the headline numbers.
Yeah.
But what's so interesting, Eddie, and I'll let you chime in here, is this idea that it's not break-evens that have been driving any of the moves that we're seeing, which is where you usually would see oil showing up. It's a real yield thing. So what's your take on this?
Yeah, you know, I think that Justina was absolutely right just there. You know, this is a story about higher for longer is here to stay. The market's buying into that. I think we're seeing real changes in the market's assumptions about just how long inflation's going to be with us. And then, you know, if you see inflation that sticky, you don't want to be anywhere near the long end. And if we're going to get this benign bear steepening, I say benign is not benign for the bond market, obviously, but you know, which the market says, look, we're going to probably see bear steepening. If we see that, we see 200 basis points, that's going to have to come quick, you know, in the next sort of 12 months. And I think there's a lot of pain underlying that, particularly for the bond market, particularly for pension funds and so on. But I do think that, you know, this it seems to be the outlook. To your question about whether, you know, why we're not seeing this in break-evens, I think, you know, the break-even market, I think that is a much more illiquid market than people assume. I don't think it is as good at forecasting inflation as people assume.
So you're firmly of the view that this is an inflation, this is underlying, this move we're seeing in the bond market has its genesis in inflation. It's not supply and demand. It's not QT. It's not what's happening with the strikes and the fact that ultimately we are seeing a potentially longer-term shift in labor. It's not what is happening in terms of the European story versus the US. So it is fundamentally driven by inflation.
Guy, I think all of the above, right? I think we've got a bunch of narratives driving us, you know, all in one direction. I don't, you know, the QT debate, I'll leave for others, but I do think that, you know, wages. I think people's inflation expectations have shifted. They're going to, you know, we're going to talk about strikes. This stagflationary debate that you're talking about, it is becoming entrenched. You know, it pops up from time to time, but I've never really had as many mainstream investors and economists talk to me about, you know, about stagflation. So it feels like that is here to stay.
And to go back, Justina, to what ultimately stagflation is going to mean for the ECB, as we just heard Christine Lagarde saying that they're going to stay high until they absolutely have to, until inflation comes low enough that they're comfortable. Who's going to be able to hold higher for the longer period of time? Can Europe do it, or is that going to be the Fed?
Yeah, it's kind of interesting because on the one hand, you have Christine Lagarde trying to send that hawkish message, or at least tell investors that we want to keep rates high. But you're already hearing a bit of divergence from other ECB officials saying that maybe the European economy can't take this for much longer. And I think you're already seeing that in the European numbers. And, Europe has always been like a more cyclical economy, and so it's more exposed to, slower Chinese growth. Of course, that also depends on, what we're going to see out of China. But it would seem like for now, I mean, the ECB probably kind of will have to like relent earlier.
Do you think that the central banks are happy with what is happening in the bond market, though? Because in some ways, they've made it very clear, and Christine Lagarde was talking about it again today, we are not talking about cuts. So what is finally happening in the bond market now is an acceptance that the cuts are not coming. The cost of that is higher yields, which is going to have an impact on growth. But do you think fundamentally central banks are ticking the box here and saying, yep, I think our communication strategy has worked?
I think they're probably happy with like the self-fulfilling prospects of it, in the sense that they don't want investors to think that, we're going to cut rates next year. And that hopefully has the effect of, preventing inflationary expectations from becoming entrenched. But of course, you can say that, once borrowing costs go up enough, it does make it harder to kind of pull off a soft landing, which a lot of Fed officials were still hoping for. I mean, at this point, are we still going to get that?
Well, to the point on the soft landing, we just had a headline crossing from S&P, now expecting the U.S. economy to expand 2.3% this year. Their previous view was 1.7%, so it just speaks to the resilience that we've seen that maybe took many people by surprise. And Eddie, what that has come with as well is a pretty surprising resilience of the U.S. dollar. We're back at the highest levels we have seen year to date since December of 2022. What do you make of that?
Yeah, look, I spoke to a lot of investors over the last week or so about, where do you position for stagflation? If this is your base case, if you believe that not only are we going to see stagflation, we're going to see protracted stagflation. And they all said, look, the dollar is the place to be, because the dollar, the Fed has the most room to maneuver here. I think that the Fed has created some space for itself in order to react, whereas the ECB, their situation's tough. And I think just the fragmentation of Europe still is a risk factor. So I do think, investors in any time of panic will flow to the dollar.
Is the fact that yields are going higher just an example of the market getting everything wrong again? So we thought there were going to be cuts, and we were wrong. So now we're sending yields higher. And I'm now wondering whether the fact that yields are higher and we're all pricing in this higher for longer basically signals that actually we are right at the point at which the economic story falls out of bed in a fairly big way. Europe already is. The United States probably could be next. To Justina's point, starts to become self-fulfilling. It's hard to pull off the soft landing. We're pricing in higher yields because the economy is proving resilient to be resilient. But the fact that we're doing that probably means that it won't be.
Yeah, and look, I think, you've got to accept that if you're going to get bear steepening, there's going to be pain. And if we're not going to get a steepening via the front end of the curve, where the Fed is forced into cutting, then I think there's going to be pain for some. But I think that narrative is one of less economic pain and growth returning at the same time as inflation remains high, and perhaps a secondary or a second acceleration of inflation. I do wonder, though, whether the Fed and other central banks will make the transitory mistake again. I think this time around they will pull the brakes fairly hard if inflation starts getting away from them.
All right, Eddie Vanderwalt from our MLive team and Bloomberg's Justina Lee, thank you both very much for joining us. Coming up, we're going to have more on our question of the day. Why are yields higher? Emmanuel Cao, Barclays head of European equity strategy, is going to join us next. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Once summer's over, that first cold snap starts to hit, there's probably going to be a big global oil producer who suddenly decides that they don't have the supply they thought they had. The price needs to go up. And I think we need to stop being surprised by that. Looking at a world where Russia's at war with Ukraine, I think that we're going to see them have a lot of supply issues in the winter that really, really, drives up the price whether we like it or not. And that does have an impact on yield.
Sarah Kearns, Managing Director, Clio Capital, speaking to Kaylee and I a little bit earlier on. Her stab at the question of the day, why are yields higher? She's certainly pointing us in the direction of oil prices. Let's get another go at this question. Barclays Managing Director and Head of European Equity Strategy is, of course, Emmanuel Cao. He joins us now. Emmanuel, this is not your wheelhouse, but it seems to be impacting what you do. Yields are higher. Why do you think they're higher?
Well, we're seeing they're higher because the markets are listening to the central banks and to the big one. Since the Fed somewhat wanted the market to listen to her last week, and the Fed has been forcing a hawkish repricing in rates. Now, if you understand the rationale for the Fed to be hawkish, it was largely because the Fed has been revising up growth projections. So, today compared to 1 week ago, we have from the Fed forecast of higher growth in the US next year and lower unemployment. So that's why the Fed has been, making a point to convey the message that rates have to be higher for longer if growth is stronger for longer. And I guess, higher growth should come with higher inflation. So look, we're running around in circle here. We have been debating this for most of the past 12 months now. And look, at the end of the day, there is no free lunch. If growth is strong, you should expect inflation to stay resilient and central banks to have to maintain a very restrictive policy as long as necessary.
Okay, so if that's the case, if we are going to live in a higher for longer world and borrowing costs are just going to be higher, that would put pressure on at least certain pockets of both the U.S. and European equity market. What is it going to do just in terms of the relative attraction of what you can get in the bond market versus the yield offered by equities?
Clearly, the bond market is becoming much more attractive to us. And we've been quite cautious as a house on duration on bonds, but now, we pretty much had a 40, 50 basis point repricing on the short end of the curve in the last couple of weeks. So clearly the bond market is reflecting now a much more reasonable outcome in terms of policy, inflation, and growth. So yes, we find more and more value in fixed income. Now, I guess what will dictate the direction of travel for the equity market is whether the economy, whether earnings can stay resilient in the environment of higher interest rate, which is what we have seen so far this year, or do we start to see something breaking? Do we start to see higher interest rate hurting the economy? So I think, I'm not sure the market is going to give it the benefit of the doubt because, as we know, most of the past tightening cycle ending in tears and hurt the economy, hence the equity market at the end. But what we've seen so far is basically equities being able to shrug off the threat of higher rates because earnings have been quite strong. So I think the Q3 earnings season will be quite important as the next catalyst for the market.
Emmanuel, the PMIs are clearly showing weakness. The PMIs, even on the services side, are starting to show that Europe is struggling. companies have been able to keep their margins looking good, as you've just been talking about, because the top line has been strong. Do you think the top line will be able to continue to be as strong? Where does the pain start? Where should we be looking for? Is it at that top line? Is it in margins? Where do you think in the next earnings season we should be looking?
Well, PMIs have been a very misleading indicator of the cycle so far, because I think they failed to capture the impact, the benefit of higher inflation on top line and earnings. Earnings have been quite resilient for pretty much the past 12 months, despite PMIs going down. So I think, as long as we have, inflation relatively high, that should come with a bit of cushion to kind of top line and earnings for the corporate sector. I think, what the market will be looking for is any kind of sign of demand pressure in some end markets. We've seen manufacturing being pretty soft already, but we've seen again that a very strong consumer, very strong services. So do we start to see cracks in consumer end market, whether it's in Europe or in the US? That's something I think the market is going to watch. And then I think, do we start to see companies or consumers talking about, well, not being able to pay the debt? Do we have some credit issues that start to have margins and profitability?
To the idea, though, of potentially starting to see some cracks in demand on the part of the consumer, are you worried at all about luxury, Emmanuel?
We do. We've been worried for some time. So we've been, I think, trying to find a balance in portfolio. We still want to have some risk in some cases, but we don't want to overpay for risk. So we try to combine cheapness or low valuation that can basically, give us a bit of a hedge against higher interest rate, and low earnings expectation. That's why we like the financials and we like the commodities. They are cheap, and we think earnings prospects are quite positive. On the other hand, we are much more nervous on the expensive cyclical sector, which are still on very high valuation, have a bit of long duration bias, but also have earnings risk if things go wrong. So we've been reducing we cut already luxury good in March, but our analysts were turned more cautious on some of the prominent names in luxury a couple of weeks ago. We are bearish on industrials. We've been cutting tech in August as well. So we want to have a bit of a balance in terms of cyclicality, but what we are much more focused on in valuation and how much we have to pay to express earnings risk or view.
LVMH is down 20% from its peak. I guess a case in point. Emmanuel, let's just talk about between now and year end. Is cash going to be the king between here and year end? What do I need to do to outperform cash if I want to be in the equity market?
Well, I mean, it's going to be very hard to beat cash risk adjusted, but a lot of the clients who speak to institutions cannot be 100% cash. So they still need to invest in a world where cash is a very competitive asset. So within the equity market, we think you want to be in cheap stocks sectors which have an earnings catalyst, hence the commodities, the miners, maybe the banks, the financials. That's what we like. We also want to have sector which can generate significant cash flow. We think healthcare is a good one, for example. And on the other hand, we don't want to be in expensive long duration sectors which have an earnings risk in case growth were to be slowing. Now, if I look at the different regions, of course, US is a safe haven. So very hard to see money going back into Europe without any kind of sense of inflation peaking or Chinese growth going back up or picking up again. But I would just flag that the valuation of the US market and this very stretched, crowded consensus tech part of the market looks a bit vulnerable to more sustained repricing higher in interest rates. So, hard to see Europe outperforming the US if we are stuck in this stagflation, but from a relative positioning standpoint, valuation, we see Europe offer some interesting balance against what is a very US-centric global equity market.
All right, Emmanuel Cao, Barclays Managing Director and Head of European Equity Strategy. Thank you so much for joining us. This is Bloomberg.
analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
The American market is slowing down due to the reality that department stores are really in a suffering situation at the moment, plus the reality that spending is slowing down. The expectation that China will come into the market in a big way after the closure that they have suffered from in the last 2 years is not happening.
Rashid Mohammed Rashid, the chair of Valentino, the founder of the Alzra Investment Group, talking to Bloomberg a little bit earlier on today, basically mirroring what is being said across the whole of the luxury space at the moment, Kaylee. You've heard it from Richemont, you've heard it from all kinds of places, even LVMH, which is down 20% from peak to trough, talking about the weakness they are now seeing. Richemont talking about it being a 10-year unwind of excess that is going to take years to come. And I tell you what else is really digging up the sector as well today. Those comments from Valentino certainly having an impact as well. But a note out from Bank of America, which has had quite a big impact on Kering today, having a really big impact. Bank of America downgrading that business on its consumer profile. It doesn't see it as quite as high end, so it sees it as being more exposed to this consumer slowdown that we're seeing. That is a street low price target of 430 euros on Kering. I'm told, Kaylee, that the Gucci show, the new Gucci show, went very well at Paris Fashion Week. You cannot see that being reflected, though, in what is happening with the stock market right now.
Yeah, I guess it's a question of how good is a good collection if you don't have people who have the spending power in order to purchase those items. And that really is what this concern comes down to, Guy. After so long of seeing resilience in consumption, are those cracks starting to emerge, and how is that going to weigh on those names, not just in terms of the European consumer base or the U.S. one as well, but as Bank of America is pointing to, China?
China's a big factor in all of this. None of these engines are firing, and I think that's the big problem. And the more exposed you are further down the income scale, that gets worse and worse and worse. I do wonder, though, whether or not, if we see a stock market rout, whether that starts to affect the upper-end consumer as well, which has thus far been much more resilient in this whole process. So I think the financial market feedback loop into all of this really quite significant. Kering, the luxury sector, all under pressure. The close is coming next. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. we will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
On the next episode of Hello World, I head to Los Angeles, meet some robots, and eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals, or 10 p.m. Eastern on Bloomberg TV.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
It's a Monday, it's a holiday, but it still feels like important things are happening. The European bond market story, the global bond market story, is a significant narrative that feels like it hasn't really rippled fully yet out into other asset classes. Yields are climbing and climbing fast, particularly at the long end, which is fascinating. European equities are under pressure today. The FTSE's down by 0.8%. Similar for the CAC. DAX is down over 1%. Series of big sectors are under pressure today. Luxury's down. Travel and leisure's down. It's more of the leisure than the travel. You've got the big mining stocks are all really under pressure as well. All of this coming together to produce really quite a negative session. Now, volume has picked up as the day. A bit of a lag in volume midday is beginning to pick up a little bit now, which I think is interesting as well. Keep an eye on that volume narrative. Are we starting to see a pickup in volatility as well, which could make this into an even more interesting week? Kind of feels like interesting things are going to happen. You've got a lot going on, a lot of factors coming together. Want to talk about Airbus a little bit, a stock that I pay quite a bit of attention to. Fantastic team here at Bloomberg monitoring what is happening there. Looks like, according to those guys telling me this, we could potentially see a big Airbus order coming through this evening, 350s. We think it could be coming out of Air France. We're going to wait, we're going to watch, we're going to see what happens there. But also significantly, watch for news on management reshuffle. I think the FT had the story earlier on. Maybe going back to the kind of Tom Enders Breguet kind of model with Faury and Scherer at Airbus, maybe making it a little bit more manageable in terms of management bandwidth. Anyway, keep an eye on Airbus. That stock down by 0.8%. Kering is being battered today by that Bank of America downgrade, really under significant pressure. Despite the fact that the show at Gucci, apparently I'm told, I don't know about these things, was quite good, but nevertheless, that stock coming down quite hard. Rio Tinto, I mentioned the miners, look at it, down by 2%. That's the China story. That's what's happening with Evergrande. All of this coming together, everything seems to be coming together right now. That's just Monday. We've got a rest of a week to get through as well. Let's talk about what we're going to be looking about for the next few days. Rate decision out of Hungary. I'm going to be going Tuesday, maybe Wednesday, actually more of an important day to the World Aviation Festival. That's taking place in Lisbon. What's happening with the airlines and the demand story? We're going to be talking a lot about that. Got the Spanish PM vote, Prime Minister's vote on Wednesday. Thursday, we get into the CPIs. This is where I think it gets interesting from Europe. Spain, Germany, CPI. Eurozone data out Friday. What is that CPI data going to tell us? Christine Lagarde very clear today, talking about the idea. She ain't talking about cuts just yet. The lady is not for turning when it comes to the rate path right now. Let's talk about how important, therefore, this CPI data is going to be for the markets and what messages it's going to bring. Sebastian Wismara, financial economist at Bank of New York Mellon, joining me now on set. Nice to see you.
Nice to see you.
CPI end of the week. Lagarde's making it very clear that rates are going to stay up. They're going to stay there for a while. What is the CPI going to tell us about whether or not she's going to actually be able to achieve that?
Well, the CPI is going to be pretty important, as you've mentioned. Ultimately, the message of high for longer is going to have to be validated by the data. The CPI indeed is the data that investors will look at for the euro area, given the single mandate of the ECB. We don't expect a particular large surprise either way. We think that this inflation process is in place in the euro area for the coming months, but for this one in particular, we don't expect a large surprise. So more to come over the coming months in terms of ECB news.
Well, and Sebastian, as we think about what higher for longer actually means, for how long do you think the ECB is going to be able to keep rates high? This is where a recession forecast, I would think, comes into play, unless you think the ECB is going to be willing to tolerate that because of the inflation fight.
Well, our view is that rates will remain high until at least the second half of 2024, despite the fact that we see inflation coming down towards 2%. The economy has weakened, but inflation remains high, and it remains much higher than target. So the ECB is trying to manage that growth risk in the context of inflation that remains pretty elevated. And again, it's a central bank that has a single mandate on inflation. So we think the ECB will be biased in terms of cutting later than other central banks, if anything.
Is this stagflation? Are we there yet on the stagflation debates? Torsten Schlock at Apollo, I keep bringing this up, is basically saying this is where Europe is now. And in reality, what that means is that the central bank playbook is fairly straightforward. You just have to keep rates higher, and at some point you've got to hope there's a spark that ignites growth. But you have to deal with the inflation story, and you have to deal with it in a fairly clear and decisive way. And in many ways, that mirrors what Lagarde was saying today. It's too painful. We have to get it down. That is our job.
I think that's right. Unfortunately, I think ultimately the ECB will manage risks that way and will probably tend to over-tighten the economy. So at the moment, the economy it is in a sort of stagflation environment where growth is very low.
Yep.
I mean, the basis from where it starts, the euro area is a lack of growth, and inflation remains high. Disinflation is in process, but it's still too high for the ECB to relax. And that, to me and to us, means that they will keep rates too elevated for long until growth deteriorates more and more sharply.
Earlier, Sebastian, our question of the day was why exactly yields are higher, and we had a whole conversation about how oil and energy is factoring into that. How do you think the ECB is looking at the energy picture, given how problematic it has been for Europe specifically?
Well, energy is an interesting story. Traditionally, central banks tend to look through these type of energy shocks. However, I think we're in a different situation at the moment. Again, the starting level of inflation matters quite a bit, and what also matters is that inflation expectations tend to be fairly correlated with energy prices. So the ECB will be looking at this particular shock with a hawkish lens. Again, it's another shock that contributes to the idea that they will remain, they will keep rates for high.
Do you think they're feeling validated right now? Rates are going up. They want to make clear that the message that they're trying to get across is that we are not going to be cutting. Lagarde spelling it out time and time again. She's trying to. She doesn't want to pause to turn into pricing of cuts. Do you think the central bank is feeling that their communication is working, and the way they can see it's working is because yields are going up and going up across the curve?
Yeah, I mean, the fact that yields are rising, it's tightening financial conditions, which is in line with the message that central banks, broadly speaking, around the world, particularly in developed markets, are trying to deliver to the market. The ECB obviously doesn't want an excessive tightening of financial conditions, but I think the moves that we've seen are in line with the message they provided. Obviously, there are other news around the world. The Fed has provided a hawkish message to the market, and I think part of the moves, even in Europe, are driven by what we've seen in the US.
Great to see you. Thanks for stopping by to see us. Interesting week coming up. Sebastian Vismara, financial economist, joining us at Bank of New York Mellon. European stocks done for the day. We're off the lows. Little tick higher during the auction, but we are still finishing firmly in negative territory, as you can see. Let's call it down circa 1%. I'm being maybe a little bit too negative, but the DAX certainly down by that kind of an amount. The inflation narrative, certainly a big factor in what we're seeing with yields right now. Oil playing its part. Are we heading for 100? There is but one person to ask this question. We head now back to the 2023 American Energy Security Summit that is taking place in Oklahoma City. There is to be found there one Alex Steele. She is joined now by by Continental Resources President and CEO. Alex.
I have to say, I'm having a lot of fun. It is a lot of fun talking to everybody here. That's right. Doug Lawler is Continental Resources President and CEO. He's promised me an interview like, 8 years ago, I think. He's finally making good on that, so I appreciate that. All right, Doug, let's just start off with Continental now being private. You're not constrained by the public market. Does that mean you're just going to go pump everything there is to pump at Continental?
That's a great question, Alex. It's a great thing being a private company. No, it does not mean that.
Okay.
We are investing at a very prudent level, consistent with our cash flows. Just to go and invest and be producing as much as we can is not how we generate the greatest value for. We still have owners. We still have shareholders. We're interested in investing at a pace which creates the greatest amount of value. Being free from a lot of the public market constraints gives us the ability to think about value and how do we grow value for the long term.
So at $100, do we think we get to $100 oil? And does that change how Doug looks at things?
I think we absolutely will. I think we're going to continue to see volatility in the $80 to $100 oil price environment right now. But I think the higher price is a reality that we're going to have to deal with as we think about our investments and we think about the energy needs of the globe. And the fact that we know today that it's being more broadly recognized that oil and gas is going to play a key role in our sources of energy and that energy stack over time as projected.
So help me understand then. So the idea is that that you guys want policy to be supportive of oil and gas because we need it in the energy transition. But then you're still going to be capital disciplined and do things in a smart way. So what gives? Like, what's the problem then? If we're keeping it, production's almost near a record high, and you're still producing a bunch in near records in the Bakken, what's the problem?
So the key today is I don't think that there's a broad enough recognition that this is a depleting resource. We still have a very strong need for oil and gas to power the energy needs of the entire globe. And we know by all the projections, whether they be government or whether they be by industry or research associations, that oil and gas is going to play a significant role, greater than 50% oil and gas specifically, all the way through 2050 and beyond. The problem we have, and what we need to be most concerned about, and we don't get enough attention on, is there's been a fundamental lack of investment in the last 10 years in exploration. And so when you talk about mobilizing resources and bringing more oil and gas to production, we're fairly balanced today, and that's good. The market's fairly balanced. But what we're not doing in a depleting resource is investing enough in exploration for future energy needs.
So what I'm hearing from you is that it's not so much you need permission to drill, you need permission to explore. That because productivity has become a problem in U.S. shale, you're not going to keep getting more and more out of the asset. You have to keep pumping just to keep production flat. Is that a fair assessment?
It is a fair assessment, but being able to have the permits to drill for exploration are very, very important in the United States, onshore in the shale areas.
For federal lands, which is where that's been an issue before. But you guys are the tech guys. I mean, you're pioneers. You're like the shale cowboys, you know? Like, you have your cowboy hat and you do cool tech stuff that gets more oil out of rock. Is that underselling your ability to keep doing that?
No, not at all. We will continue to innovate and improve in using technology. The horizontal drilling, as you know well and have heard so much about here recently with Harold's book and Game Changer, the industry's made huge advances there. We're also seeing now where the average lateral length in horizontal shales has been 2 miles. Now we're going to 3 and looking at 4. So those are things that are going to continue to provide an opportunity for good investment and good production. But the key is that there's been underinvestment in exploration. And if we don't start thinking more about exploration and that investment here in the U.S. and globally, this depleting resource is going to be a challenge and will result in higher prices.
So let's go to laterals for a second. So for non-oil nerds who are listening, it just means like how long you're going to drill this way underground. 3 to 4 miles, that's a long way. There's like a lot of technical risk that can happen with that. You mess up one thing, it's huge.
Yeah.
I mean, is the risk really worth the reward on that?
It is, because what it's doing is it's enabling us to access additional rock that we can actually stimulate and produce. So instead of, we're vertically developing in most of the oil and gas plays in the U.S. reservoirs that range from 10 to call it 14,000 feet, just on average. And then we'll actually turn and go horizontally another 2 miles, and now looking to extend that.
Which also brings me to cost, because that's got to be really expensive. Like, that's more horsepower, that's more casing for your tubing and all that kind of stuff. What's expensive right now for you guys? Like, what's going to be sticky costs for Doug Lawler?
So we obviously have seen increases in costs associated with inflation, services, labor, but we also the steel, water, sand, all the kind of raw elements that go into our drilling and development programs have been higher, and it's going to be a constant challenge. And when you think about these costs, it is not expensive or not inexpensive to bring energy to market, and significant risk, as you described, is taken.
And how much of that's sticky?
I think that it's all fairly sticky when you say, the kind of term sticky. I mean, do we see opportunities with technology to continue to improve our costs? But a lot of what's taken place here in the past few years, we're seeing it to be a little bit more resistant than what we would have liked, and being able to claw back some of those inflationary gains that we were recognizing.
So, okay, if you're here, you're going to make a pitch for we need clearer, more consistent policy to be able to explore, to get the oil so we don't have volatile prices between 80 and 100 plus. What is that policy? What about the people who are going to say, yeah, but then you're just going to pollute the environment? Like, you're not going to help us. Does that mean you have to go full on in carbon management then to kind of sell that story?
Well, the oil and gas industry has made tremendous progress with respect to Scope 1, Scope 2, and pushing to Scope 3. We're also doing things here in the near term, looking for how we can help other industries, how we can do things in the agriculture space, in the retail space. We are going to continue to make improvements there, and it's just not fully recognized what oil and gas is doing for our total energy needs of the United States, and how we're working so hard to improve the environment. Natural gas, calling a bridge fuel, a transition fuel, has made a huge difference in reducing the carbon and the reliance on coal in the United States. It has to continue globally.
For the IRA, Inflation Reduction Act, what do you like in that? What do you hate in that?
I dislike anything that discourages continued investment.
But does it do that?
Well, it doesn't. There isn't anything in there that's helping to incentivize our continued development. And this, again, as I had highlighted, the fact that we are not recognizing that energy, our sources of energy, are going to include oil and gas for the long term. We need to be investing more in exploration. This depleting resource is critical and it's essential to our everyday life.
If we don't hear your message, if the politicians don't hear your message, what happens to the oil price? Like, are we going to 150 again? Like, what is going to happen?
Instead of seeing $80 to $100, you're going to see 120 to 150.
Ooh, okay, so back 2008, that kind of scenario.
Well, it's going to be, it ties back to, as we have been talking about, the Permian Basin has been a tremendous growth basin for the oil and gas business here domestically, but also a great impact globally because of that supply that's been mobilized there. The Eagle Ford, the Bakken, other strong oil-producing shale basins in the United States, they've reached their peak. The Permian Basin will reach its peak also, and when that happens, that's going to send a shock through the system that the United States can no longer grow a major basin. And when that happens, without encouragement and good policy towards energy investment, the opportunity and where companies will invest in exploration, you're going to see more pressure on price.
Doug, it was worth the wait. Look, I appreciate it. Thanks
Alex,
very much.
So great to see
Doug
you.
Lawler,
Thank you.
CEO and President of Continental Resources. Guys, back to you.
All right, thanks very much to both Doug and Bloomberg's Alex Steele. And of course, Alex is going to be back for more later today. She has a one-on-one interview with Republican presidential candidate Nikki Haley. So don't miss that at 1:30 p.m. New York time. You can also follow it on Live Go on your terminal. But what you can get right here coming up next, we're going to take a look at the health of commercial real estate. Mark Gibson, Jones Lang LaSalle, Capital Markets America's CEO, joins next for Money Undercover. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere.
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
From New York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
We turn now to this week's Money Undercover for valuable insight into alternative investments. We'll get an inside look into the world of private debt, private equity, and real estate. Here's Lisa Abramowitz now with Mark Gibson, Jones Lang LaSalle Capital Markets, America's CEO. Lisa.
Thank you so much, Kaylee. We originally started Money Undercover before the pandemic to take a look at some of the areas that were less transparent in capital markets, that were just attracting so much money. And now we take a look at those areas that are still attracting quite a bit of money, although, and quite a bit of notice in some other ways. Joining us now is someone who can answer some questions that people keep raising about, in particular, commercial real estate at a moment where people are wondering, what is the next shoe to drop? Could it be this one? Mark Gibson joins, Jones Lang LaSalle Capital Markets, America's CEO. I want to start there, Mark. I mean, you've heard all of these discussions about how commercial real estate is the next shoe to drop. Do you think that that is an accurate description of the tsunami of potential defaults that could be hanging out there?
Lisa, thanks for the question. I don't, simply because commercial real estate, like every asset class, adjusts to the cost of capital. And as a result, just given the Fed's fight against inflation and the cost of short-term capital increasing at a very rapid pace, everyone has had to step back and reassess values and deal with what every industry is dealing with. So we don't see this tsunami of defaults and issues in commercial real estate as is being portrayed, primarily because most of the investors in commercial real estate have been conservative in their capital constructs, and they are beginning to think about a little bit higher for normal and adjusting accordingly. You will have tactical.
Wait, hold on a second, Mark.
Strategic.
And I'll let you continue in 1 second. But the way that you're talking about it, readjustments and valuations, the real estate doom loop is how the Wall Street Journal just described it. And we're looking at office REITs falling the most since 2020. We're looking at yields that are pricing out a lot of people from the real estate market, with the transactions falling off a cliff. Is this a market right now that is functional, or would you say that this is sort of a broken market in terms of price discovery when it comes to some of the loans and transacting?
I think anytime is a great question. I think anytime you get a rapid increase in the cost of capital, you have what we call a bid-ask gap. So you have both sellers and buyers trying to figure out who is right. So do they believe that the cost of capital will continue to increase, or do they believe we will normalize at a different level? And therefore, if you're a seller, you're going to believe the latter, and if you're a buyer, you're going to believe the former. And the question is, they generally need more data for a period of time to determine, well, what is an accurate cost of capital? Where do we see it going? And for today, in today's world, what we're counseling people is just take a breath and think about, why are we where we are? And the common enemy is inflation. Do you believe the Fed will conquer inflation? Most long-term investors do. And the only debate is time. So once that occurs, then what is the risk we're underwriting? And most of these long investors are beginning to discount inflation risk and really focus on recession risk, because historically, that is what happens when you have such a rapid increase in rate moves. So there is a normal bid-ask gap pause. So transactional volumes in the U.S. are down 60% in commercial real estate, and that is normal. But we're beginning to see that change, particularly as people adjust to the cost of capital and we have rationalization of pricing. So we're beginning to see transactional volume inch up as a result of that.
What about in office real estate in particular, given the fact that it's not just inflation, it's also the idea that occupancy is dramatically lower than where it was pre-pandemic?
Occupancy, we could spend an hour talking about occupancy in office buildings, but the narrative is going to change significantly in our view over the next 12 months, which is work from work will be the new mantra. And we're beginning to see that take place across every industry in commercial real estate. And the primary driver for that is falling labor productivity across every industry. And the need for training, the need for collaboration and teamwork and culture is really beginning to take precedent in every industry, again, across the United States. So we think the narrative on office is going to be considerably better in the next 12 months, but there is going to be a vast stratification of values across the office sector. And what I mean by that are buildings that have been constructed over the last 10 years or so are going to get preference in terms of occupier interest, meaning tenancy interest and where they go. So there are going to be quite a few haves and have-nots in the office sector and commercial real estate.
Mark, just quickly here, we only have about a minute left, and I'm wondering how far you think we are in this downdraft, particularly in the office space area, which is down, I believe, about 30%, even in less liquid markets. How much further do we have to go?
One never knows. So it depends on the cost of capital and where we see the inflation risk, Lisa, there. But I would tell you from our perspective and where we're seeing the market react in terms of actual transactions taking place. We just announced a fairly large trade in New York. There are many more that are happening. Our belief is that we are at bottom. From an office valuation perspective, it's a very general statement. As we stated earlier, there are going to be significant have and have-nots. But generally speaking, I think the office sector has found a bottom level.
Mark Gibson, thank you so much for spending the time with us at a time where everyone is wondering what is going to be the ramifications, particularly for banks that own a lot of real estate. Thanks again. Over to you, Guy. Thanks so much.
Great stuff, Lisa. Thank you very much indeed. Lisa Roundwitz. Catch Money Undercover, same time Mondays, here on Bloomberg Television. What have we got coming up next? The AWS CEO is going to be joining Bloomberg Technology. Caroline Hyde and Ed Ludlow next. This is Bloomberg.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's world headquarters in New York.
And I'm Ed Ludlow back in San Francisco. This is Bloomberg Technology.
Coming up, Amazon pushing further into the world of generative AI with an up to $4 billion deal with Anthropic. We're going to be sitting down with Amazon Web Services CEO Adam Selipsky to discuss.
And Hollywood screenwriters strike a tentative deal with studios to end their months-long strike. We break down everything you need to know about the agreement.
Plus, Apple's cheapest iPhone 15, well, it's winning over buyers with wait times for the device almost doubling compared to this time last year, Ed.
Yep, let's get straight to our top story. Amazon will invest up to $4 billion in the AI startup Anthropic. It is a complicated deal where Anthropic will move its software to AWS cloud, but also the training of its future models to Amazon's proprietary silicon. We are talking about the AI accelerators Trainium and Inferentia. This is kind of an interesting move for Amazon that's done so much work internally on generative AI tools, but now it looks to a third party. Of course, the Claude large language model is one with billions of parameters. It is one that was already available within Bedrock, the platform that Amazon through AWS offers to build your own LLMs or take advantage of pre-built skeletons of LLMs. There are many questions to be posed about the strategy here from Amazon and AWS with regards to generative AI and what's going on with their proprietary tech. We want to welcome our Bloomberg television and radio audiences worldwide. Joining us now, Amazon Web Services CEO Adam Selipsky. And Adam, welcome to Bloomberg Technology. I want to start with some of the mechanics of this deal. Does Anthropic still pay Amazon to use AWS cloud? Or is it structured such that the investment that you make in Anthropic is in the form of cash and credits for AWS cloud?
Good morning and thanks for having me. We're very excited for this expanded relationship with Anthropic. And the investment is a financial investment, as you say. And in addition, Anthropic will be training future versions of its models and running its models on AWS using our Trainium chips and Inferentia chips. Those models will be guaranteed to be available for years to come in our Amazon Bedrock managed service for LLMs, which provides a very wide choice of models. And AWS AWS customers will actually receive early access to key features in Anthropic's models in the future, such as fine-tuning and customization of models. In addition, Anthropic's got very talented technical teams, and we anticipate working closely with them to actually improve future versions of our Trainium and Inferentia chips. So there are a lot of different benefits for our joint end customers from this relationship, and we're very excited to be leaders in this together.
Adam, there's a lot of emphasis on moving a maker of foundation models at that scale onto your proprietary silicon. How quickly will Anthropic start running AI workloads on Trainium and Inferentia?
Well, we've been working with Anthropic. They've been a customer of ours since, I think, their founding over a couple of years ago. And so they use a variety of different technologies for a variety of different workloads on AWS. They'll be using GPUs on AWS, and will also be using large quantities of Trainium and Inferentia. So I think everything's going to move very quickly, and it'll all be a mix of technologies depending on their needs at the time.
Adam, what's the mood like within Amazon and AWS this morning? There are lots of talented engineers that have been working on large language models, generative AI tools internally, and now you're turning to a third party who's highly regarded as a leader in building foundation models.
The mood here is great. We are a company of inventors who we love to build, and there's never been a better time to be a builder at AWS than right now. And as I mentioned before, a big part of our strategy in AI, and generative AI specifically, is all about customer choice. And there's not going to be any one solution that works for all customers, for all use cases. And Anthropic has done an amazing job. They're clearly a leader in this space. And it's really important for customers that we continue to generate new capabilities together. At the same time, really one of the hallmarks of our Amazon Bedrock managed service for generative AI is choice. And so Amazon is going to continue to build its own Titan models, which are going to be available later this year. Obviously, Anthropic's models are prominent in Bedrock, and we'll have models from other leading providers as well, as we have today. So it's still an amazing time to build here at Amazon. We think our models are going to be great as well, and it's about customers choosing the right tool for the job.
Talking about choice, and I just want to re-welcome our TV and radio audiences with Adam Selipsky. What's so notable is that, well, Anthropic took a chunk of change, $400 million worth, from Google already. And I'm interested as to how you feel that is perhaps a concern for you or not, the relationship that Anthropic already has with a previous cloud provider.
No, we feel great about the relationship with Anthropic. It's been a good relationship, and I think today's announcement just makes it a deeper and longer term. Anthropic will use AWS as its primary cloud provider for mission-critical workloads, including building foundation models and doing AI safety research, and will run the majority of its workloads on AWS. So we feel great about being able to provide the capacity and the expertise, and of course the security, the enterprise-grade security that is so important to AWS customers. And we also feel great about working with Anthropic to make
yield, but without of Treasury, the long-dated part of the curve going down again and again.
But you have reinvestment risk. And also, if you're betting on a recession, I would think you want to move out the curve. Let's ask somebody who knows more about this than me. Joanna Gallegos joins us, Chief Operating Officer and co-founder at Bond. It's the first ETF provider solely focused on fixed income, and you cut the industry, the asset class, into slices so people can pick and choose. I've been hearing a lot more people say they're going out the curve. They want more duration because they're worried about all the headwinds facing the economy. What are you seeing?
Yeah, so you will see, as Eric mentioned, that the top flow into the Treasury segment has been on the long end of the curve, but that trade has been getting clobbered over the last 3 months. And I think that's just a bet on the way people thought that the Fed would pivot and change, and it hasn't come to bear in 2023. It didn't happen in 2022. At Bond Blocks, we don't foresee a recession happening in 2023 or even mostly into 2024. So that may not be where your best allocation is in fixed income right now. We think, importantly, you should be thinking about adding as much quality risk in fixed income into your portfolio so you can achieve longer term returns that people were trying to do with equities for the last 10 years in a much less risky way.
So to boil that down, are you saying it's better right now to take credit risk rather than duration risk?
We're definitely telling people a lot of our products manage duration for that very reason. Like, get every fixed income portfolio manager, Joanne Bianco at our firm will tell you that's the one thing over 30 years she did, is manage the duration out of her portfolios and looked for the quality risk and looked how to add it smartly. So it's not about making a bet of bringing risk on or bringing risk off. It's about making sure you're understanding how interest rate risk is really persistent in your portfolio right now. But when you look at credit risk right now, you look at corporates and specifically in high yield, you're coming, not only did we start 2023 from a position of strength, but that resiliency and strength in the balance sheet has endured and looks like, you mentioned refinancing risk, it looks like into 2023 and 2024, you're not going to see a spike in defaults. And you're going to see companies weather this through because their balance sheets, their interest rate coverage is incredibly strong. It's a very, very different place to be this late in the cycle than others had before them.
So I get this. You know, I always bring up XCCC, which is the most junk bond, junk ETF that you can ever find. Almost 100% in all junk bond ETFs, triple C rated.
Yeah.
It's the second best performing fixed income ETF of the year out of 600.
Yeah.
But the flows just aren't there. Why aren't people jumping at something that's up 12%, yielding 12%?
I think people need to remember the fundamentals and the characteristics of fixed income. They're forgetting this. They haven't looked at the asset class for a long time. One of the reasons Triple C is performing so well is because it has a very high coupon. And when rates are now double what they were before the Fed started raising rates, what that does is it provides an immense amount of cushion in your portfolio. And so when you're looking at these rates and this coupon income, we looked at high yields, and for the last 10 and 20 years on an annualized basis, it's the coupon income that was really driving the returns in these fixed income instruments. And so you're right, people need to familiarize themselves with the characteristics of something even as interesting as Triple C. You couldn't trade the category, you couldn't trade the exposure before Bond Blocks launched this fund, and now you can see it and you can interact with it. And I think the important thing to remember about Triple C is it's not, if you're thinking about adding more equities to your portfolio right now, you're taking on whatever the volatility of the equity market is. You just put up some interesting stats. But if you look at fixed income and you look at Triple C, you're getting, especially in broad-based high yield, you're getting half the volatility as you are of the S&P 500. Yet you're getting a lot of yield and a lot of return because that's what's driving your
I always hear fixed income people say there's not enough yield. Spreads are too tight, right, to take that risk. And if we're looking at a situation where the consumer has no more savings, putting everything on credit cards, delinquencies are rising, gas prices are high, strikes are going on, government shutdowns, wouldn't you expect defaults to start kicking up?
Well, actually, the defaults are not expected to spike over long-term averages, which in high yield is, on average, like long-term fixed income defaults are around 4 or 5%. So we're not expecting it to do that. It hasn't done that yet. There are all of those factors, but there's still resiliency and strength through even what we see. There's strength in the consumer. There's strength in balance sheets of corporations. Where you want to really think about is like, this started in 2022. We're nearing 2023.
It's not expected the Fed's going to do a huge pivot in 2024. So are you going to look for the next 2 years and look away from these yields in fixed income, which are clearly higher for longer as of last week? And so it's just sort of not a FOMO trade here, which is one of Eric's favorite topics, but it's more of reminding yourself of how fixed income works in your portfolio. And now you can dial it up or dial it down with bond blocks.
Well, on the topic of high yield, let's talk about a product that you just launched. We're talking about the Bond Block USD High Yield Sector Rotation ETF. The ticker there is HYSA. And this is interesting because it's an ETF that holds your sector-specific high yield funds. Talk to us a little bit about, out of the gate, what does the allocation look like and how often you think this ETF will turn over?
Yeah, so one of the first things that people said about our product suite of the high yield sectors is like, what do I do? How do I put them together? And so we responded to that feedback with clients, and we worked with Macquarie Asset Management to launch this fund. And so you want to think of it sort of as almost a way to replicate your broad-based ETF exposure in high yield, but with a little more intention around how to underweight and overweight some of these sectors as we're going through this cycle. So you wouldn't be surprised right now that energy is overweight, industrials are overweight, non-discretionary consumer is overweight. And so you're able to sort of like see some of the trends that are going on with companies through this period reflect your current market. And that's, I think, what people wanted to hear. They recognize that we were saying there's dispersion among the sectors and there's opportunity amongst the sectors, but it can be very hard to put that together. So we worked with, an active asset manager in Macquarie Asset Management, and they're helping us manage this fund. And that's what HYSA is. It's how do you invest in high yield right now.
All right, very interesting stuff, Joanna. Thanks so much for coming in the studio. Joanna Gallegos, she is one of the founders of Bond Blocks and talking to us here in our New York headquarters. Coming up, ARK is betting big on Europe with the new ETF acquisition. We'll dive into the details next. This is ETF IQ on Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with a risk parity ETF. We're taking a look at ticker RPAR right now. We know that this twin sell-off that we've seen in stocks and bonds has really hammered the 60-40 portfolio. It hasn't been too good for risk parity strategies as well. This ETF last week sank to its lowest level in almost a year since last November. We'll see how low that line can go. But let's also talk about muni bonds, because those higher yields that we're talking about, at least in the muni market, starting to attract some buyers. You're taking a look at ETF MUB right now. It saw its largest weekly inflow since May 2022 last week. So clearly, at least in the muni market, some bond buyers looking to buy the dip. But let's also talk about Europe, Matt. I know it's near and dear to your heart. We're going to take a look now at assets in the European ETF market. As you can see, it's been a pretty steady march higher over the last decade or so. And that steady march higher, that growth opportunity that could exist in Europe, is one of the big reasons why we saw Cathie Wood last week actually come out with some rare M&A news. She's buying asset manager Rise.
Because there's good growth over there. I mean, we always talk about how big the ETF industry is, and I think it's important to look at it globally. If I go onto ETF Go, I have to X out equities, X out United States, and then
Home
I
bias is real, Matt.
10.3 trillion in assets in the class, 17 trillion in fund assets. All right, let's talk about this more with Rebecca Sin, ETF analyst at Bloomberg Intelligence. She joins us live from Hong Kong. Rebecca, what is the growth like in terms of, I feel like Eric and Katie ignore the rest of the world. So it's great to have you here. What's the growth like in terms of, in comparison to the US, if you look at Europe, if you look at Asia?
So first, I'd like to give a shout out to Matt. You always mention Asia. I know that, ETF IQ is very US centric, but if we look at the growth and compare Asia Pacific and Europe ex-USA, Asia Pacific is currently at $1.3 trillion. Europe is at $1.5 trillion. But we believe that Asia Pacific may soon surpass Europe because there's so much growth coming out of Asia Pacific. If we look at the Asia Pacific region, Bank of Japan leads with assets under management. Japan has surpassed 500 billion in assets under management, and mainland China is closely second with more than 300 billion in assets. And so there's tremendous growth coming out of Europe and Asia Pacific.
Rebecca, you'll have to forgive me. I was born in New Jersey. I live in New York. I'm pretty US-centric, but so a lot of growth in Asia. But talk to us a little bit about the European market and what Cathie Wood might see there.
So Cathie has just acquired Rise ETF. It's a European ETF issuer that has roughly 450 million in assets under management. They are a boutique ETF issuer with only 11 ETF that focuses on sustainability, cybersecurity, digital payments, and they even have a pet care ETF. Their largest ETF is the Rise Sustainable Future of Food with roughly 180 million. But this acquisition ultimately provides GARC a global product offering now. So they have Europe with Rise and they have Nikko Asset Management in Asia Pacific. And so there's very few boutique ETF issuers that do have a global distribution. So now this completes Cathie's global take. But I think where the growth prospect is in Europe is ultimately active management. So we look at active managed ETF, there's roughly 600 billion currently, but we estimate that this could rise as much as 750 billion by year end. And ultimately, a lot of this growth is going to come out of Asia.
I was going to ask about that. One of our BI nerds wrote a story about JEPQ being boomer candy. And I thought it was, well, first of all, what a fantastic turn of phrase. But also, active really is a game changer, isn't it, Rebecca?
Yeah, so active management has really picked up, especially in Asia Pacific. Japan just launched their first actively managed ETFs earlier this month. And if we look at all new actively managed funds and new launches across the region, in Asia Pacific, 20% of new launches came from actively managed fund. And so in terms of where we think the growth is, we think that ARK could get as much as 20 billion in assets under management in the coming years because there's so much demand for actively managed funds. So to give you an idea, Asian investors would oftentimes prefer to buy a UCITS fund for the tax benefits, and the tax savings can be as much as 50 basis points to 2%. And so there's huge demand for actively managed funds. And in Asia, a lot of clients are starting to launch feeder funds or even funds of funds, and they often prefer to have a UCITS option as opposed to the US for tax purposes. And one idea that you may not know is, for instance, Kathy Wood is very loved in Asia, and she has several nicknames. So for instance, in South Korea, her nickname is Money Tree. And so oftentimes her translated name means money tree. So there's money falling off the tree. In China, her name is Mu Tao Jie, which means wood sister. So people consider her a family and they view her as a sister. And so in terms of growth, ARK may kickstart the actively managed space in Europe.
Rebecca, that's so funny because they actually call me Money Tree as well. It's really interesting. Rebecca, really appreciate you staying up late for us. That is Rebecca Sin of Bloomberg Intelligence joining us from Hong Kong. Now, still ahead on ETF IQ, Ed Rosenberg, head of ETFs and funds management at Texas Capital, joining us next on his new ETF. That's next. This is ETF IQ on Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down where we focus on one ETF. Eric, take it away.
Katie, today we got a fun one. Texas, where I used to live. I actually grew up in Texas. Some people don't know that, but great place to grow up. Texas Capital Texas Equity ETF. TXS is the ticker. It's simple. It invests in companies headquartered in Texas. So if you look at this, it's not active, though. It's not actively managed. The fee is 49 basis points, has a little bit of a quantitative design in the index, but basically, if we look at the holdings, you can see what we're going to get. These are companies that are based there. It's going to open up with Tesla. We got Schwab in there, Waste Management, Exxon. These are some heavy hitters in here, Oracle, GameStop. So you're going to be overweight energy, which isn't a surprise, and underweight tech. That means it's going to have a lower valuation than other ETFs. Let's look at this versus the S&P. It's relatively new, so I don't really want to compare it. These things they move pretty closely together. But again, this one's down a little bit because the tech has had a nice run this year so far. This is the kind of ETF that, because it is overweight value, and energy. When that comes back, this should outperform, and it will probably get some looks from people, including those who are residents of Texas, Katie.
Eric, thank you. And joining us now to talk about this ETF is Ed Rosenberg. He is head of ETFs and funds management over at Texas Capital. Ed, I'm so excited that you're here because state-specific funds, we don't really see a lot of them. And to Eric's point, what's the pitch for people who don't live in Texas to buy this ETF?
Well, I mean, if you think about what Texas is, right, it's the economy itself in Texas is growing faster than any other state and faster than the U.S. as well. It's the 9th largest economy in the world, and I believe when the new numbers come out, we may jump ahead of Italy and be the 8th. So Texas is growing extremely fast. Cost of living there for individuals is way cheaper than, say, for example, like New York or LA. So by doing that, you're attracting talent. And the other benefit is, as a resident, I don't pay taxes, but neither do companies. So you're seeing a flock of companies move to Texas to take advantage of that, which can add to the bottom line and create more growth for those companies in the long run.
I mean, it seems to me it's a theme, right? You could have an ETF that's actually Texas and Florida, and you could have an ETF that's short California and like Chicago, right? Because this is kind of the national zeitgeist, right? Everyone who's angry about taxes and regulation and like wokeness is moving to these states like Texas.
Leave out wokeness for a second. Think about the companies, though, that are moving there, right? Tesla, I mean, I don't know if they were angry about wokeness, but when they left California.
Elon Musk definitely is not down with woke.
He's not, but he's also probably not down with paying 12, 13, 14% in taxes to the state. So it's more about that aspect. When you think about what Texas offers, there's a ton of colleges, there's a ton of talent. We're in New York today, it's raining, right? It's sunny in Dallas, right? And there's a ton of days of sun that people want to experience. It does. My joke is it's sunny or you have to run because the rain's coming hard and it's a heavy storm. But realistically, Florida's not experiencing the same growth. They're experiencing influx of people, but not the same growth in industries that the state of Texas is. And so as Texas continues to grow, I mean, let's leave out Tesla for a second. I mean, I never thought Caterpillar would leave Illinois. They left Illinois. The state tax there is 5, but they still left and moved their headquarters. Schwab has been, in California forever? They left and moved. There's a ton of companies like that.
Yeah, but you've been around. We know there was a Texas ETF before this one, and it liquidated. There was an Oklahoma ETF and a Nashville ETF, and they all, are not with us any longer. Why will you make it and when those failed?
It's a good question. I mean, think about how this one's set up. This is GDP weighted. It's not market cap weighted. What we're looking for is GDP weighted by sector. So you're getting the impact of each sector on the state's economy. So while there's 216 companies, 71 of those, a third of those companies are energy, right? But you wouldn't expect energy to only make up 23, 24% of the index. You would actually expect it to be like 45 if you market cap weighted it. But when you really dig into the impact on GDP, that's the difference. And from the advisors we've talked to, that GDP weighting is resonating really well. And by the way, it's not just in the state of Texas. I mean, I just spent a week in California talking to advisors, and it resonated really well with them.
Ed, thanks very much. Next time, wear cowboy boots. Ed Rosenberg of Texas Capital. Before we go, here's a special look at another ETF. This one is ungambling. Football season is kicked off in the U.S., and investors are hoping to cash in with the Round Hill Sports and iGaming ETF, known by the ticker BETZ, BETS. This fund provides exposure to companies that operate in-person or online sports books, gambling platforms, as well as the ones that provide infrastructure and technology needed to run the operations. The first 6 months of this year saw U.S. commercial sports betting on a record-setting pace, with year-to-date totals reaching more than $5 billion, up 66% from the same period last year. These numbers are being driven by more than 30 U.S. states that now have live, legalized sports betting, which is good news for the BETS ETF, since it has around 40 holdings mainly based in the U.S., with some exposure to Australia and the UK. In BETS, you can find expected names like DraftKings, Caesars Entertainment, Churchill Downs, MGM, Penn Entertainment, and Boyd Gaming. Since its inception in June of 2020, the ETF has posted positive returns, but easily has trailed the S&P 500. The fund has about $100 million in assets, comes with an expense ratio of 75 basis points, and gets a green light from the Bloomberg Intelligence traffic light system with one warning for its alternative weighting. And that does it for Bloomberg ETF IQ. This is Bloomberg.
been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well? Or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
On the next episode of Hello World, I head to Los Angeles, meet some robots, and eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
I'm John Olive, and welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on what's going on in markets at this hour. A little bit of a reversal in terms of the equity indexes. We were down this morning. The S&P 500 is now in the green. It's only up 0.1%. But again, the direction has completely changed. The 10-year yield's still rising. And right now we're looking at 451.91. It's been a little higher than that, so we're not at the session highs, but it is the highest level that we've seen since 2007 on 10-year treasuries. The dollar index also showing some real strength today. The Bloomberg Dollar Index at 1262. That's the highest level that we've seen for King Dollar since March. And NYMEX crude coming down a little bit. Maybe that has something to do with the turnaround in equities. Of course, U.S. equity indexes are weighed heavily upon when the oil price grows the way it has over the past week. Right now, NYMEX crude is hanging under $90 a barrel at $89.60. John?
Well, going under the hood to some individual movers, Matt, I want to start with some tech names that are getting attention today. First of all, with the end in sight now for the Hollywood's writer's strike, we have seen Netflix shares modestly higher. Amazon obviously has a Hollywood connection as well, so we'll continue to watch it from that perspective. But as we've been covering all day and on Bloomberg Technology as well, that major investment in Anthropic, a big push into the AI sector once again by Amazon, which could feed into Amazon Web Services. And then we're also watching a couple of names tied to both corporate news and analyst news. So in the case of corporate news, a surprise abrupt CEO change at Alcoa weighing on that stock, and then Nike shares downgraded by Jefferies on consumer concerns. That stock off about 42 cents during an earnings week, Matt.
All right, so we're watching a couple of big events, I'd say, facing the nation's economy. One is the UAW strikes that we're going to talk about, focus on this program today. And the other is the government shutdown that we expect, people saying it's almost inevitable happening this weekend. Moody's now, the ratings agency, coming out and saying that would be a credit negative for the U.S. And we've already had a downgrade from Fitch. We've seen in the past S&P. And so this would be one more move from the big ratings agencies on U.S. finances if we do have a shutdown. Now, let's get over to Ed Harrison right now and find out what exactly this means in terms of a negative. Ed, you know, if we get the shutdown, does that mean Moody's downgrades U.S. debt?
No, I think that we have one more step there, Brian. That basically what we're looking at is a two-step process. One is the NASDAQ, if you will, where the ratings agency says that this is negative for your rating. Then they would most likely move to the next step, which is to put the U.S. on ratings watch negative, and then would come the downgrade. So this isn't as far as, for instance, if Fitch went a week before the shutdown, they placed the U.S. on rating watch negative. This is slightly before that.
All right, so what do we think would be the result of ratings watch negative if they even went that far? The last time I saw an actual downgrade of the U.S. long-term debt profile, people piled into treasuries.
Yeah, you know, the interesting bit is we've seen very different reactions this time than we have in the past. If you think about the Fitch move in June, really that was right in the middle of a channel upward in yields, both on the real yield side and the nominal yield side. Since April, we've been driving higher. Ever since the SVB situation was resolved, 10-year yields have been driving higher, so it had almost no impact longer term in terms of the direction of yields, which in the case that you're talking about would have been down.
And Ed, I was just talking to longtime Washington strategist Greg Valliere, and he feels ultimately we will see the shutdown, and it could last for a period of time. And I guess the other factor here that a lot of people are watching is, what does that mean for a central bank like the Fed, in part because they're trying to figure out where the economy goes from here in their monetary policy actions, not to mention the fact that this would complicate the ability to actually have real-time data to make those assessments.
Yeah, I think that last bit that you talk about is the difficulty, the real-time data, especially with regard to inflation, getting a handle on that, and tips market in terms of understanding, you know, what kind of inflation data you're looking at. So that's very difficult. But the Fed's hands are tied by inflation, which they may not know the number to, because there's a floor to how far they're willing to go. They've already told us that they're not going to cut until they see very severe weakness in the U.S. economy. So I think at the margin, this isn't going to do anything unless it really weakens the U.S. economy severely.
All right, Ed, thanks so much for joining us. Bloomberg's Ed Harrison talking about the latest story on Moody's, saying a government shutdown would be a negative for the U.S. Credit picture. Now, President Biden is going to be joining striking UAW members on the picket lines in Michigan tomorrow, which would be, I believe, a first, certainly for a modern president. Here with an update on the negotiations is Bloomberg's Detroit bureau chief, David Welch. So, David, we're now in the second week of these strikes. What do we know about how negotiations are going?
Look, we're getting closer to a deal between Ford and the UAW. The union was talking at the end of last week that they kind of liked a lot of what Ford was putting out there in terms of the economics. They said they weren't quite done yet, but a 20% raise, some paid, a lot of paid time if workers get laid off. Another one, reinstating the cost of living allowance that the UAW gave up in 2007. That's been a big issue for them. It's protection from inflation, basically. Getting that back, those are all big things. And if I had to predict, I'd think we could probably get a deal with Ford by the end of the week, and then the union will use that to tell General Motors and Stellantis, hey, here's par, you got to hit this for us to get a deal, and if they don't, then you could see a much wider strike at both of those companies.
David, now that we are having this conversation about the risks of a government shutdown with the ongoing strike, what do we know about the economic impact so far tied to the strike action that we've seen and based on the timing of getting any of these updated deals done?
Now, the impact so far isn't that great. You're talking about a total at the moment of 3 assembly plants and then a bunch of parts plants that are actually warehouses that feed dealers with replacement parts. So, when General Motors, they lost $3.6 billion in a total strike for one company, but the economic impact really only threw Michigan into a very brief recession in terms of the state's GDP. It only gets really big if all the plants go down. The bigger inconvenience here, it does hit earnings, which puts pressure on the companies. But right now, with GM and Stellantis having their parts supply operations shut down, that cuts into dealer profits, so they start pressuring the company, and it makes consumers very angry because if you can't get a replacement part, your car can't get fixed, you're waiting longer, and that's something the companies don't want to see. It's a big customer service nightmare for them. So it's not economic impact we're seeing right now. It's really kind of pain for the companies themselves. Now, if GM and Stellantis don't get a deal, let's say Ford does, and GM and Stellantis refuse to sign on to that same deal, I think the union could move to a national strike, and that's when you start to see bigger numbers come up.
Okay, well, a lot to watch. David, great to get your perspective as always. Thanks so much. Bloomberg's David Wells joining us. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this, put it over here.
Not cool. Not cool. All right, I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
State, Senator, First Lady, with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Split Rockets, I'm John Ehrlichman with Matt Miller. Time now for our Stock of the Hour segment. We have been tracking the auto stocks. Right now we're seeing mixed performance. Stellantis weaker, Ford and GM higher on the day. We just talked about the road ahead. Let's get some more perspective now. Matt, George Byers joining us. George Byers-Kaufman joining us. I'll take it over to you.
Yeah, George Kaufman, Executive Vice President and owner of Byers Automotive. We want to get the dealer perspective here, George, on how these strikes are affecting your business or how they will affect the business. You're one of the biggest auto dealers in the great state of Ohio. So what are you seeing so far as in terms of problems on the ground?
You know, as David said earlier, right now, we are not seeing any major effects. The fear is what's to come. My biggest concern is with our customers, with the UAW deciding to have strikes in the parts distributions centers. That will have a much more immediate effect for us as far as taking care of our customers, being able to repair our customers' vehicles. Honestly, the domestic brands and even a lot of other automakers have really struggled since the pandemic to fully recover. I don't think we're fully there yet. So my big fear is that we are in a position to be hurt a little bit more than we normally would just because of the pandemic. And we still have supply chain issues. We still have issues of vehicles being delivered. We have hundreds of vehicles all over the country that are built, sitting in lots that we just haven't gotten yet. So I'm hoping that the strikes can be resolved pretty quickly. But for now, it's just reassuring our customers and the consumer that we will be able to supply you with products. We will be able to repair your cars. I think just the initial thought of the strike before it even happened has caused a lot of uncertainty with the consumers about these domestic brands and can they get them? Will they get them in a timely manner? Is there going to be a price hike because there'll be limited supply?
Yeah,
so I think the consumer is just waiting to see what happens.
Yeah, the inflation concerns are definitely front and center. And, you know, during the pandemic, I'm sure your inventory thinned out on the lots that you operate, and you have dealerships for Ford, General Motors, and Stellantis, as well as a lot of the foreign brands. What does your inventory look like right now?
So right now, in typical times, the domestic brands run around a 45 to 60 day supply. Right now, we're about 90. But that is due that the last month's sales have dipped a little bit. I don't know if that's uncertainty in the market because of the looming strike, but there's definitely been a pullback on sales of those vehicles.
What's the outlook, George? I mean, if this strike goes on, how do you expect inventory to deplete? How do you expect sales to look in the third quarter and going into the fourth quarter, really, the end of the year?
Well, I've prepared myself. The fact is, it's going to go down. You're going to have less vehicles to sell. The consumer is going to struggle as to whether or not to buy a domestic brand because of the part supply shortage. It's going to be tough. Like I said, I'm hoping that they are able to come to some sort of resolution quickly, but I'm prepared that if it does prolong, of what we're going to be able to do.
Well, we'll have to be watching very closely, George. Thanks a lot, George. Byers-Kaufman of Byers Automotive joining us. U.S. presidential candidate Nikki Haley, meanwhile, speaking one-on-one with Bloomberg's Alex Steele right now at the American Energy Security Summit in Oklahoma City. Let's listen in.
Pushing through 7,000 of them last December. We have to start focusing on cutting the spending. The way you do that is I put out my economic plan last week. We're going to focus on the middle class. We're going to reduce the taxes for the middle class, and we're going to collapse those brackets so that they have more cash in their pocket. We're going to cut the federal gas and diesel tax because we know right now the small portion that comes from the federal government also pays for hiking trails and bike trails and everything else. We need to make sure that we start looking at an infrastructure plan that's 20, 30, 40 years out, not from the old archaic system that we've always used. And let's go to zero-based budgeting. Government needs to say, what do we have to have? And then then build up instead of what you're talking about, which is you just assume everything we paid for last year, we're going to pay again and then add more to it.
You can still have all the stuff. You just need to start from zero.
Let's prioritize what we have to have. There's a lot of old programs. There's a lot of problems that we have in that. When we do that, and then let's look at, you're seeing a government shutdown conversation that's happening right now. And it's a false narrative to say that the Freedom Caucus is holding things hostage because they want to cut, or do you allow the government to go forward? First of all, you cut and you allow the government to go forward. You can have both, not either or. Think about this. Congress has proposed a budget on time 4 times in 40 years. 4 times in 40 years. We have to go back to no budget, no pay. If Congress can't produce a budget, Congress doesn't get paid. We should not be in this scenario, but because they wait and they don't work and they don't produce results, we end up in the same situation over and over again. That'll stop when I'm president.
It's also been shown that government shutdowns hurt both parties. Have you talked to leadership at all, particularly as you guys are headed into the second presidential debate?
I haven't talked to leadership. I've talked to all of Congress saying it is irresponsible and inexcusable that you would let government shut down.
And what's the response?
It is also irresponsible and inexcusable to not cut all of this spending. They are using our budget and keeping it in pandemic spending. We're no longer in a pandemic. Why are they still spending at those levels? Taxpayers can't afford it.
So what's their response when you say, guys, get it together?
I mean, they need to get in a room and figure it out. We're going to find out, I guess.
But are you worried that this is going to harm the party?
This is going to harm taxpayers. It's not about the party. Taxpayers already can't afford groceries and gas. They can't afford buying a home or buying a car. And now you're going to say, oh, we can't figure it out. We're going to shut down government. That's not okay. You don't get to do that. Instead, you have to start cutting what you spend. Why is it everybody in this room balances a budget? I balanced a budget as governor of South Carolina. Why is Congress the only group that refuses to balance a budget? It's the reason we have to have term limits in Washington, but it's also the reason we need them to start doing their job. Taxpayers and businesses work for government right now. So government's got to start working for them.
So let's circle back to the everyday American. And Governor DeSantis talked about pledging to get gasoline prices to $2 in his first year. You talk about scrapping the gas tax and the diesel tax. Do you think we can get to $2 a gallon? Like, would you support that? How would you do that?
Well, I didn't propose that.
Right, but he did. So would you match it?
I don't support what he proposes.
Okay,
I came out with my own.
So that wouldn't be something that you could commit to?
No. I mean, I think what we do is we focus on the taxpayers. How do we get more cash in the taxpayer's pocket? Let's eliminate the federal gas tax and diesel tax, and let's start coming up with an infrastructure plan that can manage what we need in the next decades going forward. That's the focus I'm going to do. I'm going to focus on strengthening the middle class. That's where we have to focus. Right now, we're watching in America where the poor are getting poorer and the rich are getting richer, and we are losing that middle class. We're going to focus on the middle class.
Well, considering that $2 gasoline means like $45 oil, everyone here is pretty happy that you are going to support that one, I bet. Okay, so you've talked a lot about China as really the crux of China then becoming your economic policy, right? Like combating China, how do you manage that? If we're all going to eventually transition and get to cleaner fuel, how do we flex our muscle in China and India to get them to also reduce it? How do you do that?
So, by winning. And so I'll tell you the first thing that we need to do in terms of with China and Russia is let's take India. They have millions of people right now without electricity. They need clean, cheap electricity that they can start doing with their country. They have doubled the number of coal-producing plants that they have, which is a problem. That's why we need to be doing more in America. We need to be exporting as much liquefied natural gas as we can. India is going to be a friend of ours. India is worried about China. They just gave themselves $1 billion stimulus to become less dependent on China. Let's partner with them. So not only are we exporting liquefied natural gas to the Europeans, let's do it to India as well. That's when it's a win-win. We have it. Let's share it. That's the goal, and that's how we would handle India. With China, you beat them. What I saw at the United Nations, there were 2 things our enemies never wanted us to have. They never wanted us to have a strong military, and they never wanted us to be energy independent. Let's be energy dominant. That's how you defeat China.
What energy dominance? Like what of the energy mix? All the stuff? Just oil and gas?
So I think we should be all of the above energy, while also focusing on innovation that allows us to continue to be cleaner and safer in that process. The problem is when you start picking what kinds of energy, that's when you're picking winners and losers. Let's do all of it. I want us to be energy dominant. I don't ever want us to have to lean on an enemy or have to be dependent on a foreign country for our energy needs. Not when we're this blessed.
And you're one of the only ones up there that talk about actual climate change. So you are a proponent of wind and solar. Like you want them all. What would be a good energy mix for you after your first term?
Well, first of all, I do think that climate change is real. I think we have to acknowledge that it's real. But I also don't think we go so extreme that we say we have to do all these things by X year. Instead, that's where the partnership in this room comes. They know innovation better than anyone else. We know what we can do to start finding those ways of capturing carbon, of making sure that we do the fusion so that we can start getting a net energy plus in the process. These things are starting to come out. Now let's just go and make that happen. But yes, I believe in wind. I believe in solar. I believe in all of those things because I think all of those are part of how we become healthier as an environment and healthier in teaching the countries around the world what else we're doing.
At the end of your first term, how much of the energy mix is renewables? How much does it grow by?
I don't think that's for me to decide. I think that's for the industry to decide. That's where we have to come together. We have to say, what can we do that's safe, that's clean, that's affordable, that helps taxpayers? The problem is you need to have a president that understands you've got to have an energy community that's going to say, well, this is what we can do, or we can propose this, or let's pull this innovation in. Right now, you're treating them like second-class citizens. They're experts. We need to use the experts. And if I go and say, this is how we want to make sure we reduce emissions, how do we get there? This is the group that tells us how we get there, not government bureaucrats, not regulators. They're not going to tell you how to get there. They're just going to squeeze you to the point that you don't have energy to start with.
You got a lot of attention there when you said that. When you're taking a look at, say, unleashing the energy dominance, right? Labor is still a really big problem. I was talking to Doug Lawler of Continental, and he's like, labor's just still really tight. So even if you wanted to sort of innovate and pump a lot of money into stuff, you can't. We don't have the labor for it. How do you get there? How do you get skilled, quality labor to this industry?
Well, you always have to. In South Carolina, we went from a state that was making textiles that all went overseas, and we had to get used to, when I recruited in, we were then building planes and cars and tires, and we had to retrain our workforce. And the way we did that was we worked through our technical schools to start focusing on the new jobs that we had and how we could get them back on track. We need to do that. We need to make sure that we're filling the jobs that we need. And you do that by reskilling. And then you also look at the fact that while we're looking to close the border, and we need to close the border because there's more lawlessness that we've seen in a long time, you also look at legal immigration. And when you look at legal immigration, we have to stop the way that we do quotas based on numbers. We'll take X number this year, X number next year, and start saying, what do our industries need that they can't fill? So think construction, think farming, think tourism, think energy production, and then you bring it based on merit. When you bring it based on merit, that's when you build up our economy, instead of just focusing on what quota you're going to deal with from one year to the next.
We only have a few minutes left, so a minute left. I just wanted to ask you about your path. So we have the second debate coming this week. What is your path? If Iowa doesn't go your way, for example, what is the Nikki Haley path now? What's the Nikki Haley path in 2028?
Well, you're assuming that Iowa won't go my way.
No, I'm really not. I'm saying you got to have lots of plans. There got to be a spreadsheet there with lots of things going on.
I have one plan. We have done 85 events in Iowa, New Hampshire. We continue to do big events in South Carolina. The momentum is real. We're pushing hard. We're raising money, and we are working on, we're putting ourselves out there in the debates, and the support is strong. And so our goal is to have a strong showing in Iowa, have a strong showing in New Hampshire.
That was U.S. presidential candidate Nikki Haley speaking with Bloomberg's Alex Steele in Oklahoma City. You can tune in to that event. If you have a Bloomberg terminal in front of you, just type LiveGo, L-I-V-E, GO, on your Bloomberg terminal to hear more from Nikki Haley. For John Ehrlichman, I'm Matt Miller. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I try and play that role.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
The pain trade puts the squeeze on stock and bond investors alike. Live from Studio 2 at a rain-drenched Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking you off to the closing bell here in the U.S. About 2 hours ago, you take a look at stocks right now. They're actually higher on both the S&P 500 and the NASDAQ 100. The S&P 500, of course, off its worst week since March last week, rebounding a little bit today, up about 0.3% or so. Big tech up about 0.2 as well. That's even as that bond sell-off continues, which we're going to get into in a big way. You look at the 10-year Treasury yield, currently up almost 10 basis points. The levels that we're talking about, pretty amazing, well above 4.5% at the highest yield level going back to 2007. Just some really amazing moves that we're seeing, particularly at the long end of the curve. And Romaine, I did just want to end on oil here. Of course, we've been watching this months-long sell-off in the energy market. Crude oil right now, though, dropping a little bit below $90 a barrel.
All right, a couple of key developments coming out of the weekend, Katie Greifeld, affecting markets here in the U.S. here. We start with, of course, the big drop in Asian equities. That was led by a slump in Chinese equities, led by a plunge in property developers. This after Evergrande's onshore unit says it actually missed principal and interest payments on a key bond just issued a few years ago. That stock slipping 22% in Chinese trading. A few other stocks, including Sino Ocean, down 12%. Country Garden down about 8%. Overall, you got a Bloomberg Intelligence gauge out there of developer shares giving back 7% on this Monday. That's the worst one-day decline, believe it or not, of the year, and it adds to what is now a 34%, $56 billion loss in valuations just in the past 9 months alone. It's a pretty dour setup when you consider the drop in volume heading into what is going to be a multi-day market holiday for Golden Week over there in Asia, which kicks off on Friday. So that could have an outsized effect on some of the price action that we're seeing over there. Meanwhile, back here in the U.S., we did get some interesting price moves for the Hollywood studios. Reports that labor contract talks with the Writers Guild may have finally found enough common ground to get folks back to work. Netflix, which is among the big studios, is largely seen as being the biggest beneficiary from the proposed new agreement. That's moving higher on the day, but the rest of the stocks, kind of a mixed bag here. Paramount, Disney, and Warner Brothers oscillating between gains and losses on the day. Remember, the actors' strike that started in July still appears to show no meaningful signs of compromise just yet. But, of course, we saved one of the biggest stories for last here, and that is what we're seeing in the Treasury market. That's where most of the activity is, a continuation of the sell-off in the long end of the curve that's been unfolding for about 4 weeks now, Katie. But some strategists out there, they actually see a potential opportunity to buy here, particularly in that so-called belly of the curve.
It's my favorite thing to talk about, the belly of the Treasury curve. Let's talk about it a little bit right now. You're looking at all sectors of the curve right now, and as you can see, it's been pretty much a straight march higher for all of those maturities. But if you focus on the belly, that is that yellow line there, about that 5-year tenor. So you are starting to see some appetite there, if you will, of course, when people say maybe we don't see rate cuts next year or maybe at the end of next year. But if you think there's going to be rate cuts in the next 5 to 7 years or so, that should benefit the belly. And of course, picking your spots on the curve right now is very important when you think about what a battering the bond market has taken. And if you take a look year to date, we're heading for the 3rd straight year of losses when you look at the ag. And as you can see, that is very rare when you go off looking back through history. The average return somewhere closer to 6-7%. So to see a 3rd straight year of losses really speaks to this amazing re-rating that we've seen in the Treasury space so far this year, Romain.
Of course, everyone is out there still looking for opportunities, Katie. Let's get some insights out of our first guest here to kick you off to the close. Gargi Chowdhury, head of iShares investment strategy for the Americas over at BlackRock, releasing their fall investment outlook. And Gargi, great to have you here today. Let's get right to that outlook here, because there has been a lot of discussion about whether now is the time to maybe embrace certain parts of U.S. Treasuries here. You and your team seem to think that there is opportunity in the belly of the curve.
Sure, Romain, it's great to be here. Thank you for having me. And absolutely, one of the things that we talk about in our fall investment directions that actually came out this morning is the attractiveness or the relative attractiveness of the 5-year point of the curve, the belly that Katie was talking about earlier. And the reason is a fewfold. Number one, of course, is the income that you're generating, much above that 4.5% level, sitting in the 5-year part of the curve. But secondly, it is the asymmetry that you have right now in the 5-year point, where if you believe that rates can still perhaps move up 100 basis points, owning that 5-year for the next year. So if you hold on to it for the next year, you are still going to be flat on a total all-in return perspective.
Okay.
However, if yields actually move lower by 100 basis points, you're going to have close to double-digit returns. And that asymmetry is the best on the 5-year part of the curve, which is why we prefer that more than any other area of the curve.
I'm going to ask you a question then that you probably won't be able to answer, or maybe you will be.
Hope
and that
so.
is, I guess, when do we start to see that drop in rates? Because a lot of people had called for that quite some time ago. And of course, as you've noticed, over the last 3-4 weeks, we've seen a meaningful uptick in those rates.
Yeah, it's a great point. And I think where you're talking about is also important, right? So which part of the curve are we talking about when we talk about the fall in rates? I think the long end, so anything that's 10 years and higher, can actually remain sticky at current levels for some time. There's a lot of supply coming into the markets. Term premium, so what you expect to get paid to own further duration, is still fairly low. It's still negative. So that still needs to normalize. But if you look at the 3 to perhaps the 5 or even the 7-year part of the curve, that I think is getting to levels, and we think certainly for the 5-year, it's already at levels where even if rates don't move significantly lower, where if it just hovers around the levels they are at, or even moves higher to 100 basis points, you still have cushion. So you can still earn positive return while rates move higher. What can drive them lower? The things that we are looking for, and we've been talking to clients across the country, and they're asking us the same question: when can we expect to see rates go lower? And I think it's really around a few things. Number one, the labor market has to show some signs of slowing down. So the inflation has already moderated, but I think the labor market is the next shoe to drop. And if we see some moderation on the labor market, I think the 10-year or even the 5-year can stabilize. The second is really from the Fed. This latest steepening move is certainly based on the Fed's sort of, their forecasts. And I think they need to pull back on their hawkish narrative just a little bit.
Let's talk about cash, though, because I look at some of the iShares products. SGov in particular has been on fire, as has anything that's tracking anything with basically a 6-month duration or less. I see what you're saying about the belly, but if I'm worried about reinvestment risk, I heard from Jerome Powell last week saying that rates are going to stay high for quite a long time. Does that become more of a moot point?
I think it depends on the type of investor you are. So right now, if you're really nervous about the markets, if you think that we can see further deceleration in the stock market here, holding cash at 5.25 makes a lot of sense. So SGov or SHY, something that gives you that very front end, and we've seen tremendous amount of inflows into that, and specific I-bond maturities. So sort of instruments that act like cash and mature like bonds in the very front end of the curve. But I do think, especially given our view, and we talk about this in our investment directions, that we think that the consumer growth can soften a little bit from here in the fourth quarter. If you were in the same camp as us, where you think, again, not calling for a recession, but just a slowdown in Q4 from Q3's run rates, I think that's where owning a little bit of duration, again, around the 4 or 5 year point, with something like an IEI or something like even with something like the ag or mortgages, we think make a lot of sense here.
And Gargi, just quickly, talk to us a little bit about some of the unknowns out there, some of the wild cards, if you will, because just in the past hour, we actually heard from Moody's saying that a U.S. shutdown would be negative for the U.S. credit rating. How are you thinking about that?
Yeah, so with the government shutdown in particular, of course, that's an unknown, but depending on how long that lasts, can actually be a blip, right? So we'll obviously have a drop in growth every week that the government is shut down, but once we reopen, that does come back to growth. We've seen that in the last sort of 40 years. We've had about 20 shutdowns, and every single time we've had that growth come back. I think the unknowns here, the one that I'm thinking about quite a bit, is really around the big one is around oil prices. I think to what extent can oil prices continue to move rapidly higher as they have over this past quarter, and what does that mean for the consumer? How much does the consumer slow down as a result of higher prices, and what does the Fed have to do if headline inflation, instead of turning lower, turns higher, and this time they can't get to call it transitory? And that's actually one of the reasons that we're telling investors to stay invested in the markets, but particularly pay attention to the energy sector of the broader markets.
Katie, I'm a little surprised you asked her that question.
Why is that?
You're being hard here.
We've got some breaking news. We've got an expert.
Okay.
I want to hear her thoughts.
Okay, all right. Well, always great as Lang. You're such a Taurus, you know that?
Yeah.
All right, Gargi, great to see you. Great to catch up with you. Gargi Chaudhary there, head of iShares investment strategy for the Americas over at BlackRock, helping us kick off to the close here on this Monday afternoon with a look at the writers reaching a tentative deal with Hollywood studios. Actors, though, still walking those picket lines. We're going to talk about what it means for the industry and what could happen next.
Plus, Congress faces a deadline of midnight Saturday to pass a federal spending measure or face a potential government shutdown. We'll have the latest on the negotiations and, of course, what it means for the markets.
And Gargi was just talking about energy prices. We're going to go back to the Ham Institute American Energy Security Summit in Oklahoma City, where top executives are talking about the potential for $100 a barrel on WTI. That conversation and so much more coming up in a bit. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
After 5 long months, Hollywood writers and the studios reached a tentative deal over the weekend to end those strikes. Now, the agreement settles one of the 2 walkouts that have shut down film and TV production. For more on this deal, let's bring in Chris Palmieri out of LA, who, of course, has been covering this story closely for Bloomberg. Chris, tell us a little bit about this tentative deal. What did we wait 5 months to see?
Well, this was billed by the writers as really sort of a transformative deal. It's the first one they've really hammered out in the streaming TV era. They wanted a lot of guarantees about these new technologies, artificial intelligence. They want to make sure they're not replaced by robots. They wanted a greater share of royalties and transparency in terms of the data that comes out for shows on streaming. So those were 2 of the biggest issues, and there was some movement on those 2 factors.
So it looks like they did win some concessions here. What do we know about the state of that agreement, the state of the negotiations, the idea that this is tentative? How much confidence do we have that this is going to be a done deal?
Well, we know that they got salary increases. We knew they've got some guarantees in terms of a minimum number of writers per show, which was another big sticking point. We'll know all of the details possibly tomorrow. Where it's going from here is the boards of the Writers Guilds East and West will meet and sort of approve the agreement. Then it goes to their members, which are some 11,000 of them, to vote. That could take a few days, but the boards can say that the members can go back to work as early as tomorrow in an interim basis.
So they could go back to work, but of course, any actual filming will require an agreement with the actors. Where do those negotiations stand?
Haven't restarted yet, but we expect them to do so very shortly. The Actors Guild put out a statement last night, congratulating the writers, and so it certainly seems a lot of the same issues were covered. Streaming residuals, artificial intelligence, and that. But we'll see some shows go back, that weren't as dependent on writers, talk shows, daytime and night. Not as dependent on actors. So we're likely to see some news later this week about what returns.
All right, Chris Palmieri out in Los Angeles to look at the Hollywood writers' strike, which at least for right now appears to potentially be at an end after 5 long months. Meanwhile, the UAW strike entering week 2. We did hear from President Shawn Fain of the United Auto Workers calling for an expansion of that strike, with GM and Stellantis facing walkouts at 38 more facilities after talks last week failed. The president, Joe Biden, heading to Michigan on Tuesday. Former President Donald Trump scheduled to be there on Wednesday. Our Detroit Bureau Chief David Welch joining us today on this Monday. And let's start off here with some commentary that we heard over the weekend, David, out of the Transportation Secretary, Pete Buttigieg, who seemed to be relatively optimistic that not only could a deal get done, but in his words, it would be a win-win for all. I think we're having some issues with David Welch's audio out there in Detroit. David?
Yeah, I'm here.
Go ahead.
Yeah, so look, what Pete was saying is, in addition to calling for a win-win, he was kind of using the UAW's own words. He was saying that there should be record compensation and record benefits. And that's exactly what Sean Fain's been saying all along, is that record profits equals record contracts. So you see the administration's language clearly pivoting toward the union, that they're going to be, they're on their side. And Biden needs that because you have Trump in Michigan campaigning for union votes. And a lot of union members do actually vote Trump. And the Democrats are going to try to steal them back. Workers have traditionally voted for Democratic candidates. You could really look at this week as being a precursor to the 2024 election, assuming Trump gets the nomination, and most think he will. So you've got the two likely candidates here fighting for union votes on picket lines or during a strike right here in town.
Well, David, that's what I want to talk about. Clearly, you've seen the Biden administration, some of these Democratic politicians lining up behind the unions. What have we seen from the Republican side?
Look, some of the other Republican candidates have not been so friendly to the union. You've had them saying things like, they should be replaced if they're on strike. Others have sort of said, they feel sympathetic with the workers, but they've only used that to say that Biden's electric vehicle agenda is costing them jobs. So it's, the Republicans, including Trump himself, are pivoting this toward, hey, the union is really striking here because they're worried about losing jobs, and they're worried about losing jobs because of electric vehicles that Joe Biden is ushering in with billions of dollars. It hasn't really been, hey, we're sympathetic toward the worker, which is the message the Democrats are trying to win votes with, and that's what Biden will likely be saying once he's here.
All right, David, really appreciate your time and your reporting. Our thanks to Bloomberg Detroit Bureau Chief David Welch. And Romain, it's really interesting to see this become a political issue and see how the different sides are trying to handle this.
Yeah, we kind of knew it would at some point here. And of course, it really dovetails considering sort of what drove the last couple of elections. We know that Michigan has been a swing state. Obviously, some of these other manufacturing states like Ohio have been critical, and Pennsylvania have been critical to the election of who becomes president. So it makes sense that the two leading candidates would want to sort of court those voters. And I think we talked about this last week. At least if you believe some of the polling, seems like the rank and file is maybe a little bit more amenable to some of the language coming out of Trump, while the leadership seems to be more amenable to what they're hearing out of Biden.
Yeah, an interesting split there. And just when we think about the position that the Democrats are in right now, you remember when we had the rail unions and a potential strike there. It was pretty awkward for the Democrats trying to maybe enforce that.
Exactly. For a president who basically says he's the most pro-union president in the history of the United States of America. And there were a lot of folks that were part of that union who basically felt that, well, he didn't really stand up for them, at least not to the extent that they wanted him to. So it's a tough situation. It'll be interesting to see whether, if this does drag out, does it force his hand to intervene and then once again maybe have to upset some of the potential voter base that he needs.
Yeah, it's going to be a fascinating couple of weeks. And sticking with the government, stay with us, because coming up, we're going to have the latest on the potential for a U.S. government shutdown at midnight on Saturday. That conversation coming up next. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
My knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
From New York City.
In London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
All right, let's turn now to U.S. politics. The Speaker of the House, Kevin McCarthy, and his allies spending the weekend working on a short-term government funding measure with just 5 days to go until a potential shutdown of the federal government. Party infighting, though, between McCarthy's party, the Republicans, and the conservative hardliners there, seeming to put a little bit of a roadblock here into getting a deal done. Laura Davison joining us right now from our Washington, D.C. bureau, and everyone sees the calendar there. We've been in the past at this level of brinksmanship before, Laura, but there's some concerns that this time is different, and I am curious as to, has anyone really sat down to assess the potential economic impact should we actually get to that September 30th date?
Yeah, the tenor is different. Congress comes up on these deadlines all the time, and generally the mood is that, no, we don't want to shut the government down. We want to come up with some deal, and if we can't come up with the deal before that deadline, we'll pass some sort of short-term stopgap measure to give Congress more time to negotiate. That is really not the mood, particularly in the House right now, where there's a small group of hardline Republicans, and remember, the Republicans just have a narrow majority, just 4 or 5 seats, so a very small number of people can say, no, we're not going to pass anything, and effectively shut the government down. What has a lot of both moderate Republicans as well as Democrats frustrated is there are a lot of knock-on effects. A couple-day shutdown doesn't really affect things, but if we see something like we saw back in 2018, 2019, when the federal government was shut down for more than a month, we're looking at things like economic indicator reports that are delayed sometimes by months. You look at, hits to GDP. Last time it was $11 billion, $3 billion of which was never recovered. Other things like government services, you're going to see national parks shut down. Some essential services like mail delivery will stay, but there's a lot of gray area on what happens to some things like tax payments as well as student loan repayments that are set to start at the beginning of October. If the Department of Education is shut down, how does this process work? It probably makes for a very messy restart to all of that.
Well, Laura, what are you hearing from your sources about current thinking about how long this shutdown could last if indeed we don't get a deal?
Yeah, sources really are saying that this is going to be, that Republicans are very much dug in on this. So we're looking at weeks, potentially more. The whole idea of going into a shutdown, that what hardliners will tell you, they want to extract some sort of concessions from Democrats. They want to hold out as long and try to win things over. History tells us that generally the side that causes a shutdown rarely gets anything in return, but that pressure starts to mount and they dig their heels in longer and longer, ultimately resulting in a lot of knock-on effects without actually achieving the political goal that was at the center of the whole shutdown.
And just real quickly here, Laura, when we talk about the idea of a deal potentially getting done, what's being negotiated right now? Is it largely just Kevin McCarthy negotiating within his own party, or are the Democrats involved at all?
There's a couple different factions. So it's mostly McCarthy working with his party, but there's this group called the Problem Solvers Caucus. This is a group of Democrats and Republicans in the House. They've put up some of their own ideas as well. But remember, it's McCarthy here that, one, has the ability to control the House floor, as well as his job is at stake. If he does something that these hardliners don't like, he could get ousted. So he's very cautious, and that's really the person at the center that will be making all the decisions going forward.
All right, the countdown begins. Laura Davison down in our Washington, D.C. bureau. I have a feeling Katie Greifeld, we're going to be checking in with her multiple times this week here, as everyone, I think, is now starting to bite their nails. This could have an impact. We talk about a recovery in that lost revenue, but we forget there's a big chunk of that lost revenue that never comes back.
And you also think about more immediately what it means for the Fed. For example, we wouldn't get a CPI report on time, theoretically, depending on the length of this.
Then what are we going to obsess over?
I don't know. That's the thing. We should ask the Problem Solvers Caucus.
The Problem Solvers Caucus.
I'd like to know.
Yeah, I'd like to see who the members of this Problem Solvers Caucus are. Romaine Bostic and Katie Greifeld here trying to solve problems with regards to the market today. A mixed day on this Monday, coming off what was one of the worst weeks that we've seen all year for U.S. equities. Stick with us. This is Bloomberg.
course, we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under-tightening would be a worse mistake than over-tightening, because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
This is the countdown to the close. Almost 2:30 here in New York. A mixed day for the broader markets and a mixed day for commodities as well. Abigail Doolittle is standing by right now with our commodities close. Abigail.
It is a mixed day indeed for commodities. Overall, though, Romaine, we do have some declines. So here are some of the big weights, drags on the Bloomberg Commodity Index. New York crude oil down about 0.4%, slipping back below $90 per barrel. From a chart technical standpoint, it appears as though oil may drop back down closer to 80 before potentially rising above 100. And of course, we can bring China and some of those property woes happening over there into the picture as the world's largest user of natural resources. That's probably weighing from a fundamental standpoint, and the idea that maybe some demand will come off the market. Copper down 0.7%, silver down 2%, and platinum down 1.8%. The metals getting hit the hardest, and this, of course, has everything to do with the dollar rising. If we take a look at the Bloomberg Dollar Index versus a Bloomberg Precious Metal Index over the last 2 months, since really the July Fed meeting, when the Fed indicated that they are still around, higher for longer as a possibility, you can see precious metals down, the dollar higher, up about 4%. Of course, metals denominated in dollars, super sensitive to dollar strength, and we see it right there, especially since there's no real use for precious metals, Romaine. We can see that weakness clearly.
Abigail Doolittle there with a closer look at what's going on in the commodity space. Let's stay in that space right now. The American Energy Security Summit taking place in Oklahoma City. Our very own Alex Steele is down there right now asking some of the industry's top executives about the prospects for oil prices.
The reason Prince Abdulaziz has been doing what he's been doing recently is to balance the markets, because there was a time of overspend followed by a long period now of underspend in the industry, and then the pandemic. So now to balance the markets is best for all of us, because if he wasn't doing that, then prices could potentially go way up to over $100. But in balancing the market, you protect the downside so that you have a healthy oil and gas industry.
The higher price is a reality that we're going to have to deal with as we think about our investments and we think about the energy needs of the globe. And the fact that we know today that it's being more broadly recognized that oil and gas is going to play a key role in our sources of energy in that energy stack over time.
All right, the heads of Continental, Occidental, and a few other folks that Alex Steele has had a chance to sit down with while she's down there in Oklahoma City for that summit. And give us a sense here, Alex, about the discussion about oil prices, which, as I'm sure you know, have gone up pretty significantly just over the past couple of months. Are the people you're speaking to, do they think that that increase that we recently saw is going to continue?
I mean, yeah, kind of. The most significant part of it, actually,
was that we used to be in a range like 60 to 80, right? Where 60 was kind of the floor. That's where you want to make investment decisions. But it feels like the conversation is shifting now to 80 to 100. And now 80 is that floor where you make investment decisions. That's a very different profile than we were just at about 6 months ago, and they all really see the volatility, and volatility can be really tough if you're trying to make investment decisions, and that's a huge, huge shift change for some of these CEOs.
Well, let's think big here. Let's talk about the upper end of that range, $100 a barrel. What does decision-making look like at $100 a barrel? What do the politics look like?
Yeah, well, then you get to 100, and then you start talking about 150. I think it was Doug Lawler of Continental that says that eventually you could see 150 because of the kind of underinvestment that we've seen. And what they mean by underinvestment is that you pump money into the existing oil system, but that's just to keep oil at a consistent pace. That's not to grow production. Then to grow production, you need a higher price, and then to do exploration, you need even a bigger price and clearer policy. So then we're in a whole different ballgame. Then we're definitely talking recessionary fears. Then we're definitely talking demand destruction. The tension, though, Katie, to your point, which is so interesting, is what do you do with policy in Washington, right? A lot of these oil companies like the IRA because they get subsidies for their carbon capture unit, for hydrogen, for stuff that they're actually investing in, yet they want a government that is more friendly to oil, which just means more clarity so they can actually explore and not just produce more, but maybe explore more.
Well, square that circle for me, Alex, because whenever I hear this idea that they want a government that's going to allow them to sort of explore, allow them to drill more, I feel like that always runs up against this idea of where? Like, where are the reserves that we don't know about yet that are going to be profitable enough for these companies to go there? It's easy to say this, but is there something there in the ground that we're missing?
I mean, maybe federal land. They're all going to talk about the moratorium on federal permitting. Maybe we're talking about Alaska. But the irony is, Romaine, to your point, is that if you talk to any of these oil CEOs, you're like, all right, you're unleashed. Go for it. Drill more. Are you doing it? They're like, no.
Yeah.
They're like, we like capital discipline. We're not going to do it. So that's very confusing to me.
Yeah, well, to me as well, Alex. You know a lot more about this than us. Alex Steele out at the American Energy Security Forum in Oklahoma City. We'll check in again with her soon. Again, I am sure. Katie Greifeld. And the interesting thing, you know, we didn't get a chance to ask her, but she had a chance to interview Nikki Haley, one of the Republican candidates for the nomination for president. And Nikki Haley talked about this idea of trying to get gas down to around $2 a barrel. And I think Alex pointed out that that would kind of translate into like oil around $45 a barrel, which I'm like, really square that circle, because I'm sure most of the people in that room don't want to see $45 a barrel.
Yeah, that's the thing.
Yeah.
It's a very delicate dance to do when you're thinking about how consumers feel higher energy prices and everyone else in that room who would maybe like to stay at these prices and explore even more. I don't envy the politicians trying to walk that line right now, but still ahead on the close.
Maybe the Problem Solvers Caucus.
Maybe we should get them in here. I don't know. I want to talk to these problem solvers. Maybe they can talk about the hype around one of the hottest IPOs this year. Has it already cooled? We're going to talk about Instacart in our top calls coming up next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
What do you like most about your job?
I
think the people, I mean, ultimately we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
Look, I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
All right, time now for our top calls, the big movers on the back of analyst recommendations. And we start off with CarMax. The Queen telling me that Wedbush putting the pedal to the metal with an upgrade to outperform. Better mix of older and more affordable used car inventory relative to its peers provides an opportunity to increase market share. The analyst also saying a prolonged strike by the United Auto Workers could give used car dealers like CarMax more pricing power. Those shares up 2% on the day. Next up, Nike. Jefferies downgrading the sneaker giant to a hold ahead of an earnings report this week. The analyst girding for a sales slowdown, citing a consumer survey where 87% of respondents with student debt said they will reduce their overall spending with apparel and footwear, the first thing on the chopping block. Shares down fractionally on the day. And finally, Microsoft. 59 analysts covering this company, and up until today, only one of them had a sell rating. Guggenheim, which downgraded the stock to sell back in January because of the risk posed by what most people thought was going to be an economic slowdown, upgrading back to neutral today on tailwinds from artificial intelligence. Nevertheless, Microsoft shares fractionally lower on the day, and those are some of our top calls. We do want to stay in the tech space and in the sell side space and talk about, well, the newly public Instacart. Our next guest was the first analyst tracked by FactSet to set a rating on the shares, giving it a hold. He says, well, they were in the right place at the right time during the pandemic, but he sees a tough road ahead. Let's bring in Bernie McTernan over at Needham to talk a little bit more about this call. And Bernie, let's just start off with the elephant in the room. I think everybody at some point or another either used Instacart or maybe tried to use it during the pandemic. My question is that type of interest that we saw in 2020 and in 2021, is that still there here in 2023, heading into 2024?
Yeah, no, and thanks again for having me on to start. And that's the reason why we have a hold rating on the stock. If you look at just from a top-down perspective for the industry, only 12% of grocery sales are done online right now. So again, you had this huge catalyst of the pandemic with getting people to try these services for the first time. And now we just think, what's the catalyst really to potentially even double penetration here? We think it's going to be a longer road ahead. And then you throw on competition on top of that. 80% of Instacart's GTV, that's coming from their marketplace. And we think competitors like DoorDash and Uber are going to become increasingly competitive in the grocery space over time.
We'll talk a little bit more about the competition, because this seemed to be absent from the discussion when it came public. The idea that Instacart has something relatively unique, but there's got to be that question as to whether some of the other grocery or delivery companies, if you will, can sort of move into this space. You also, of course, have the elephant in the room with an Amazon or one of these other big players that I feel like could just flip a switch if they ever decided to get their act together and do the same thing.
Yeah, no, it's a great question. And so I think it's important to give the timeline here for how Uber and DoorDash, when they really announced grocery, and it was in the summer of 2020, they actually didn't even have an announcement with their first major grocery chain until in 2021. And really, so they were late to the game with grocery. They were, trying to really get the product right. I still think they're in that mode. I do think grocery from a product technology standpoint is more difficult than restaurant, but I think over time they should be able to figure it out. And Dara, Uber CEO, was at a competitors conference a couple weeks ago talking about how later this year that's when they're really going to be integrating Corner Shop with Uber Eats. That's going to add a lot more product functionality. So again, like I think that Instacart had a decade-long head start, and that gap is going to be able to close over time. And it was funny, when we went through the report, we were really focused on Uber and DoorDash. And usually when you're talking about competition, there's a spot where Amazon is touching. It doesn't take that long to get to them. With Amazon, we can put them in the same camp as Walmart, where it's these one-piece solutions. And I think that's why if you look at the whole grocery delivery market, we think Instacart actually lost share, even if it was stable with those third-party delivery companies like an Uber or DoorDash over the past year, because Amazon and Walmart have been growing the market, and we think that that's the risk, that those chains continue to take share in the overall category.
Well, Bernie, if you take a look at the filings prior to the IPO, it was interesting that you saw that orders on the platform were pretty much flat in the first half of 2023. But then you take a look at advertising revenue. It actually accounts for nearly a third of Instacart's total revenue. And couching that in the competitive landscape, is that silver lining from advertising enough to cushion the blow of Instacart losing market share here?
Yeah, and so advertising is how we have mid-single-digit growth for GTV, but high single-digit growth for the whole company. And they're operating as a retail media network. This is a really highly effective form of advertising where it's in a closed-loop environment, meaning the transaction is happening the same place that the advertising is happening. So, you can really have 100% attribution. It's powerful for CPG advertisers. The only thing is that advertising, was doubling as they're approaching $1 billion in terms of advertising revenue. It is slowing down. And actually this is one area of pushback that I wasn't expecting from investors, but really focused on Instacart actually competing with grocers for those same CPG dollars. So as consumer spending shifts more online, those advertising dollars are following. And so they're competing with that same, competing with their partners for the same dollars.
And Bernie, you're one of 3 analysts that's initiated coverage of Instacart. All 3 of those analysts, including yourself, have a hold on Instacart. What would you need to see that would bump you up to a buy?
Yeah, so we did a scenario analysis in our note where we said, what's the bull case and what's the bear case? And in the bull case, that's when growth can really look like an Uber or a DoorDash. And I think that's why, that's how you get to a high teens multiple $55 bull case we have on the stock. And so that would be these grocery gains that we saw during the pandemic actually having this network effect where you're looking at 200 basis points of annual share gains for grocery adoption. And that can really drive GTV a lot faster. Advertising is based on a percentage of GTV, so you could, get a lot faster revenue growth. And then this is a company that's shown a lot of operating leverage. So if you look from 2019 to 2023, we think that there's going to be a $1.1 billion swing in EBITDA. A lot of that is, really leveraging off fixed costs, but you need to have that revenue growth to have that operating leverage. So in our bull case, we would have greater operating leverage. In our bear case, it's that online grocery gains really go back to pre-pandemic levels, talking less than 100 basis points per year. So then you're looking at mid-single-digit revenue growth, high single-digit EBITDA growth. If you look at a comp set of other tech companies with high margins and low growth, that's how you get a high single-digit multiple, and that's where our $7 bear case comes from.
All right, Bernie, we're definitely going to have to catch up again over the next month or two, particularly ahead of the earnings that we're looking at coming in November. Bernie McTernan there over at Needham. A look at Instacart, 5 days of trading, 4 of those days down, 4 of those days is traded below its $30 IPO price, and today it could potentially close below that level as well. Coming up here, a conversation about the auto supply chain and some of the disruptions coming from the UAW strike. That conversation coming up after the break in our Wall Street Week Daily segment. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg.
Welcome back to The Close. It's time now for our Wall Street Week daily segment with David Weston, who joins us every day around this time. And David, there's been so much talk about the United Auto Workers strike and the effect on Ford, GM, and Stellantis. But we forget there's a whole ecosystem of parts makers and other companies that are also being affected.
Exactly. In some ways, those automakers are just the tip of the iceberg. There's a big iceberg down below the water. And to take us through that supply chain issue, we welcome now Bindi Vakil. She is Resolink CEO. Welcome back, Bindi. It's great to have you here. So give us a sense of just how many ancillary businesses there are feeding into the auto industry that are either now being affected or will be.
David, there are tens of thousands, and let me give you a little bit of a snippet on Resolink and why we have this unique perspective into the global supply chain. Resolink monitors global supply chain disruptions 24/7 in more than 100 languages, and more importantly, we map these supply chains down multiple tiers deep, all the way down to the small suppliers and raw material providers that are vital to supply chains operating. Put these together, our customers, including the automakers, work with their suppliers multiple tiers deep to navigate through these challenging disruptions. So as you can imagine right now, a small disruption at the OEM level really ripples through the supply chain as you go to the suppliers and suppliers globally. So this is not just limited to the United States and suppliers here. Globally, when demand goes up, as it did before the strike went into effect, there was what we call a bullwhip effect, where suppliers saw an increase or a spike in demand. And now as the demand is dropping, as this strike expands, to the supplier, this looks like a manifold reduction in demand. And these suppliers can be everyone from a small mom and pop shop that does some tooling, or it could be a large company that manufactures massive systems.
So let me pick up on those small mom and pop shops. In your map, as you look at it, how many of these suppliers are, I guess they call them tier 2 or tier 3 suppliers rather than tier 1, because they can be very small, like family-owned businesses, as I understand it.
Yeah, absolutely. I mean, in the automotive supply chain, we've mapped down 4 to 5 tiers deep, and we see everything from semiconductor, which obviously shows up in our cars, everything we do. So some of that supply chain at the 3rd and 4th tier looks fairly similar to a typical high-tech or consumer electronics supply chain. But then when you look at things like seats and threads, I mean, you'll see the seatbelt thread makers, and you will see the upholstery, and those small parts can come from suppliers that aren't terribly sophisticated. And there's an ecosystem of suppliers around each of those factories as well.
Yeah.
So it's a very complex and fairly networked industry.
I am curious about the potential longer-term changes. The last time we had a major supply chain disruption, of course, born out of the pandemic, we did see some major structural changes that took place as everyone sort of had to reassess what their supply chains looked like. Do you think if this does drag on, we'll see something similar play out for the automakers?
Absolutely. In fact, right now, there are 5 mega trends already in play why supply chains are in a state of flux. One is extreme weather. 2 is the demographics and labor disruptions, which, by the way, is one of the top 5 reported disruptions in our database. The 3rd is geopolitical shifts. fourth is ESG, and fifth is cybersecurity. So these are five mega threats, if you will, that have already caused supply chains to either shift, move around, do things differently, cause suppliers to change how they operate. So they're long term, specifically to the labor strike. Yes, we see a lot of our customers on the Reslink platform assessing suppliers, really understanding where they have unionized factories and those types of dependencies to manage this in a more proactive way.
And we should point out, too, I mean, as they're doing that, it's one thing to sort of look at the supply chain through the context of the cars that you're making now. But if you believe in, I guess, what the future is supposed to hold, where we all move to renewable energy vehicles of some type, how much does that change the calculus?
You know, it changes quite a lot. The electric vehicle supply chain looks very much like almost like a networking or switching product, but on wheels. So it's a very different type of, there's a lot more automation. There's a very different type of componentry that goes into those. It's complex. So the kind of, plus there's a tremendous amount of AI and AI-driven automation that is coming our way on the EV side as well. So there's a lot changing actually as we speak.
Bindia, to come back to this strike right now, how long before it causes permanent damage to the supply chain? Because I have read some accounts that some of the smaller suppliers actually do not have enough cash on hand. They don't have the resources to go very long into the strike. Could we do permanent damage to the supply chain?
You know, it is on a lot of our customers take care of their suppliers to some extent. You know, we see customers looking at which suppliers are highest impact to revenue, for example, and then extend them lines of credit. This is something we recommend companies do as we speak. Really monitor which of your suppliers are potentially in financial distress risk. Assess their financials, have candid and collaborative conversations with them. And then there are several things we recommend our customers do. And many of them are doing that right now.
Okay, Bindia, always good to have you with us. Really appreciate it. It's Bindia Vakil of Reslink. So, as you know, there are a lot of households in the United States who don't have that much money saved up, and you wonder about a lot of people out back in my home state of Michigan, Ohio, Missouri. They're under some stress right now.
Yeah, I've seen some of the economic calculations for exactly how this could affect those individual households if this goes on for a longer period of time, and it's pretty sobering.
Yeah, right now it sure looks like it's not ending anytime soon. Unlike the Writers Guild, you got the Writers Guild strike taken care of. Congratulations.
In theory, congratulations. Thanks. Now we just got to work on the auto strike.
Yeah, no, exactly. We've got a long way to go. So tomorrow we're going to hear from Raj Cohen, Senior Chairman of Sullivan & Cromwell, about the moves to regulate the largest non-bank banks. There are some big ones like BlackRock who are really concerned about that. And then on Friday, Rashir Sharma of Rockefeller International joins us on Wall Street Week. We're going to talk to him about investing in China. A lot of it's not being done right now. And if it's not being done there, where's it going to go? That's all coming up at 6 p.m. Eastern Time on Friday on Wall Street Week.
And be sure to check that out. You could also check David out every day right around this time here on The Close for our Wall Street Week daily segment. Here on The Close, we're rounding out into the final hour of trading here on a soggy Monday afternoon, picking up pretty much where we left off last week, which is the market still searching for some degree of direction in the face of Treasury yields that continue to drift higher on the long end, higher on the short end, and right now a revaluation of some of those multiples that have left a lot of folks wondering whether there was any room left to run for U.S. equities. Romaine Bostic and Katie Greifeld counting you down to the close. This is Bloomberg.
Paul Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people.
Almost 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostic.
And I'm Katie Greifeld.
And we take a look at a market that's still searching for direction here, Katie. A mixed day here for most of the broader indices, but that's coming off what, of course, was an absolute awful week last week.
It was really bad. Yeah. We're talking about the worst week since about March for the S&P 500 when we had that banking crisis, if you will, unfold. So it makes sense that we're left a little, tired today on this Monday?
Yeah, a little tired here because everyone thought maybe the Fed was behind us. I think we sort of learned a hard lesson last week where we learned that the Fed is still out in front here. And now, of course, a lot of people obsessing about the potential for a government shutdown. We're still relatively unchanged on the day. And I guess the fact that we're in the green on a couple of the key indices, maybe that gives some people a little bit of hope here. But take a look at the bottom of your screen there, Katie Greifeld, 465 and change right now on your 30-year yield.
I thought you were going to go to Bitcoin, which is also down today. But all the action in this market, even when you put in crypto, has been in the bond market. The volatility that we've seen, mostly yields higher, has just been pretty breathtaking so far.
And it makes you wonder if the volatility is going to pick up. Flip up the board real quick here because I do want to just talk real quickly about the government shutdown. We talked about it a little bit earlier here, but take a look at this chart here. This is basically the MOVE index, bond price volatility, and the red lines are the last few shutdowns that we've had, or at least the brink of shutdowns here. And that volatility does start to pick up because, of course, this has a material effect on, obviously, our federal finances, but also the ability of the Treasury to continue issuing new debt.
And, of course, the countdown is on for that Saturday midnight deadline. We'll see what happens over the next few days. But let's talk about some of the biggest movers today. I want to highlight Amazon. This is a really interesting story. You can see the Amazon shares up 1.8% after news broke that they're going to invest as much as $4 billion in Anthropic, basically one of those hot AI startups. The plan here is that Anthropic is going to move most of its software over to AWS's data centers, and also it's going to use Amazon's homegrown chips to train its models.
Interesting. This will be for good, right? Not evil.
It'll be good for Amazon, theoretically, and good for Anthropic. You can see that's giving a lift to those Amazon shares. Let's also talk about Open Door.
This is an interesting story.
Yeah, not having a great day. Of course, Citi coming out, cutting the price target to do $2.70. It's a reflection of basically housing macro headwinds that we've been talking about. That's going to keep existing home sales below historical levels, according to Citi. Shares off on Open Door by about 5.5%. And we should probably talk about I was going to say the strike. I have to specify which one. The
strike?
writer's strike. Of course, we're finally getting an agreement between the studios and the writers. I wanted to take a look at.
And I assume the shares are rallying on this?
No, they were, and now they're not. Warner Brothers Discovery's off by 3.5% or so.
Yeah, it's an interesting reaction. In fact, I think the last time I looked, Netflix was really the only major studio that was actually higher in the day.
Yeah, I'm hoping someone can explain that reaction to me.
Yeah, all right, well, stick with us. We'll try to get you that explanation 1 hour away from these closing bells. Our cross-platform coverage, counting you down to the close. That coverage, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Masser and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, originals, and our partnership with YouTube. Happy Monday, Carol and Tim. Interesting day for the markets, not so happy at all. And some interesting data that we've been writing about here, some Federal Reserve data showing that, well, the amount of money in the pockets of consumers right now, not quite as flush as it was in the past.
Yeah, and that's kind of true for everyone, whether you're the richest of Americans or the poorest. But what's interesting is this Fed survey of household balance sheets. Basically, what they found, the richest 20% of Americans are doing the best. They still have some excess pandemic savings. It's a complicated chart, folks, that's out there for YouTube TV and, of course, our streaming service. But that's what it says. The richest 20% of Americans have excess pandemic savings. They have not run out completely, but they now have less cash on hand than they did when the pandemic began. The bottom 80% of households by income, bank deposits, and other liquid assets were lower in June this year than they were in March 2020 after being adjusted for inflation. So they're getting hit hard.
Okay, what about the next 40%, the middle class? They saw their cash savings drop below pre-pandemic levels in the last quarter. So Romaine, we're talking about this because for a couple of years we've been saying over and over again, okay, what about excess savings, powering the consumer, powering the economy? If that dries up, what happens to the economy? Because, well, consumers power this economy.
Yeah, I never quite bought into that. I mean, I know that the aggregate data showed that, but it just seems that when you looked under the hood, there was a huge concentration of those savings amongst a small group of people in this country. And when you looked at everyone else, at least anecdotally, they were already struggling. And we're talking like months ago when we were having this conversation. So I can only imagine what some of those balances look like today.
Well, let's talk about another potential pain point. Of course, we're talking about the child care cliff. This is when those pandemic-era subsidy for U.S. child care providers expected to expire on September 30th. And there's a great column by our Sarah Green Carmichael saying that it's estimated about 3 million children could lose their spots, and thus that's why we're calling it this child care cliff.
Yeah, we spoke last week with Catherine Edwards when I was down in D.C. about this. She had testified. There was a hearing last Wednesday, I believe, where she testified about this. This is a big deal here. We're talking about real money that went into people's pockets to pay for child care, and it was already kind of set to expire one way or another. But now, of course, with all the infighting over the government shutdown and whether there'll have to be some compromises made in order to appease those that far right-wing faction of the Republican Party, it makes you wonder if this will ever even get renewed.
It's amazing, too, that we still can't get this right? So many working Americans, they talk about when it comes to struggles, it's taking care of kids. It's either you can't find the people to do it, or it's also really, really expensive. What's also interesting, and I think that kind of stands out from this opinion column for me, is that when you have these child care deserts, maternal workforce participation really takes a hit. So essentially, if you can't find folks to take care of kids, it's women who get pulled out of the workforce. And they made incredible strides and advancements coming out of the pandemic when we saw a lot more flexible work situations coming out, Tim.
It's not rocket science. If you can't find somebody to take care of your kid, you're not going to be able to go to work. Here was something that was pretty shocking that I found in that story. The federal threshold for household income in order to say that child care is quote unquote affordable, 7% of your household income. That is like, find me where you can get child care for 7% of your household income.
Yeah.
Not in New York City.
Yeah, and to Carol's point too, I mean, there's just so much data and so many about the correlations between having women in the workforce and having viable childcare alternatives, and the fact that we're still having this debate, particularly in a political spectrum, is just mind-boggling.
Yeah, you keep hoping we're going to keep moving forward and learning, but we continue to slide back. All right, guys, we're going to continue this discussion, and we're going to also talk a little bit more about the markets and take you down to the close on this Monday. Join us in less than 60 minutes' time. We're going to count you down to the close on radio, on TV, on YouTube, and of course, Bloomberg Originals. Join us for Beyond the Bell at 4 p.m. Wall Street time.
And we continue our markets coverage right here on the close. About 50 minutes until we get to those bells, and all the focus isn't on equities, it's on treasuries. Those yields marching higher, hitting multi-year highs today as expectations that the Fed will maintain higher for longer take hold and the supply of treasury debt increases. Gene Tenuzo joining us right now, Global Head of Fixed Income over at Columbia Threadneedle Investments. And Gene, let's just start off with the elephant in the room here. I'm looking at 13 basis points higher today on the 30-year yield, similar on a 20, 10 basis points on a 10, and even the 2 and 5 year moving higher as well. Gene, when does it stop?
That's a good question, Romaine. I think the market has taken the comments from Powell as meaning that the longer end of the curve really needs to come higher. And there doesn't seem to be a near-term catalyst to abate that move at the moment. But I think longer term, the market kind of missed the plot after the Fed meeting last week. The single most important thing that happened in that meeting is that we're getting even closer to being done talking about rate hikes. And 18 out of 19 members that put their forecast down said basically one more hike or fewer, and then we're done. And I think that's the most critical thing here. I think the long end of the curve, especially that 30-year point, the risk premium there can continue to bounce around, particularly as we see deficits and Treasury supply continue. But I do think we're going to see more stability at the front end of the curve as we go forward.
Is that where investors then gravitate to, Gene? Because there's been some folks on this program, including today, that says maybe there is an opportunity a little bit further out in duration. Are you seeing it?
We think duration overall is attractive. If you look at historically when the Fed reaches that peak in the rate hike cycle, the next 12 months of returns are very attractive for high-quality bonds. We think we're at that point, and at the worst case, we're 5 weeks away from that last rate hike. And I think going forward from here with a 4.5% yields along most of the yield curve or higher really sets you up for nice returns. Our preferred area would be the 5-year part of the curve to avoid that volatility at the long end that could come from sort of uncertainty around risk premium, especially with a government shutdown looming.
Well, Gene, something I'm still scratching my head over is why we're seeing these huge moves at the long end of the yield curve. You think about when you look at a basis point level, what we're seeing in terms of the 10-year, the 30-year, what's actually driving that?
Well, I think there is some law of gravity in terms of how inverted the curve will get. And now we're at a 5.25% to 5.5% funds rate with the potential to go yet a little bit higher. I think if you get up to 5.75% with the top end of the range for the Fed funds rate, having a 10-year yield 100 basis points below that is reasonable, but hard to go much below that until we see a material change in policy. So I think we're going to be stuck in this range where the front end of the curve is kind of dragging longer maturities higher. But I think we're getting close to the end of that move, honestly. And I think, at the end of the day, it's going to be changes in the economic outlook that really are going to drive Fed policy. And I think now, for the first time in 2 years, we're getting to a point where those risks for the bond market are two-sided instead of just one-sided with yields moving higher.
Well, Gene, there was a really amazing chart out of Deutsche Bank last week, actually, that plotted the 10-year Treasury yield back to 1790, so over 200 years or so of data. And the average over that time span is 4.5% for the 10-year Treasury yield. But you think about the economy that we had in 2007 when we were last here, what we had in the 80s, the 90s, and in the 1700s or so. Is this economy built to withstand 4.5% 10-year Treasury yields?
Yeah, that's a good question. My Bloomberg terminal doesn't go back quite that far, but if I look at the data that we have versus what the Fed is projecting, basically GDP growth is already there at around 2%, which is consistent with their long-run forecasts. The unemployment rate, just below 4%, is already consistent with their long-run forecasts. And even the inflation rate, if you strip out housing, CPI ex shelter is already at 2%. So I think we're very close to that equilibrium economy, and they will be able to make meaningful changes to the funds rate when the data change. And I think your previous guest was talking about what some of those sources could be, but I actually think we're not that far away from an equilibrium economy. And now if you weave in some risk to the downside, I think rates can go lower. I wouldn't anchor on a 300-year average in terms of determining where 10-year rates should be now. What we're looking at is the economy changing I think the simplest way to look at that is looking at the housing market, where existing home sales are at recessionary levels because of what's happened to interest rates.
Yeah, interesting too. Why do you think then we're seeing so much volatility then in the yield space? Is it because of just a difference of opinion about where we go, or is there something maybe a little bit more consensus oriented?
I think it's a difference of opinion, and I also think there's a global divergence going on here. And it kind of goes back to the old Alan Greenspan comment that the U.S. cannot continue to be an oasis of prosperity. And in the current environment, we're seeing weakness in China, we're seeing weakness in the UK and Europe. And the question is really, when does that come to the U.S. and start to outweigh some of the growth momentum that we've seen here? We think those factors will start to come into more balance as we go over the next few months.
All right, Gene, really enjoyed this conversation. Gene Tenuzo, Global Head of Fixed Income over at Columbia Threadneedle Investments. Thank you for your time. Now, coming up on the close, the plan to turn the U.S. back into a semiconductor powerhouse, how the government is calling on former executives from Goldman Sachs and KKR to help lead that strategy.
And one of the biggest decliners today is Alcoa, an abrupt change at the top of that company, the largest U.S. aluminum producer, naming a new CEO as it deals with operational and permitting setbacks in Australia.
And a big conversation coming up. Usher is confirmed as
he's going to be here?
No, but he's going to headline the 2024 Super Bowl halftime show. The Grammy award-winning singer calling it the honor of a lifetime.
Is Kim Kardashian performing as well?
I hope so. I just want to talk about Taylor Swift, though. In any case...
Taylor Swift, is she performing?
No,
this is going to be some halftime show.
We have
all that and more coming up in a bit. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
With less than 44 minutes until we get to the closing bells here, the Magnificent Seven trying to do what has made them so magnificent. Apple, Nvidia, Amazon higher here on the day, but you see somewhat fractional gains, and with some of the other cohorts down on the day here, the net effect is a market that's relatively unchanged. A lot of big cap names are in the red, including Microsoft, which has taken a leg down just over the last few minutes. Some of the consumer staples companies, as well as consumer discretionary names, also moving lower here on the day. A big part of reason for the agitas, what you see right now in the middle of the screen here with the 30-year yield right now around 4.6. That's 13 basis points higher than where we were just on Friday. The selling that we're continuing to see on the long end of the Treasury curve causing people some concerns as about what's actually being priced in. Is it higher rates or is it more about economic conditions or maybe a bit of both? The Bloomberg Dollar Spot Index trying to reassert itself once again here. Bitcoin not getting any love. And I guess if you're looking for a respite from some of the big moves that we had seen in the energy space, you at least got it today. WTI crude back below $90 a barrel. Let's get Abigail Doolittle into this conversation as we do every day at this time for our Options Inside segment. And Abigail was just taking a look at the VIX here, up for what, 7th of the past 10 days here. Out around 17. A big question is, why is it continuing to move higher?
Well, all of that uncertainty you were just talking about, Romaine, whether yields, if that's higher for longer or it has something to do with the global economy. And of course, we have this China weakness. We also have action in the yen, all of it coming together. And I can't think of a better person to discuss the intersection of these topics than Samantha LeDuc, founder of LeDuc Trading. Great to have you with us, Samantha. And so Romaine is talking about the VIX. When I take a quick look, a simple look at the chart, it looks as though it could pop very quickly above 20, which would suggest there will be more volatility for stocks to the downside, maybe even significantly higher. What are you seeing there?
Definitely dollar and yields are making the weather, right? So when we actually had back in July 31st a very large Treasury issuance, August 1st was when we started to roll over in markets. So underneath there was definitely already breaking down and there was net selling. But yields were really the tell, right? We had this issuance and it was large. Yields started moving higher with the dollar. And they make the weather. So right now, I'm not really liking these odds. VIX has definitely percolated because we needed a trigger, which was FOMC, right, last Wednesday. And as soon as Powell got off the podium, we obviously had the volatility because he obviously made the call, basically, that the Fed funds rate for 2024 was going to increase from 4.6% to 5.1 and basically pulled out 2 cuts from the market that the market had been pricing in. So the dollar and yields are at a very, very important level. 106 on the Dixie, 4.5% in the 10-year. And that means above that level is actually even more volatile. And I'm actually looking at a gamma level in the market right now and a JP Morgan collar structure that says we could actually tag 4,200 by Friday.
Yeah, well, it's interesting that you're bringing up that issuance of treasuries in late July, because what I've been talking about or thinking about was that Fed meeting in July where the Fed indicated that they're not going anywhere. They confirmed that that's last week, but that makes a lot of sense what you're talking about with that issuance, given the fact that we've seen the dollar index, a currency, go up about 5% over that time period, really pretty unheard of. So, you know, when we connect rising yields, rising dollar to the VIX, to volatility, what is it? What is the connection there? What makes it so unsettling for traders? Is it just the money coming out of the system?
Oh, definitely. We have liquidity that's leaving versus coming in, but we also have a structure called negative gamma. So positive begets buying and negative begets selling if we trigger particular levels. And there are CTAs and other quants that basically have price insensitive buying and selling. We have right now what's called kind of a put wall, which is this kind of 4,300 for SPX. If we go through that, that triggers even more outsized selling. We happen to have a JP Morgan collar, which happens to be a very large hedge. It's rolled every quarter. Sometimes it works, sometimes it doesn't. But there is a very stickiness to some of these levels that helps pin the market or pull the market. In this particular case, we have that collar, which is at 42.10 for this September 29th, which is the quarterly expiration for September. It looks very much like the market wants to go there.
Yeah, very quickly, Samantha, when I take a look at a chart of the S&P 500, we did go below one level that suggests support is giving way, that there is a trapdoor there to some degree. What would it take to go below 4,200, and how much further down would we go if we were to do so?
Well, one thing that I'm looking for that's an economic data point this week, I think all eyes are on GDP revision, believe it or not. This is this Thursday, and one of the things that the Fed has managed to do is obviously remove 2 potential Fed cuts in their last week FOMC meeting. This particular revision downward in GDP could show that one of the reasons they removed the cuts, by the way, was on the strength of the economy.
Right.
That revision this Thursday could actually undo some of that, which would be good for bondholders, right? They're suffering terribly.
Yes.
So it could soften yields. It could put a short-term duration bid in bonds and equities, but more importantly, is a slowing backdrop for the economy
thank you so much for weighing in on all of these topics. Very helpful, as always. Samantha LeDuc, founder of LeDuc Trading, thank you for joining us for Options Insight today. And from New York, this is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Well, Usher is next up for the Super Bowl halftime show. The 8-time Grammy-winning singer will headline the big show in Las Vegas on February 11th. And remember, Romaine, back in 2011, he was a compliment to the lead act. He's never actually headlined the show. So
yeah, well, about time. I mean, this should be good. It's generating a lot of buzz. I don't know if you've seen the promotional videos,
of course,
but they have a great one where they're taking a clip from one of his old videos and they're putting it up with Kim K and Deion Sanders and a few other people, basically calling him, as you see there, and letting him know that he's going to perform at the halftime show.
I saw the Kim K one. I didn't see all of the other ones, but yeah, it is kind of surprising that he's never done it before. Of course, he first really broke onto the scene in 2001. I mean, Usher has been a household name for so long.
Yeah, so well, this is fitting, right? Because they only put older, sort of people who've been around here. Now, I know you're a big football fan. Big foot. So I'm sure you were watching this weekend when apparently someone famous decided to show up at this Kansas City Chiefs game.
You know, I wasn't watching, and then I tuned in because rumors have been circulating.
Did you get like alerts on your phone?
I did, actually. Okay. Anywhere you went on social media, it was all about Taylor Swift was at the Chiefs game. She is officially confirmed dating Travis Kelce. Huge news. You can see her there with the Kelce mother.
Yeah.
This is a little bit interesting because Taylor Swift is from the Philly area. She's from Pennsylvania. She should be an Eagles fan.
Right.
The other Kelce brother, of course, I don't know if I should call him the other Kelce brother, but there's a Kelce brother on the Eagles as well. So a little bit of a
But she decided not to date him. Who's he dating?
He's married, actually.
Okay.
I know that because sometimes I listen to their podcast.
Well, that's interesting. Yeah, I should point out, too, I mean, the Chiefs just absolutely whooped the Bears for that game. It'd be nice.
Can you imagine if he hadn't, though? If Taylor Swift came and he just...
I want Taylor to start dating somebody on the Chicago Bears who are 0-3 right now. Maybe she would give that to you.
I don't know. Maybe she's into athletes now. In any case.
Is this the new era? Are we going to get an album about this?
The albums are going to be fantastic. This is Bloomberg.
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
On the next episode of Hello World, I head to Los Angeles, meet some robots, and eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
From New York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is the countdown to the close. About 30 minutes left to go on a somewhat tepid Monday in terms of trading action, Katie.
A lot of indecision if you take a look at the benchmark. If you actually dial back down below, also not too much conviction. You can see there's more green than red, but we're talking about pretty small moves. Energy, though, at the top of the pack is up more than 1%, followed by materials, consumer discretionary. You go down the list, again, pretty small moves until you get to the bottom of the pack. Utilities off by about 0.4%, and staples, interestingly enough, leading losses today, off by about 0.7%, Romaine.
Yeah, interesting to see 100% of the members in that energy index higher on the day. As far as a Magnificent Seven, a bit of a mixed bag for them. Amazon, though, having a great day, up about 2%. Remember, this has actually been one of the relative outperformers in that space for quite some time, even though it's had a somewhat dour September here. But keep an eye on that space and keep an eye on the big Hollywood studios. Of course, our reporting earlier today about a potential agreement between the writers and the Hollywood studios. Netflix right now is probably the only stock amongst them that's really doing well today on the back of that. The rest of them are either lower or somewhat unchanged. Paramount down about 0.4%. And keep an eye on Brainstorm, down 39% right now. This is after the FDA released some documents that appeared to show that they had some doubts about this company's ALS treatment that it's been working on. Remember, this is a biotech with basically one product in the pipeline. That product doesn't get approved. Well, it's look out below here. And Chef Warehouse, which has actually been one of the worst performing stocks out there for quite some time, getting an initiation at UBS, those shares higher by about 2%. Of course, we go back to some of the broader concerns in the market, and by the time we get to the end of the week, this is going to be a chart that a lot of people talk about, the debt to GDP ratio and our fiscal situation right now. That is the debate playing out in Congress right now, at least if you believe in earnest that that is truly what they're talking about. But the net effect of it is, well, a potential government shutdown. The government, of course, here in the U.S. has to approve a new budget by the end of this fiscal year, which is September 30th. And, well, as we stand right now here on whatever it is, September 25th, still no deal, Katie Greifeld.
Let's go from debt to chips, because Commerce Department Secretary Gina Raimondo is pulling together a team of former Wall Street executives to help turn the U.S. back into a semiconductor powerhouse. Let's break this down with Mackenzie Hawkins of Bloomberg News. And Mackenzie, set the scene for us. Why is the U.S. really putting their muscle behind this effort?
So the U.S. is engaged in basically a global war over chip technology. Now, chips are the tiny electronic components that are in everything from electric vehicles to nuclear missiles. And the U.S. used to produce the chip technology and make chips here, but over the past 40 years, all of that production has pretty much shifted to East Asia. And now Washington is very concerned about China's rise in this technology, particularly with military applications. So there's a massive government subsidy effort to convince the world's biggest chip makers to build factories and produce chips here in the U.S.
This has sort of been an effort that's been going on for quite some time. Now, it's interesting, Mackenzie, to see some of the dollar figures attached to it, and as well as the folks who have to deploy this cash. But there's been some concerns here that even when you look at the aggregate amount that the government is putting on the table, that for some of these companies on an individual basis, that's still just a drop in the bucket.
That's correct. That's one of the central challenges of the CHIPS and Science Act, which is the marquee semiconductor policy that was signed into law just about a year ago. The government is dealing with just over $50 billion in subsidies, and that's broken down into $39 billion in loans, and then a pool of around $75 billion worth of loans and loan guarantees. And that's really a drop in the bucket. It's about just a little bit more than a year's capital spending by some of the biggest chip makers. And the U.S. is trying to convince global technology giants like Taiwan Semiconductor Manufacturing Company, like Intel, which is a U.S. company, like Micron, to build fabs, which are chip production facilities that cost $20 billion or more. And so the Commerce Department has some really difficult decisions ahead over how they're going to divvy up this relatively small pool of money between more than 500 companies that have expressed interest in the funds.
Well, Mackenzie, that's what I'm interested in. What does due diligence on the government's part look like here? How do they make sure they're investing in the right companies?
I mean, that is the central challenge that has plagued Washington's efforts at industrial policy in the past. And there are examples that folks here point to, like Foxconn and like Solyndra, where the government has bet big on a company that has gone belly up. And the biggest concern is making sure that doesn't happen here. And so the Commerce Department, led by Secretary Gina Raimondo, has pulled together a team that includes some folks from Wall Street, includes veterans of Goldman Sachs, of KKR, to try to structure deals that put commerce on a level playing field with companies that hold all the tools of the trade. And they've said that they're going to give out the money in tranches. So once they reach an agreement, we don't know when those are coming, at the earliest, probably later this fall. They'll be dispersing the money over time, contingent on the companies meeting benchmarks related to workforce development, production capacity, and getting these factories up off the ground.
All right, Mackenzie, great reporting. Really appreciate your time. Our thanks to Mackenzie Hawkins of Bloomberg News. And it's an interesting question, Romaine. I mean, I guess that's why you put some of your very big brains in a room together to try to figure out where to actually put this money.
Yeah, and hopefully they get it right. I know everyone always likes to focus on the failures. Obviously, Solyndra, at least one of the big ones that people made a big deal out, but you forget about the success stories, including, of course, Tesla. You forget about the bailout of GM. And, of course, you forget about, if you really want to go back in time, all that money that was put into the Human Genome Project and all those biotech and the medical companies that came out of it, or into the space program and all these defense contractors and other sort of component makers that are thriving today.
People never forget your failures.
Yeah, so that's my list for you, Katie Greifeld.
That's a good list. I mean, it'll be fascinating to follow this, and we'll see where that money actually goes. But coming up on the close, before we get there, we're going to be talking about a sudden C-suite change. It's putting pressure on shares of aluminum giant Alcoa. We'll get into it next in our Stock of the Hour. That's up next. This is Bloomberg.
what do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, probably I try and play that role.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Time now for our stock of the hour, a look at Alcoa. Shares of the aluminum giant under pressure after announcing the sudden switch in CEOs has Wall Street wondering if there's a little bit more to this story. The company naming William Oplinger as its new head, succeeding Roy Harvey. Joe Doe joining us right now. He covers commodities for us here at Bloomberg News. And this seemed to take a lot of people by surprise, which is never really a good thing for the leadership of a company. What do we know about the reasons for the departure?
At the moment, we're not really clear why now. Listen, I mean, Roy Harvey had been the CEO ever since the company split into two back in 2016. So he's been there for, 7 years now. There had been talk over the years that, maybe somebody else new would come in, especially because Roy Harvey was the guy who they expected to cut debt, bring down the pension liabilities, and turn the commodity company into a more efficient company. He did all those things. Now, Bill Oplinger comes in. Bill is very well known in this company. He's been there since March of 2000. He's been the CFO. He is the guy that when people have questions, investor class, some really deep in the weeds things, they go to him. Bill's the guy that oftentimes was going to many of the conferences. So in that regard, Bill becoming the CEO is not something that would be totally unexpected. But again, there was an 8K filing that was filed yesterday. It was published this morning. There also was a mention of severance for Roy Harvey in there. And it does seem to have taken a little bit of the market off guard in that.
What theoretically is he being brought in to do?
Well, listen, a lot of people have said now that Alcoa has been a little bit of a sleepy company, right? There haven't been a lot of major acquisitions, and not that investors have been asking for that, but there's not been real growth that you've seen in the company. Sure, they had a massive bump in the stock back in 2021, right? But that's also because that was the commodities rebounding from the pandemic shutdowns. You've seen some of their competitors go out and get more involved in the battery metal space. You've seen some of them get more involved in scrap, right? Scrap is becoming more and more profitable business. You turn that, remelt it into new material. Alcoa just hasn't been that kind of person. So again, it's too early to tell what exactly they're going to expect them to do next, but these are the kind of questions that have been coming up from investors.
Yeah, and not to dump on Oplinger at all, but I mean, he's been there for quite some time, so it raises the question, what type of innovation can he bring if he's basically been there at the hip of this CEO and, for that matter, previous CEOs as well? I am curious. I mean, you know this company. I mean, this was a premier U.S. company a few years ago. It was a member of the Dow. It was, famously, it was always, the first company to report earnings, and now no one really thinks about it much.
Yeah, I mean, Alcoa has become the commodity producer. They make aluminum, right? The jets and car part businesses have long been gone.
To Arconic.
And Roy Harvey, I mean, one of the things he did well that investors liked in those first few years was he just made Alcoa a boring commodity company. And it turned out that actually, if you invested in Alcoa for the first 2 years, you saw your share price double, right? And so investors were happy with that, but that's 7 years ago, right? And I guess it does bring up a good question of what are the big things that are next for Alcoa? Listen, they're very much talking about green aluminum and everything else, but it'll be tough to see.
So Alcoa looking a little bit sleepy here. Are there any exciting aluminum companies? What do their peers look like?
Well, I think the aluminum space, they're all trying to figure out the next step. How do you make aluminum completely without carbon, right? Alcoa has a joint venture right now with Rio Tinto that Apple is involved in. I wrote about that 2 years ago, right? And how much progress have you seen in terms of them scaling up commercially? Not a whole lot. And I think the whole industry is trying to figure out that next step. And of course, everybody's just raving about battery metals, nickel, rare earths and everything else. Aluminum is aluminum. Steel is steel, right? These we will always need for their various commercial inputs. But in terms of the growth, it seems that, most of these companies have figured out their markets at this point.
All right. Well, Katie Greifeld's still on the hunt for an exciting aluminum company. Joe Doe, who helps cover this sector for us here at Bloomberg News. And we want to actually continue here in the commodity space because the American Security Summit is underway down in Oklahoma City. The CEO of Chevron, Mike Wirth, he spoke from that event about energy policy and the impact of EVs. Take a listen.
When I hear somebody that starts to rule things out, I'm hearing somebody who's not serious about energy. There is no silver bullet in here. EVs are great, but EVs are not going to be the silver bullet. They're a part of a very complex solution set.
And that was the CEO of Chevron, Mike Wirth, speaking a little bit earlier, Katie Greifeld, out in Oklahoma City. And we've heard this from a lot of executives who are kind of in this space, or the fossil fuel space, if you want it. They're obviously trying to balance out their legacy business with what I think most people agree is going to be the future. Now, whether that future is 5 years from now, 10 years from now, or maybe 50 years from now, no one really knows. But clearly he wants to see maybe a little more balance in the interim.
Yeah, you think about what the Biden administration and other administrations have put their muscle behind. It's EV production. And it was interesting also from Mike Wirth saying that if you look at U.S. oil production, it's being held back by inconsistent energy policy, which is what you would expect him to say. But, I mean, it's a point that plenty of people have made.
Plenty of people have made, and they've been making that, I feel like, for the last 20 years now. And it is what it is, and I don't think it's going to be any different, right? I mean, if you get a new president in another year here, how is that policy going to be materially different from the policy we had under this administration or the previous one?
That's the interesting question. How much does the president actually matter here?
All right. Well, know who matters, Katie Greifeld?
Tell me.
Our next guest here. We're counting you down to the close with about 15 minutes to go. Ed Clissold going to be joining us over at Ned Davis Research. Stick around. We'll be back in a moment. This is Bloomberg.
Particular is that the brain is that last fortress, and our inner self is the thing that defines us. And yet we're at this turning point where that inner space could become part of some business's private enclave or some government's Orwellian fantasy.
So I worry about this deeply. And I worry that that final private space, the space that I think is so critical both for self-awareness and for resilience, for the ability to know truth from fiction, the emotional self-reflection and cultivation, is at risk of brain transparency.
You mean the idea that we can just be seen through entirely?
Essentially, right? I think the way we define intimacy in a lot of relationships is by choosing what emotions, what thoughts, what secrets we want to share with another person. And if all of that can be revealed by decoding your brain activity, if other people can have access to it, whether it's your partner who says, no, I want you to prove that you're in love with me, or a lie detection test by the government, or the way you authenticate yourself at borders is through brain transparency, I think this final space of mental reprieve is at risk.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
10 minutes until we get to those closing bells. Katie Greifeld, and a mixed day for the markets once again, coming off what was last week one of the worst weeks that we've seen since March, at least for the S&P 500. Right now, holding on to fractional gains here on the day, about 0.2% for the Dow and the for the S&P and the NASDAQ here. But there's still some concern here about what we're seeing in yields. 4.5 right now on the 10-year.
Well, let's get into it now with Ed Klissel. He is Ned Davis Research Chief U.S. Strategist. Ed, it's great to have you with us. I'm curious, when you think about what's happening in the bond market, you think about what is happening in the stock market, how related are those two markets right now?
Oh, it's very related. Yeah, with yields across the curve to the highest levels in several years, in some cases a couple of decades, investors now have to ask themselves the question, are there reasonable alternatives to equities? And so if you were to say, look at the earnings yield for the S&P 500, so inverse the PE ratio, so PE of 20, earnings yield of 5, stocks are actually more expensive than cash. So you really have to try to find companies that are going to grow very quickly to justify owning a risky asset like stocks instead of just sitting in cash and collecting a risk-free 5.5%.
And what do you think the tipping point was? Because it feels like every couple of months, maybe the stock market starts to really be driven by what's happening in the bond market. But when you think about this latest episode, what do you think the actual catalyst was that now we're in this situation where it feels like the bond market is very much wagging equities?
Well, I think that the investors are starting to figure out that the Fed is serious about higher for longer. And so rather than what the expectations were for maybe another hike and then several cuts next year, now we're starting to price in, either a soft landing, which means rates will be higher for longer, or the other side of the coin, which is the economy doesn't do so well and the Fed is cutting because all sorts of bad things are happening. So, the market just was living in a little bit of a Goldilocks that probably wasn't going to be there forever, of inflation coming down enough for the Fed to cut rates without causing recession. That's a very, very thin needle to have to thread.
I am curious about some of the technical levels, Ed, that we've been seeing in the equity space. A lot of talk about at least the S&P and the NASDAQ breaking below that 50-day a couple of weeks ago and then the 100-day moving average, and whether there's a trend line here that is now starting to point down.
think there are some technical levels that are starting to be breached. They still are fairly short or intermediate term, and we're in a seasonally weak period. We had such a great start to the year. The first 7 months of the year were the best since 1997. So a little bit of a pullback at this point, still within the context of a long-term uptrend. But what we do want to watch remain is to see if those long-term technicals break down. For example, percentage of stocks above their 200-day moving averages. That's looking back several months. It's down to about 45, 44%. Not great, but usually it needs to get into the low 30s before you'd say this is a top. And furthermore, what I'd say is usually tops are processes. So if this is the first part of a top, then we'll probably have a few waves before a downtrend gets started in earnest.
How much has seasonality played into some of the weakness that we've seen? I remember there was a lot of discussion about how September is historically a bad month, and with just, 4 more sessions until the end of the quarter here, I'm just looking at the month-to-date losses, the quarter-to-date losses, and it's pretty much consistent with that.
It is, and some years it matters a lot. Some years the market tends to find a different rhythm. This year it's actually moved in the seasonals in lockstep, but it's because of the macro backdrop has made sense, and we hit a point in the summer where we had priced in a lot of the good news, a lot of investor sentiment data that we look at, surveys of investors, but also positioning of a lot of investors was pretty optimistic. We've backed a lot of that away. Our composite of short-term sentiment has dipped into pessimism, not quite to levels that you'd see a good bottom in place, but we're getting there. Just seasonality starts to turn around. So it looks like we have a good shot at the strong seasonality heading into the last couple months of the year.
And Ed, you think about the relationship, again, I'm really stuck on it, between bonds and equities. Obviously, the Treasury market has done a pretty lousy job of hedging the sell-off that we've seen in the U.S. stock market. What's the haven in this environment to your eyes?
Well, first of all, cash would be the place to look because of the inverted yield curve. But if you start looking at companies that can manage this interest rate environment, ironically, it tends to be some of those mega cap tech companies. People think of them as, quote, long duration assets, so rates go up so that they could underperform. But not all of them, but some of them have such strong cash hoards, they can actually manipulate the yield curve. They're making more money on the interest income from all their cash than they're actually paying out interest expense on their bonds. Whereas you compare that to small cap stocks, they don't have that kind of cash. They're having to go back to the capital markets on a regular basis. And so as they have to re-up when their bonds mature, they're paying higher and higher interest expense. So for the S&P 600 small cap index, their interest expense is actually at a record high, and it's been trending up for a little while now. So that's the challenge for these smaller companies or anybody who has to go back to the capital markets.
Yeah, that's a fascinating point on small caps when you think about some of the interest expenses that they're having to manage right now. But when you talk about some of those companies that are very cash rich and don't necessarily need to worry about some of that interest expenses, what kind of companies fit the bill here? Because my mind, for example, Ed, goes right to some of those mega cap tech names.
Well, those are the ones. We're not allowed to speak about individual companies, but I think with a little bit of work, our listeners can see who they are. But yeah, they're the ones that have been generating super high cash flow for years, have great margins, and built up these fortress balance sheets. They're the ones that can handle a higher rate environment probably better than most other companies.
All right, Ed, always great to talk to you. Ed Klissel there over at Ned Davis Research here. A look at, I guess, Katie Greifeld, at some of the market action and whether this is maybe just sort of a temporary seasonal blip. Maybe there's something more structural there. I don't know. I guess we're going to find out over the next few days and weeks.
The point on seasonality is pretty interesting, though, because I feel like I look at some of the seasonality functions on the terminal, I kind of ignore them. But we were warned September is ugly, and that's exactly what we're getting.
Yeah, I think everyone warned us on that. And like I said, as we were speaking with them, I was just going through those numbers here. Basically 4% down on the S&P, 5-6% on the NASDAQ right now, and even the Dow down 2%. We didn't even get to ask them about the Russell. That's down 6%.
I know. Really fascinating point, though, when you think about some of these smaller companies, maybe the maturity wall isn't as scary as maybe some had suggested. But for those smaller companies, interest expenses are real.
Yeah. The problem, though, is where else did you get a return this month, right? Because we talk about the downdraft that we saw in Treasuries on a price basis, and even some of the other areas aren't necessarily doing that well. We are moving closer to these closing bells here on this Monday afternoon. Our full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting you down to the closing bell, here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms here on a soggy Monday afternoon in New York City. And a somewhat interesting market right now. Actually seeing a lot of price activity to the upside here, Carol, as we get closer to the bells.
Kind of interesting, right? Seeing some buying here into the close. Having said that, really one group that was a standout throughout the day was the energy group.
Yes.
Among the major industry groups in the S&P 500, top of the list, up about 1% overall. And what's interesting is, we're on track for a quarterly gain in the energy names, the biggest quarterly gain since March of 2022. We know the reason, right, in terms of supply curbs by Russia and Saudi Arabia. That's your big macro story, even though we cooled a little bit in oil today, but nonetheless, really a standout in today's trade.
Yeah, but kind of hard to find a standout today with, although we are seeing some buying into the close, still a really choppy session, Katie. And look, it's a holiday and volume's low.
Volume is low, about 10% lower if you look at the S&P 500's 20-day trading average. The point about energy, though, is interesting. The fact that you do see a little disconnect between what the equities are doing and what actual oil is doing. But energy, just off to the races today.
Yeah, that's a really good point, right? We're back below $90 a barrel. But nonetheless, the trend has been for a stronger one. We're going to watch it, though, to see if somehow global economic demand is decreasing. And maybe that plays a little bit into it, maybe longer term.
All right, as we get the closing bells here in New York City, what had been a really mixed market here, from oscillations, from gains to losses, and now back again to gains. The Dow Jones Industrial Average higher by about 40 points, or 0.1%. The S&P 500 higher by about 18 points, or 0.4%. A similar move higher on a percentage basis for the NASDAQ Composite, and a similar move higher on a percentage basis for the Russell 2000, Carol.
Yeah, the Usher Index, though, on a tear. I saw what you guys did before.
Are we going to talk about Taylor Swift at any point? I know we have some stuff to get.
Later.
Okay,
All right, the S&P, let's do the divide. 300 names to the upside, 199 to the downside. Katie for unchanged.
All right, I'll save the Taylor Swift comments. Let's take a look at some of these industry groups here. Like we were saying, energy, top of the pile. That's true on the industry group level as well, up 1.3%. You can see also chips getting some love. So too are some of the auto names. Actually more green than red. If you do look into the red, though, it's definitely some strong trends there. Household products, for example, off by about 0.5%. Food and beverage off by 0.7%. The staples today really taking a beating.
All right, so let's get to some of the individual gainers, if we may. And here's one. It's actually, I think, the number 2 gainer in the S&P 500, number 1 gainer in the NASDAQ 100. We're talking about GE Healthcare. I couldn't find any real catalyst. This company, though, on pace for its worst full quarter since being spun off from GE Electric last year. But this is after climbing about 41% in the first quarter, losing about 1% in the second quarter. It's down about 18% in the third quarter with less than 1 week to go. So this one, though, nonetheless, investors buying into it, up more than 3% in today's session. So talk about a wacky year for this one since being spun off. Amazon, you know the story. We've all been talking about it. It's big kind of AI play, if you will, spending as much as $4 billion on Anthropic. So it's been a crucial partner, and this is helping it move more aggressively into AI. There's a chip component to this. There's a cloud component to this. Read it. It's on the Bloomberg, but nonetheless, Amazon is standout, up 2% at its highs, up about 1.7% at its close today. And then CarMax, top in the S&P 500, heavier volume than usual. Keep in mind, they've got earnings on Thursday, so we'll be breaking down some numbers then. Wedbush upgrading the company to outperform from neutral amid improving market share performance. We'll find if that is truly the case on Thursday when they report. Also upping their price target to 90 from 85. Stock closing at 77 and change, just under 78, so some room to run there. It's up about 30% year to date. 12% of the float is shorted. It's still down 50% from its high back in November of 2021.
And I just want to add one to your list. Sonoma was on a tear today, up about 12% WSM ticker on the back of no real news.
It's that kind of a day, right? Like I can't tell you how many names I pulled up and there was